Welcome to CA Final Audit Marathon Part 1. So in Part 1, mainly we are going to discuss about fundamental terms. There are certain fundamental terms which every one of us should be familiar with before we start the subject of audit. To best of my knowledge, many students are not aware of exactly the meanings of various fundamental terms and they still read the entire subject of audit. I just would like to start this marathon with one important and my favorite quotation. Understanding sentence is not understanding concept. Concept understanding is completely different from sentence understanding. Now you will witness it. So first, this is part 1. Every day from today, every day, one part marathon video I will be uploading. And once all the parts are uploaded, I will combine all that and then once again upload a consolidated file. Once again I upload a consolidated because many students, they can't identify all the parts because some students are not aware of the concept of playlist in YouTube. So for them, especially keeping in mind their purpose, okay, I will be uploading one consolidated marathon file. Okay, once we did all the parts, I upload a consolidated file for your benefit. So with one file, you can just can access any part of that particular video. You can watch any number of times. So while late, let's enter into the subject of advanced auditing and professional ethics, which is a paper 3 at CA final. And we all know that this subject will be asked for 120 marks, out of which 30 marks will be MCQ and 90 marks will be a descriptive paper. 90 marks will be descriptive, out of which 20 marks choice you're having. So you have to write descriptive paper for 70. And so totally 100. You know, for scoring the best in MCQ, for scoring highest marks in MCQ, you have to be conceptually very strong and terminologically, the command on audit subject should be extreme. And one promise I wanted to make you all at the beginning. I feel some of the students are listening classes in regional languages. Okay, not in English. Audit, especially the subject of audit, especially some are listening in Hindi. And I bet any Hindi students, whoever is watching, if at all you think you will definitely understand one point. By listening classes in English, you feel much more convenient, much more connected to the subject, much more. And in fact, your job becomes easier. And this marathon is going to help you to connect with the subject of auditing in its own native terminology. Fine. So let's enter into the fundamentals topic. There are some basic terms which I wanted to discuss. What are the terms? What do you mean by general purpose financials? What do you mean by special purpose financials? Fair presentation framework, compliance framework, financial reporting framework, applicable financial reporting framework, misstatement. Yes, there is a definition for misstatement, and above all, audit definition. So first we'll start with audit definition. Okay, first we'll start with audit definition. We are learning the subject of advanced auditing and professional ethics. So in that, first and foremost thing that we all should understand is definition of audit. From this particular sentence itself, from this particular definition itself, you are going to understand the audit subject that you know is going to be different from the audit subject which is actually is. I challenge, listen carefully. Fine. Audit. What is an audit? We all know. An audit is an independent examination. Now we'll directly open to that book. So this is my edition 1 audit material, CA final. So meaning of an audit. An audit is an independent examination. Independent examination of financial information of any entity, whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. We all know this definition, but you see how much in depth this definition actually. Understanding sentence, understanding concept is completely different. Now look, what do you mean by audit? An audit is an independent examination. You are verifying financial information, you are examining financial information. What examination they are saying? Independent examination. What do you mean by independent? We all know, even in your articleship you would have learned that maker and checker should be different. The person who is executing the task and the person who is checking the task should be two different persons. Only then that review has some value. If I only execute the task, if I only verify the task, this review will not have any value, obviously. So independent means this recognizes the concept of maker and checker shall be different. Maker and checker shall be different persons. Independent examination. Independent word has two different meanings. It may be independence of mind or it may be independence of appearance. It may be independence of appearance or it may be independence of mind. But the definition of audit focuses on independence of mind. Audit must be an independent examination. The person who is checking, who is verifying, who is examining the financial information, he must be a third party. He must not have any connection with the, a financial information. He should not prepare it. He is only verifying. Independence of mind. And company audit, statutory audit. In fact, our entire subject of auditing, especially standards on auditing that we are going to discuss right in our upcoming videos, upcoming parts, they are completely drafted from the point of view of statutory audit. They are drafted from which point of view? Statutory audit. We are learning entire standards on audit only from independent audit, statutory audit perspective. Our standards on auditing, we all know we have totally 35 standards on auditing, one standard on quality control. They are not applicable. Remember, they are not applicable for internal audits. They are not applicable for any other. All these 35 standards on audit, all these 35 standards on audit are applicable only when you are doing independent audit of financial statements of an entity. Stat audit example. Suppose, sir, I'm doing internal audit. Standards on audit do not apply. I'm doing, let us assume, an operational audit. Standards on audit does not apply, for which there are some other separate standards. So independence of mind. Companies Act says, dear Mr. Auditor, only independent mindset alone is not required. I mean, it's not sufficient. You must be independent in terms of appearance. So what do you mean by independent in terms of appearance? Suppose a company is there. In that company, my brother is a managing director. If I am acting as an auditor, for anybody who ever look at me and my brother, they know that we both are siblings and I am the auditor. Public can easily say that based on our appearance, based on what we appear, based on how we appear, public can easily recognize I am not independent. So independence is not about just mindset, it's about appearance also. In case of stat audit, remember, in case of stat audit, independence of appearance is most important. And of course, when you are independent, when you don't have any relationship with that entity, the entity which you are doing audit, when you don't have any relationship with them, naturally your mindset also works independently. See, ultimately, what is important substance over form? Independence of mind. I should work with integrity. I should work with honesty. Independence of mind is what most important. But in case of stat audit, not only my mindset, they look at mostly at what? At my appearance. How I am appearing. Am I independent? Do I have shares in the company? Did I take any loan from the company? Do I have any relative in the management of the company or key managerial persons of the company? They look all the points. They look whether am I eligible or not. So independent means independence of appearance as well as independence of mind. But most importantly, from audit concept, independence of mind is most important. But from lawmaker point of view, independence of appearance is also must. Now you see, an audit is an independent verification of financial information. Now what do you mean by financial information? In a company, financial information consists of two parts: books of accounts and financial statements. Both together are called as financial information, which can also be called as books and records. So books of accounts means we all know today companies are maintaining books of accounts in the form of softwares. It may be Tally, it may be Joho, it may be SAP, it may be Citrix, it may be QuickBooks. There are so many softwares that were evolved in the market. So books of accounts means where entry, transaction capturing, transaction initiation, transaction recording, transaction processing, transaction reporting. That reporting is what? Through financial statements. And you know what? These financial statements are two types: general purpose financial statements, special purpose financial statements. General purpose financial statements, special purpose financial statements. Sir, What do you mean by general purpose financials? What do you mean by special purpose financials? For your information, we do not have audit of special purpose financial statements in our syllabus, SEA 800 series. We do not have in our syllabus. We only have in our CA final syllabus audit of general purpose financial statements. To best of my knowledge, some students don't know this. Whoever is attending my classes especially, they know this, but generally outsiders, they're not aware of it. In our syllabus, we only have audit of general purpose financial statements. So first of all, what's the difference between a general purpose financials and a special purpose financials? General purpose financial statements are those financial statements which are prepared using general purpose framework. General purpose financials are those financial statements which are prepared using general purpose framework. Special purpose financials are those financial statements which are prepared using special purpose framework. If general purpose framework is used for preparation of financial statements, then it is general purpose financials. If special purpose framework is used, then special purpose. What is special purpose framework? Framework means what? Framework means process, policies, rules and regulations. Special purpose framework means rules and regulations for preparation and presentation of financial statements. Rules and regulations for preparation of financial statements which are decided by a specific user, a specific user decided what rules and regulations you have to follow for preparation of financial statements. That's a special purpose framework. Sir, example, a very basic simple example I will take. Suppose you want to get a bank loan. You approached a particular banker. You gave your financial statements a standard. You gave your standard financials. What is your standard financials? Nothing but general purpose financials which are prepared using applicable financial reporting framework, which is nothing but general purpose framework. Okay, so you just took last 2 years or 3 years financial statements and submitted to the banker. And you know what? The banker requested, sir, your profit, everything is fine, but I want to look at your financial statements on cash basis. What would be your profit? What would be your cash flow? What would be your balance sheet picture? If at all you prepare financial statements on cash basis of accounting, tell me, a company incorporated under Companies Act, the company will prepare financial statements using section 128. Financials 129, books of accounts are maintained as per 128. A company must maintain books of accounts on accrual basis only. So naturally, financial statements are prepared based on accrual. But this fellow is asking me, sir, I want financial statements of last 3 years, which is to be prepared on cash basis. Okay, fine. I will go back. I will inform my audit committee. I'm a director of the company. I will inform my audit committee. I will inform my chief accountant, CFO, that I want financial statements on cash basis for getting 100 crore project finance. And the people prepared and gave me. I went and hand over to the bank. He processed it and released the loan. Entire documentation, everything is completed. Now the financials which I prepared now on cash basis of accounting, what are they? They are special purpose financials. Why? You prepared them using special purpose framework. What is framework? Rules and regulations. Who decided? Only banker. He is the specific user. Will I distribute this special purpose financial statements to anybody outsiders? Will I distribute it? Will I publish it? No. Special purpose financial statements are confidential in nature. Special purpose financials are confidential. Sometimes these special purpose financial statements may require audit. Banker may ask, what is the authenticity of the special purpose financials? Okay, as a director said, okay sir, we'll do audit. Then audit of special purpose financials coming into picture, at that time SCA 800 series is applicable, and which is not there in our CA final syllabus. Now coming to what is general purpose financial statements. General purpose financial statements are those financial statements which are prepared using general purpose framework. So what is general purpose framework? It is a financial reporting framework. General purpose framework is a financial reporting framework which takes into account, which considers requirements of requirements of wide range of users. Wide range of users. In fact, instead of word requirement, they use the word common needs. Common financial information needs. Common financial information needs of wide range of users. You see, today, every year, Reliance Industries, Tata Consultancy Services, Tata Motors, Jain Irrigation, there are so many companies, small companies, medium companies, and large caps, small cap, mid caps. You take any listed company in market, stock market, every year as a generally accepted practice, they publish what? Financial statements on annual basis. Yes or no? What are those financials? General purpose. For whose purpose these financial statements are prepared? Is it only for shareholders? No, it may be for prospective investors, it may be for government agencies, it may be for employees, it may be for business acquisition purpose. Whatever the reason, they are general purpose. This is every year which I do, which I prepare every year on a standard basis. I follow some accepted framework which everybody wants. See, whether you are a shareholder, whether you are an employee, whether you are my director, whether you are a government official, whether you are a business prospective investor, every one of you want to know commonly some information from me. Commonly, everyone want to know what is my profit, everyone want to know what is my cash flow, everybody want to know how, what are my assets, what are my liabilities, everybody want to know whether do I have going concern ability or not. So by considering all your common needs, government determined one framework, and that is general purpose framework. It is a financial reporting framework. What is financial reporting framework? What do you mean by framework? Framework refers to rules and regulations. Financial reporting means what? Preparation and presentation of financial statements. Financial reporting means what? Simply, you have financial reporting subject. What do you mean by financial reporting? Financial reporting refers to preparation and presentation of financial statements. What is framework? Rules and regulations. What is financial reporting framework? Combine rules and regulations for preparation and presentation of financial statements. Who decided these rules? How these rules are decided? These rules and regulations are decided considering common financial information needs of wide range of users. There are so many users, all of them commonly want to know certain financial information from a company, listed company. Example, by considering their requirement, if I prepare financials which will fulfill all of their requirement, it's generally accepted accounting principles, it's generally accepted accounting policies, it's general purpose framework, and that financial statements are called as general purpose financial statements. And our entire subject of advanced auditing, whether it is CA final or CA inter, okay, our subject of audit, we are discussing from the context of audit of general purpose financial statements. We are only discussing audit of general purpose financial statements. We are not going to discuss about audit of special purpose financial statements, and that's general purpose financials. Now you get back what is meant by audit. Audit is an independent examination of financial information. Financial information includes financial statements. Financial statements means which financial statements? General purpose financial statements. Now again, now here I have used another word called financial reporting framework. What is framework? Rules and regulations. What is financial reporting? Preparation and presentation of financial statements. Rules and regulations for preparation and presentation of financial statements is called as financial reporting framework. Now there is another term which you have heard very frequently, applicable financial reporting framework. Almost in every standard out of 35 standards, you would have heard of this word, applicable financial reporting framework. Why to that extent? What is your definition of audit? Sorry, what is your objective of audit? The objective of audit is to obtain reasonable assurance. The objective of audit is to obtain reasonable assurance whether financial statements are free from material misstatements, and whether the financial statements are as per applicable financial reporting framework, and to report. So, in the basic objective of audit itself, the term applicable financial reporting framework word came. What is applicable financial reporting framework? Tell me, for a bank, for an insurance company, applicable framework is it same? The rules and regulations for preparation and presentation of financials of a bank, the rules and regulations for preparation and presentation of financials of an insurance company, the rules and regulations for preparation and presentation of financials of a normal manufacturing trading company. Do you think the rules and regulations are same? No. The applicable financial reporting framework for bank, the applicable financial reporting framework for insurance, the applicable financial reporting framework for normal companies is different. So applicable financial reporting framework is determined based on nature of entity. Nature of entity and why are they preparing financials? Objective of financial statements based on nature of the entity, objective of financial statements. That financial reporting framework adopted by management or those charged with governance for preparation and presentation of financial statements. Whatever financial reporting framework based on the nature of entity, based on the objective of financial statements, whatever framework management adopts, management takes, management follows for preparation and presentation of financial statements, we call it as applicable financial reporting framework. As an auditor, my duty is to get opinion, my duty is to get reasonable assurance whether the entity for which I am doing the audit, whether that entity prepared financial statements as per applicable financial reporting framework. If I am working as an auditor of a bank, I need to see banking regulation financial reporting framework and check whether they follow Form A, Form B, balance sheet formats or not. Insurance audit, if I'm doing, I need to check whether Insurance Act related financial statements format is followed. When I'm doing audit of a normal company, trading, manufacturing, not a banking company, not an insurance company, not an electricity company, in such a case, I need to check whether the financial statements are prepared as per Schedule 3. It may be Division 1 or it may be Division 2. So that is what meant by applicable financial reporting framework. And I don't know how many of you have read entire auditing subject without understanding this word applicable financial reporting framework. And these financial reporting framework, based on how they were presented, there are two types. The financial reporting framework, based on how they are presented, there are two types. Okay, one is fair presentation framework, another one is compliance framework. What is compliance framework? It refers to a framework where financial statements are prepared and presented in accordance with requirement of such framework without any deviation. It refers to a framework where financial statements are prepared and presented. Here I am adding just another word for better understanding, exactly in accordance with the requirement of such framework without deviation. If you look at the original definition, without deviation word is not there, exactly word is not there, but I am adding it for making you understand better. So you take section 129 of the Companies Act, 129 subsection 1 of the Companies Act. What is 129 subsection 1 says? Every company shall prepare financial statements which will comply with Schedule 3, which will comply with accounting standard, and must show true and fair view. Since the word true and fair view has been used, Companies Act recommends, Companies Act mandated which framework? Fair presentation framework. Sir, what do you mean by fair presentation framework? In a fair presentation framework, I have to comply with accounting standard, I have to comply with Schedule 3. But if at all complying with Schedule 3 or complying with accounting standard resulted in not true and fair, no, it is not fair. Following that method blindly is not fair. In such a case, I can deviate from that accounting standard, follow that method of accounting policy which brings fair position, which brings fair performance, which will show fair presentation. That is what fair presentation. This is a superior framework. So a simple example I'll take. Suppose let us assume accounting standard 10. Okay, accounting standard 10 or Ind AS 16. Okay, property, plant and equipment. Let us assume it only recommends SLM method or WDV method. It do not recommend any other method. Let us assume I purchased a machine which I have to depreciate using units method, sum of units method, production units method. I have to depreciate it based on production requirement. But the accounting standard says either I have to follow SLM or WDV. Suppose if the section 129 subsection 1 true and fair word is not there, what should I do? I must comply with accounting standard. I either should follow SLM or should follow WDV because I can't deviate, because true and fair word is not used. Whether the financial statements presented fairly or not, nobody bothers. They only check complied with the law. That's it. Enough. Is it fair? Doesn't matter. That is what compliance framework. What is fair presentation framework? It thinks beyond that. What it thinks, array man, in this case, sum of units method is what suggestible method, right? But accounting standard says only two methods, SLM or WDV. That is not fair method, no. That is not transparent logical method, no. No, 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 ignore it, no problem. Sir, but it resulted in deviation from accounting standard. It's okay, no problem. Why are you deviating? Not for the purpose of violating, but for the purpose of achieving fair presentation, but for the purpose of but for the purpose of achieving fair presentation. For that purpose you are deviating. If achieving fair presentation is what the objective, you can deviate. And Companies Act uses the word true and fair view. The Companies Act clearly says financial statements prepared must show true and fair view. Must show true and fair view, which indirectly means fair presentation is what given importance. Sir, what is fair presentation? Fair presentation is also a framework where financials are prepared and presented in accordance with the requirement of that framework. Like accounting standard schedule 3 only I follow. However, and it can contain disclosure beyond the requirement of such framework. I can give additional disclosures. I have that freedom. Or I may deviate from requirement of the framework. Example, I may deviate an accounting standard. Why? So as to achieve fair presentation. I want to achieve I want to show fair picture. How my asset actually depreciated, same only I want to show in the balance sheet. Not SLM, not WDV. Real way of depreciation only I want to show. That is what fair presentation. And one more point that we have to learn here. Our entire audit subject, we are doing audit of general purpose financial statements prepared using fair presentation framework. Because what is the audit? Which financial statements audit we are discussing about? Companies Act financial statements. Companies Act says what? You have to prepare financials as per accounting standard and schedule 3 and true and fair view. Since the word true and fair view is also there, the framework which we follow, what is that framework? Fair presentation framework. What is that framework? Fair presentation framework. Then so now still definition of audit is not yet over. Coming back to the definition of audit. So what is an audit? Audit is an independent examination of financial information. Now the word financial information is completed. Hamma. Independent verification of financial information, which includes financial statements, which includes general purpose financials, which are prepared using fair presentation framework, okay, of any entity. It may be any entity, doesn't matter, not necessarily a company, any entity, whether or not profit oriented, irrespective of size or legal form. When look at this sentence, when such an examination, why am I examining? When such an examination is conducted with a view to express opinion. Your objective is to give opinion. Opinion are of two types, either a positive opinion or negative opinion. Don't worry, in the upcoming parts you will understand what is positive, what is negative. Sir, modified, unmodified, no, why are you saying positive? Don't worry, I will bring to that later. So on any topic or on anything, we may have broadly two types of opinion, either positive or negative, or sometimes no opinion at all. And that is what in our auditing language we call it as disclaimer of opinion. Don't worry, all that we will gradually be discussing now. So either we can give a positive opinion or we can give a negative opinion. By the way, don't feel that I'm going faster. You can listen it in the slow mode also. Okay, this is not a regular class, this is a marathon class. Please observe. Okay, fine. So either I can give a positive opinion or negative opinion. Why am I doing audit? Because why am I verifying? Why am I conducting audit? You know what is technical meaning of audit? Audit means verification. Audit means listen. Audit means to hear, to listen, verify, to listen and respond, to verify. That's what the dictionary meaning of audit. Why am I verifying? To give an opinion, to express opinion on the financials. Why am I verifying that financial data, financial statements? To give an opinion. What opinion you can give? Either positive or negative. What even if a positive opinion? Okay, I checked the financial statements. I feel everything is right. Everything is right. So I said everything is right. That's positive opinion. If some data given is wrong, I say it is wrong. That's negative opinion. See, today companies are preparing financial statements. Reliance Industries Limited is having 7 lakh crore turnover. 7 lakh crore turnover. In the latest financial statement, 7 lakh crore. They are having profit of approximately 40,000 crore. Now shareholders took that balance sheet P&L, saw that a company is really performing well and buying the shares. Why they are confidently buying? Because behind that you are certifying them that they are true and fair. You are saying it is right. You didn't say anything. See, positive opinion means company is performing very well. Company is performing excellent. No, positive opinion means not that. What is positive opinion of auditor? Financial statements, whatever they are showing, it may be profit or it may be loss, it may be a good position or bad position, good performance or bad performance, whatever they showed, it is right. That's what positive opinion means. What? Suppose company is really having huge losses, they really showed that losses, honestly declared it, I should give positive opinion. I don't have any other option, because what is reality they showed exactly, so I must give positive opinion. Suppose company is really having losses, but they don't want to show the loss, they created fictitious sales, they decreased expenditure and showed a fake profit. It's fake, it's not reliable, it's not correct. Dear shareholders, don't believe that. Negative opinion. So if the financial statements discloses right data, actual data, real data, then we give positive opinion. Otherwise we give negative opinion. If this is our objective, if this is our audit objective, tell me, do I bother about is it profit oriented or not profit oriented? Suppose Tirumala Tirupati Devasthanam is preparing balance sheet P&L. They are also preparing balance sheet, income and expenditure account. When I am appointed as an auditor of Tirumala Tirupati Devasthanam, what is my objective there also? Whether that income and expenditure account, whether that balance sheet, are they showing right information or not? That's what my duty. Whether Tirumala Tirupati Devasthanam appointed me, which is a non-profit organization, whether a mosque appointed me or a church appointed me or a gurudwara appointed me or a Reliance Industries Limited, a commercial enterprise appointed me, my objective is same, man. My objective is same, sir. What is it? Is it right or wrong? That's it. If everything is right, I will check the background data, books of accounts, I will check transactions, I will talk to the people, I will check everything. If everything is right, I will say it is right, then it is positive opinion. What is given in the balance sheet P&L, what is there in the reality? If they are not matching, a company balance sheet P&L is showing something misleading, I will point out and say it is wrong, and that's negative opinion. So any entity, it's a profit oriented, non-profit oriented, doesn't matter its size. Is it having 10 crore profit or 100 crore profit? Is it having 10 crore turnover, 100 crore turnover, 1 lakh crore turnover, 7 lakh crore turnover? Doesn't matter. Size doesn't matter. Legal form. Is it a company? Is it a partnership firm? Is it an LLP? Is it an AOP? Is it a society? Is it a sole proprietor? Is it a part? Is it partnership firm? That is also doesn't matter for me. It doesn't matter at all. Why do I bother? Whether a partnership firm appointed me, whether a company appointed me, whether LLP appointed me, they all prepare P&L, they all prepare balance sheet. My objective is it right or wrong? That's it. Whether partnership appointed me, they prepare balance sheet P&L. Is that right or not? I will check with reality and comment. Is it right or not? Company appointed me, listed company appointed, unlisted company appointed, private limited company appointed, foreign company appointed, small company appointed, 1% company appointed, producer company appointed. Anybody who ever appointed me, my objective as an auditor is verify the financial information, give opinion, is it right or is it wrong? That's it. So irrespective of size, irrespective of legal form, whether or not profit oriented, when I am examining the financial information with a view to give an opinion thereon, and that is what an audit is. That is what an audit is. So that's about audit. So that is what is covered in this first chapter mainly. So we have completed what, indirectly, what we have completed, we have completed these terms. Okay. We have completed these terms. General purpose financial, special purpose financial, fair presentation framework, compliance framework, financial reporting framework, applicable financial reporting framework. What is audit? Now what is left over is misstatement. What is left over is misstatement definition. Misstatement definition. What is misstatement? What is a misstatement? I bet majority students would have not studied what is misstatement. Still they are reading the word misstatement many number of times. Still they are using the word misstatement word, material misstatement, misstatement term you are using many times without understanding that word. Now you will understand. Not everybody I'm saying, but majority students are like this. That's the reason I'm pointing out. Now, what is a misstatement? What is a misstatement? First of all, let's understand what is objective of our audit. What is objective of audit? SA 200, the first standard in audit, overall objectives of an independent auditor and conduct of an audit in accordance with standards on auditing. Conduct of an audit in accordance with standards on auditing, SA 200. Okay, what it says, the overall objective of auditor is to obtain reasonable assurance, whether financial statements are free from material misstatements and to report on financial statements as per relevant standards on audit. So first objective is get reasonable assurance regarding whether financials are free from material misstatements. Are they free from mistakes? Are they right? Are they containing any errors? Get a reasonable assurance, then report. It may be positive opinion or negative opinion as per standards on audit. So as per standards on audit means that is what we are going to discuss in our upcoming parts. So to obtain reasonable assurance whether financial statements are free from material misstatements and to report on the financial statements. Now you see, material misstatement word is used. In that, material means significant, big mistakes. If 1 rupee, 10 rupees mistake is there, we are not bothered. If the mistake is 1 crore, the mistake is 10 crore, we definitely consider. That is something which we can't tolerate. Okay, so misstatement means what? Definition of misstatement is also contained in SA 200 standard. What is a misstatement? What is a misstatement? You see the definition I have given in our material also, in my material also. What is a misstatement? Misstatement means, first I will read and show you, then I will break it up and then explain you what it is. Misstatement means it's a difference between amount classification, presentation, disclosure of reported financial statement item and the amount classification, presentation, disclosure that is required as per applicable financial reporting framework. If you read like this, you will never understand. Break the sentence and then read. So what is a misstatement? That same I'm writing as a diagrammatic. What is a misstatement? Misstatement is a difference between what and what? Amount, classification, presentation, disclosure of reported financial statement item and amount, classification, presentation, disclosure that is required as per applicable financial reporting framework. So in the word misstatement also, the word applicable financial reporting framework is used. What is applicable financial reporting framework? We already have seen. So a misstatement is difference between this one and this one. You know what are they saying? A misstatement is a difference between amount, classification, presentation, disclosure as per reported financial statement item and amount, classification, presentation, disclosure that is required as per applicable financial reporting framework. You know what are they saying? Misstatement can happen in 4 ways. 1, 2, 3, 4. A misstatement in financial statements. See, what is our objective? So our objective is the financial statements right or is the financial statements wrong? How financial statements can be wrong? In how many ways a financial statement can contain mistakes? In 4 ways. A mistake can be in the form of amount, or a mistake can be in the form of classification, or a misstatement, a mistake in the balance sheet, a mistake in the P&L, a mistake in the financial statement can be in the form of presentation, or mistake in financial statements can be in the form of disclosure. It can be in the form of disclosure. Now, how a mistake can happen in amount? Example, in the AS2. What is the evaluation measurement principle? What is the measurement principle of Ind AS 2? Very simple. Cost or NRV, whichever is lower. This is what the applicable financial reporting framework. A company that is covered under Schedule 3 Division 2, they must comply with Ind AS, right? Yes or no? Yeah, when they are complying with Ind AS, 2, yes or no? As per Ind AS 2, they need to value inventory at NRV, right? Cost or NRV, whichever is lower. Let us assume cost is 10 crore, NRV is 7 crore. Let's assume cost is 10 crore, NRV is 7 crore. At what price they need to value? 7 crore. 7 crore. Okay, this is the NRV. So what is required as per framework? 7 crore. The company shall value at 7 crore. But you know what the management did? They ignored NRV principle. They reported They reported. What is the financial statement item? Inventory. In financial statements, what they reported? Amount 10 crore only they reported. They ignored 7 crore, which is as per applicable framework. As per applicable framework, they need to report 7 crore, but they didn't report 7 crore. They reported 10 crore. A misstatement can happen in the amount like this. Generally, many students think that misstatement means only amount. Not just amount. Amount is one example of misstatement. Another way misstatement can happen. Another way misstatement can happen is in the form of classification. In the form of classification also a misstatement can happen. Example, always, I will show you two balance sheets. I will show you two balance sheets. Very simple. Okay. Balance sheet type 1. Balance sheet type 2. Okay. So let's assume fixed assets are 100 crore. Current assets are 150 crore. Current liabilities of 100 crore. Equity 150 crore. So this is 250 crore worth of balance sheet. Another balance sheet. Equity 150 crore. Current liability 100 crore. Current assets 70 crore. Fixed assets approximately 180 crore. So here also 250. This is actually the original position of the company. This is a original position of the company. This is original position of the company. When you look at this original position, are current assets are lesser than current liability. It's a negative working capital. Negative working capital means operating cash flows are negative. Company is about to default. Going concern is about to affect. But what company did in order to hide this? Some fixed assets, 180 crore worth of fixed assets there, no, out of which 80 crore of fixed asset they deducted and reclassified it as current asset, and they are showing current assets as 150. Fixed assets actually they are non-current assets. Company classifying them as current asset in order to show a positive working capital. Here, did they manipulate in amount of any particular item? No, they manipulated classification. Some assets, instead of classifying them as non-current, they classified intentionally as a current asset. It's a misstatement. A misstatement can happen in the form of classification also. In by way of wrong classification also, financial statements can be misrepresented. Here you see, how interpretations can change. Arey, this company by using just 100 crore fixed assets, they generated so much profit. In this case, 180 crore fixed asset, only this much profit. Asset turnover ratio, everything will interpret. Everything interpretations can change like anything just by wrongly classifying financial statement line items. Just wrongly classifying them, you can change the interpretation, you can change the view, you can change the position of the company. So a misstatement can happen in the form of classification. A misstatement can happen in the form of classification. A misstatement can happen in the form of presentation also. Sir, how in the form of presentation? Presentation means how are they presenting? We all know, debtors, current trade receivables 100 crore minus provision for bad and doubtful debts 5 crore 95. We all know this is what generally accepted presentation. Yes or no? We all know this is generally accepted presentation. Now, provision for bad debts. Suppose if it is shown on the liability side 5 crore, instead of reducing from asset, debtors 100 crore, liability side 5 crore, separately they showed. They didn't net it off. They are deviating from the presentation. What is the accepted presentation? Debtors minus provision. This is accepted presentation. But instead of reducing here, company what they did, they just classified it under liability. But as a shareholder, when I see debtors value, hey, 100 crore, I don't even recognize that provision is there. Because I will never say debtor, liabilities and assets simultaneously. I will see first assets, then I will go for liabilities. Or first I will see liabilities, then I will go for assets. I may not have that knowledge of interlinking. So shareholders may misinterpret. Company performance is very good. No provision for bad and doubtful debts. They may misinterpret. So a misstatement can be in the form of presentation also. A misstatement can be in the form of disclosure. It can be in the form of disclosure. Disclosure mistakes are two types. Either non-disclosure or inadequate disclosure. Either non-disclosure or inadequate disclosure. Companies having totally 100 related parties, only 70 related parties data they showed, 30 related parties data they did not show. It's a non-disclosure of part of the related parties, or you can say partial disclosure of related party relationships. Inadequate disclosure. Non-disclosure means disclosure itself they avoided. As per applicable financial reporting framework, accounting standard 18, related parties, company must show who are all the related parties, what transactions executed with them, what is the outstanding balance with them, all that company has to show, but they didn't show. In the actual financial statements, they reported nothing. It's a misstatement. So a misstatement in the financial statement can arise in any form. It may in the form of an amount, assertion amount, or it may be in the form of classification, or it may be in the form of presentation, or it may be in the form of disclosure. Any way a misstatement can happen. And sir, why do this mistake comes? Don't know. Even company also doesn't know. Sometimes unintentionally it happened. Error. Or intentionally management misclassified. Intentionally management took a wrong valuation amount. Intentional fraud. A misstatement can be from fraud or misstatement can be from error. Sir, is auditor responsible to identify this fraud? We'll discuss in SEA 240 in the standards part. That's it. So with this part 1, fundamentals topic is majorly done. Fundamentals topic part 1 is completed. See, these are the basic terms which you need to understand. Basic terms which you need to understand. Please watch this entire video. Okay, those of you, at least those of you who ever watched this entire video, please forward it to your friends. This is very important to understand the audit subject. From next part, I am going to start audit reporting. I am going to start audit report where I will be discussing 10 to 12 standards. That next I will be discussing standards on audit. That next I will be discussing professional ethics. Sir, what about company audit? Amendments were there? Don't worry, we'll discuss later. Company audit, bank audit, NBFC, there are very few amendments. All amendments related thing we will discuss at last. Okay, along with that revision. In the marathon itself, we will also cover amendments. That's it. So this is about fundamentals topic. The first beginning session in order to start audit revision. Actually, you need to understand all this before you understand the actual subject. That's it. Carry on. Okay, part 2. Wait for part 2 of the video. So this is part 2 of audit marathon. In this part 2, we are going to start the topic of audit report. We are now going to start the topic of audit report. See, what I notice in many students, especially like those who have attended classes with me, that's okay. For others, what I notice is they study entire audit subject, but they don't know how to prepare audit report. I'm very confident to say that. They don't know how to prepare audit report. They don't know what are the contents of audit report. After you being qualified as a chartered accountant, if you doesn't know how to prepare audit report and how to interpret the audit report, obviously there is no use of your qualification. Maybe you are good at other subjects, but ultimately in our real life, what is that subject which is mostly tested? Auditing concepts. So in this particular, from part 2 onwards, until we complete this audit reporting sessions, I'm telling you, you are going to learn really a beautiful concepts. And here we are going to discuss about 12 standards: 700, 701, 705, 706, 710, 720, 299, 600, 610, 620, 570, 260. 12 standards we are going to discuss as part of audit report segment. We are going to revise all these 12. I'm telling you, these all standards, these 12 standards will have a direct effect on reporting. Most of these standards will have a direct effect, or maybe 1 or 2 standards have indirect effect on audit reporting. And this audit report, I divide it into 2 segments. Segment 1, where we are discussing about reporting standards. If you look at the ICA material, if you look at the pronouncement, only 700 series is considered as reporting standards. Rest all other standards. But for me, all these 12 standards will have an influence on reporting, will help you to understand the reporting concepts much better. In addition to that, we are also going to discuss about segment 2. Segment 2 is what? 143.1, 311. And for your information, we are also going to see numerous audit reports. We are going to check Air India audit report for understanding SAF 570 and qualified opinion. Alphabet, this is actually United States audit report. This is ICMA Institute audit report, annual report. Inside that audit report is there for understanding how they gave qualified opinion. ILFS audit report where they have used material uncertainty paragraph SA 570, Muthoot Finance audit report, Reliance audit report, SBI audit report for us to make us understand branch audit, subsidiary company audit, that kind of relationship. TDC, this is a Europe company. This is a company which is registered in Europe, Denmark. So TDC Group 2019 annual report. Inside that we are going to see audit report. So we are going to cover audit reports of Indian few companies, US company, Europe company. Just to understand that audit is universally the same subject, the terminology of audit report is exactly same. Fine. Why let's start into the subject. So audit report broadly divided into two segments. Okay. Now you take this, you take the audit report. What are the contents of audit report? What are the contents? Along with this, I will also show you simultaneously pronouncement illustrative formats. Pronouncement illustrative formats. Be focused. By the way, before you proceed with this particular part 2, I hope you have finished watching part 1. I hope you have finished watching part 1. Part 1, I have covered fundamental terms. Don't think we know fundamentals. Don't think. Watch part 1. You will only understand whether you know fundamental terms in audit subject or not. Listening to the term is different. Understanding the term is different. So watch part 1 fundamentals video. Then only continue with this part 2. Please, otherwise don't continue. You may understand the things, but you don't understand comprehensively the subject. Understanding subject is most important. Now, what are the contents of the audit report? What are the contents of the audit report? When we are preparing an audit report, how we prepare the audit report? What components it will have? What contents it will have? It will broadly have, I have divided into 16 parts. Audit report broadly will have 16 parts totally. What are the 16 parts consist of? First part is title. Second part is title, first one. Second part is addressee. Third part is opinion. Fourth part is basis for opinion. And fifth part material uncertainty. Sixth part key audit matter. Seventh part emphasis of matter. Eighth part other matter paragraph. Ninth one SA 720 other information. Other matter paragraph is 706. Other information paragraph is 720. Remember, you see here all these 5 parts I have given in bold letters. These will come into picture only if the circumstances given in that standard present. Okay, only if you are using that paragraph only it will come. Otherwise these paragraphs may not be there in the real life audit report. In a real life audit report, these 5 paragraphs may be there or may not be there. Okay, then we will talk about responsibilities of management. Then we talk about auditors' responsibilities for audit of financial statement section. Then we are talking about another lengthiest paragraph, report on other legal and regulatory requirements. This is what I call it as segment 2 in audit reporting. You see the material which I'm using here. Part 1. Reporting standards I'm going to cover. What are the reporting standards? 700, 701, 705, 706, 710, 720, 299, 600, 610, 620, 570, 260. These all are reporting standards. And part 2, reporting requirements under 143. Example, CARO 2020, but for December attempt 2016 only applicable. For December attempt 2016 is applicable. So part 1, reporting standards. That is what I call it as segment 1 in audit reporting chapter. Segment 2, reporting on legal and other regulatory requirements I'm going to discuss. And now coming back to the contents. What is the first and foremost content in the audit report? Title. Title. What do you mean by title? What do you mean by title? Just 1 minute. So the first and foremost thing in audit report is title. And by the way, even in the part 1 video, I clearly mentioned we are going to learn this subject. We are going to learn this audit subject from the context of stat audit or independent audit of general purpose financial statements prepared by company, form of organization. So from this context only we are discussing. So naturally, audit report, all the standards I am covering right now, 12 standards we are going to cover. Okay, all these standards are from which context? Independent audit of general purpose financial statements prepared by a company under section 129 subsection 1 of the Companies Act. So when you are giving an audit report, what title you must use? Remember, the title must be very, very, very clear. the title of the audit report must be very clear. What is the title? We generally put very clearly independent auditor's report. The title that we must use is independent audit report. Even in United States also they use a title very clearly, in the report of independent public accounting firm. Even in Europe, independent auditors report, same title Europe also uses, like how we use India. Okay, in India, how we refer audit report title, the same title is being used in Europe, because in Europe they follow international standards on auditing, which is exactly ditto to our standards on auditing. Whereas in United States, they do follow standards issued by PCAOB framework. Okay, that's it. So that's not required other countries. I'm just giving you for your information. Now, so once title is attached, once you put up the title, now to whom you are addressing the audit report, addressee, the second and second, so title is completed. Now addressee, so what is the addressee? Whom you will address the audit report? In case of general purpose financial statements, we address to members. We address to members of the company. Remember, this format of audit report is same whether you're doing audit of insurance company, whether you're doing audit of banking company, electricity company, or any other company registered under Companies Act. For all types of companies, individuals, sole proprietors, partnership firms, for anybody, whoever we are giving audit report, same format we will use. This format was applicable from 1/4/2017-18 financial year onwards, which is commercially made applicable from 18-19 financial year onwards. And now the same format of audit report we have to follow for everyone, whomever you are doing audit. If you are giving audit report, an independent audit report, external audit report, stat audit report, you have to do this format unless the law requires a special format. Suppose you take income tax, there is a format given by income tax department, 3CA, 3CD, 3CB, 3CD format is given. Form 10B is given for trust. You take GST, there is a separate format which is given, GSTR 9. So if the law talks about a specific report format to be given, then that specific format. Otherwise, by default, we have to follow SA 700 format. SA 700 format. SA 700, 701, 705, 706 together talks about the format of audit report. I also incorporated together all of that comprehensive report. This audit report format, what I'm giving here is a comprehensive report. This is a comprehensive audit report format. Some of this content, some of these sections, see, each one is one section. Title is one section, address is one section, opinion is one section. Likewise, totally how many sections of audit report we are going to discuss? 16 sections, 16 parts, 16 components we are going to discuss. In a real life audit report you take for any company, all these 16 parts may or may not come. But I told you, these 5, 5th part, 6th section, 7, 8, 9, these 5 sections may come or may not come, or any 1 or 2 of these sections only may come or may not come, but rest all other sections, out of 16, 5 you take off, 11 sections are standard in any audit report you take. Any audit report you take, these 11 sections are common. Fine. So title, what is the title we use? Independent audit report. Then addressee, in case of general purpose financials, to the members. In case of special purpose financials, generally special purpose financials are prepared at the request of the board of directors for some purpose. So we address to board of directors. Okay, so general purpose financials, we only need to understand from which context. General purpose financials. Suppose you take State Bank of India, their audit report contains to President of India. Government companies to President of India, they may use the word President of India. Okay, or to members. Members is most simple word, because in government company, who is the member? President is the member. Central government owned company, state government owned company, who is the main member? Governor is the member. So whether you use in a government company President of India, or simply you put members of the company, both meanings will be same. It will reflect the same person. Now, so that's about the addressee. Now the third most important paragraph is opinion paragraph. If you recollect part 1 revision, now the most important paragraph is opinion paragraph. If you recollect part 1, revision, part 1, fundamental terms, there I discussed definition of audit. In that, what is the objective of audit? With a view to express opinion thereon. And I told you there are 2 types of opinion: positive opinion, negative opinion. So what is positive opinion? What is negative opinion? The SAS 700, instead of using the word positive or negative, they uses the word unmodified opinion, modified opinion. They uses the word unmodified opinion, modified opinion. What do you mean by unmodified opinion? What do you mean by modified opinion? Suppose management prepared financial statements. They prepared using some framework. Okay, they prepared financial statements. Say, let us assume after 31st March. They prepared financial statement, they closed books of accounts and prepared financial statements as per Schedule 3, as per accounting standards, let us assume. And I am the auditor. I need to check whether these financial statements, are they free from material misstatements? Are they containing any mistakes? I need to check. I checked it. I verified background books of accounts. I verified internal controls. I verified accounting system. I verified accounting processes. I verified bookkeeping controls. Okay, I verified some various other internal controls. I did risk assessment. I understand the business. I understand the risk management process. Everything I understood. And then I concluded, yes, the balance sheet, profit and loss account, whatever the amount they are showing, whatever the classification they did, whatever the presentation they did, whatever the disclosure they did, everything do not require any modification. Whatever they are giving as it is can be issued to the public. They don't require any modification. Now tell me, when they don't require modification, do I tell them please modify? No, unmodify. I can simply tell them I will also give an opinion without any modification to them, without any request for modification to them. And that's how the word unmodified opinion came. Suppose, what is modified opinion? Suppose company prepared balance sheet, P&L, cash flow notes and statement of changes in equity. Amounts, they require some modification. Or classification wrongly given, not as per the Schedule 3, not as per the accounting standard classification. They gave some other classification which is not right. They need to modify the classification. They need to modify the presentation. They need to modify the disclosure, because what they have, what amount they have shown, what classification they did, what presentation they showed, what disclosure they mentioned, they are not as per applicable framework. They are misleading. They are misstated. They require modification. I requested management, dear management, this amount is not correct. This classification is not correct. This presentation is not correct. Kindly, please rectify. I requested top management, please rectify. They didn't rectify. They didn't modify the financial statements. They want to issue the financial statements as it is to the public without any modification, which requires modification. So what I will do, you don't modify, don't worry, I will modify my opinion. I will not agree with them. I will modify my opinion. And that's how the word modified opinion came. And that's how the word modified opinion came. And you know, the modified opinion is of three kinds as per the standard: qualified opinion, adverse opinion, disclaimer of opinion. There are three types of modified opinions: qualified, adverse, disclaimer. Modified opinion discussion is given under SA 705. The word for the first time modified opinion is used in SA 700. What is SA 700? Standard: forming an opinion, reporting on financials. First you form the opinion, then report on the financials. How do you report? Format of audit report is given, and that format only we are now discussing. We have not yet started much of the format. We are still only in the third section of the audit report format. Now what SA 700 says? It says auditor can give either two types of opinion: unmodified opinion or a modified opinion. Now tell me, first of all, before I proceed further, if I have to give an opinion, first I must have a conclusion. What do you mean by conclusion? See, you are asking me, you are a shareholder, you are asking me, dear Mr. Chartered Accountant, are the balance sheet P&L, they are showing some amounts, right? They were classified in some way, right? They were presented in a particular format, right? They were giving some additional disclosures, right? Are they as per applicable framework? Are they free from material misstatements? You are asking me. Are they right amounts? You are asking me. Without verifying them sufficiently, without verifying the appropriate records, how can I give my opinion? I cannot. So first I want to check it. Is it right or not? I want to check it. Only then I can come outside and tell people, yes, it is right. Okay, without checking them, without evaluating background data, without evaluating background books of accounts, without getting sufficient appropriate evidence, without getting my reasonable assurance, without me getting confidence, how can I tell you is it right or is it wrong? So first I want a conclusion. I want some reasonable assurance. I want sufficient and appropriate audit evidence. Only if I convince, only if I get persuasive evidence, only if I get sufficient appropriate audit evidence, I can conclude. Only whatever I conclude, that only I can give it as an opinion, that only I can report. Now to get this conclusion, what you require? You require sufficient and appropriate audit evidence. Sir, what do you mean by sufficient appropriate? Suppose balance sheet amount to fixed asset shows gross block value 100 crore, double accumulated depreciation 50, net block value is 50 crore. Now they are asking me, sir, is this balance sheet true and fair? If the balance sheet, when balance sheet will be true and fair? If the fixed assets are true and fair, current assets are true and fair, liabilities are true and fair, equity is true and fair, then I can say a balance sheet as a whole is true and fair. So first I need to get evidence for fixed assets. What evidence I need to get? Management showed 100 crore gross block. Then they showed depreciation 50. Then they showed 50 crore net block value. Well, is this net block value correct? Only if the net block value correct, only total balance sheet will be correct. Net block value correct or not? How do I know? First I need to check gross block value. Is gross block value correct or not? I need to check. Is accumulated depreciation calculated correct or not? I need to check. Is it true and fair or not? I need to check. Sir, what is the difference between true and fair? What is the difference between true and fair? Many of us listen to this term true and fair many number of times, but without understanding what exactly the difference between true and fair. Example, sir, suppose a customer, I sold goods to a customer for 10 crore. I sold goods to a customer for 10 crore on credit sale. Credit sale I made. Okay, some 2-3 customers I made. Total credit sale is 10 crore. Now my balance sheet trade receivable is actually 10 crore. Out of which one customer recently became insolvent. But he is promising me, sir, your money is, don't worry, I will give you, believe me. But for me, I have a doubt. I don't know whether he'll pay. From him, I need to receive approximately 2 crore rupee. I don't know. Okay, but in my balance sheet, to the shareholders, what I'm showing, dear shareholders, I'm having totally 10 crore receivable. It's true. But fairly speaking, genuinely speaking, right now, confidently tell me how much you can receive logically. 8 crores only. Why? 2 crores is doubtful. So how much is fair value of the trade receivable? 8 crore only. The auditor has to check truth as well as fairness, genuinity. Both auditor has to check. So that's the difference between true and fairness. So when the depreciation is 50 crore depreciation they charge. I don't know is it true or not, but I need to see is it fair. Organization asset is used by organization in so and so approach, so and so method, in so and so process. So asset might get depreciated on a straight line basis, but if organization is using WDV basis, it's inappropriate accounting policy. The asset useful life is only 10 years, but organization chosen 15 years as life. Unreasonable accounting estimate. So when I'm checking fixed asset, I need to check invoices, whether asset original cost is correct. I need to check what items are capitalized. Is it as per accounting standard? I need to check. Then I need to check depreciation method used. Is it in line with accounting standard? Depreciation useful life they used. Is it genuine? Is it reasonable? It's a judgmental issue. I need to check residual value. Is it correct or not? After all checking all that, and I will physically also want to see 100 crore you are saying gross block of fixed asset. Show me where the 100 crores assets are. Okay, go to the factory, go to the office building, we will see. Show me on a sample few assets. Okay, assets are there, invoice is there. I can convince, yes, fixed asset gross block value 100 crore is correct, depreciation is correct, then net book value is correct. Now here I am gathering evidences. No, how much I am gathering? I am gathering whatever is sufficient for me. I am gathering that many evidences. I am gathering that many evidences where I will convince, where I will satisfy. So sufficient appropriate evidence. So sufficient appropriate evidence is the important thing for reaching conclusion. Based on this conclusion, you will give opinion. So first get an evidence, then conclude, then give an opinion. These are the 3 steps. Now you see. By the way, once you get the evidence, once you check the background data, sufficient and appropriate evidence, once you get this background data, you can have 2 conclusions. Array, there is a mistake, a material mistake exists. Or you can conclude no material mistake. Whatever they showed, whatever in the reality, whatever in the background, everything is matching. So balance sheet P&L is matching with reality. So there is no material misstatement. Anything you can conclude if you have an evidence. Sometimes we will not be getting evidence. We will not be getting background data. Some fixed assets they showed or inventory they showed. Some 10 crore inventory is there. But this entire inventory is in go down. Okay. But I am unable to visit the go down. Management is saying in the go down inventory is there. But I want to physically go and check, is it really there? but I am unable to go down because there was a problem. The go down is in the forest area, and right now because of the weather conditions, because of so and so incidents happened, I am in a position, management is in a position, they are not letting me to visit the go down. Now they are saying, sir, 10 crore is there, sir, promise, sir, take our written representation, SA 580 declaration management gave. But management will say entire balance sheet P&L is true and fair only. That does it mean I can proceed with management representation? No. What should I do? I need to go and check for sure. Management is saying, sorry sir, you can't go. But I want to go and check. How do I know really 10 crore inventory is there? Sir, nothing sir. We can't do that. So I did not get evidence here. I did not give evidence here. I did not get any evidence here. But still they're asking me, sir, give your opinion, sir. How can I give opinion, sir? Without getting evidence, how can I give opinion? So here, sometimes when I did not get evidence also, my opinion conflict will come. There will be a conflict with my opinion. And tell me what are the types of opinions we have? We are having broadly two types of opinion, unmodified opinion and modified opinion. The standard SA 700 says what, unmodified opinion can be given provided if auditor concluded based on sufficient and appropriate audit evidence that financial statements are free from material misstatements and financial statements are prepared as per applicable financial reporting framework. Financial statements are prepared as per framework concluded based on evidence that they are free from material mistakes. You have got evidence, you concluded financials are completely right, no error, no fraud, no material misstatement, everything is right, amount classification, presentation, disclosure, everything is right, you concluded. And you also concluded based on the evidence you got, financials are prepared as per applicable financial reporting framework. Then you give which opinion? Unmodified opinion, which is also called as unqualified opinion, which is also called as clean opinion, when I will give unmodified, if I conclude two things: concluded that based on evidence they are free from material mistakes, okay, and they are prepared as per applicable framework. What if I did not get the evidence, or what if I got the evidence but financial statements are containing mistakes, they are not free from material misstatements? I don't have evidence, that's one situation. Okay, another one, I have proof and I say I have a proof that it is wrong. I have a proof and it is wrong, and I don't have a proof. In both these cases, we will not give unmodified opinion. We will give what? Modified. That's why you see modified opinion will have 2 points. Modified opinion definition have 2 points. What is the first point? If auditor concludes based on sufficient and appropriate audit evidence that financial statements are not free from material misstatements. Dear Mr. Auditor, tell me, is the balance sheet P&L, are they free from mistakes? No. When they're not free from mistakes, what you do? I request management to make it rectify. If they don't rectify, I will modify my opinion. I will not give unqualified opinion. I will not give clean opinion. I will not give unmodified opinion. I will straightway modify my opinion. I will modify my opinion. Sir, how do you modify? Do you say everything is right except one or two items, or do you give completely don't believe? Which one? Don't worry, I'll come to that later, next part. When I conclude based on sufficient appropriate evidence, when the financials are not free from material mistakes, I will give modified opinion, or I will also give modified opinion in another situation. Okay, auditor is unable to obtain sufficient appropriate evidence to conclude financial statements are free from material misstatements. Dear Mr. Auditor, will you conclude financials are free from material mistakes? To conclude that I am unable to obtain evidence, I did not get the evidence. To conclude that, even I want to conclude they are free from mistakes, even I want to give unmodified opinion, but what? I don't have evidence, I don't have a conclusion, I am unable to conclude because of not able to obtain sufficient appropriate evidence. If the auditor is unable to obtain sufficient appropriate evidence to conclude financials are free from material misstatements, then also auditor will give a modified opinion. Two situations auditor will give a modified opinion. Now This modified opinion is more detailedly expressed in SA 705. Remember, still we are discussing opinion section of the audit report only. We have not yet crossed that stage. We are only discussing opinion section of the auditor's report. We are only discussing opinion section of the auditor's report. Now SA 705, what it says. If you want to give modified opinion, follow SA 705 standard. What SA 705 speaks about? Modifications to the opinion. Modifications to the opinion in the independent auditor's report. In the independent audit report, you are giving modification to the opinion. You are modifying your opinion. What rules and regulations, what precautions, what structure you need to follow. SA 705 talks about. What SA 705 says, dear Mr. Auditor, you can give modified opinion in 3 ways. You can give modified opinion in any of the following 3 ways. In any of the following 3 ways, you can either give a qualified opinion, you can give an adverse opinion, you can give a disclaimer of opinion. You can give a qualified opinion, adverse opinion, or disclaimer of opinion. Example, suppose right now, let us assume the balance sheet amounts are in crores. Right now the balance sheet amounts are in crore. Okay, fixed asset 150 crore, current asset like inside that trade receivable 10 crore. Okay, stock 20 crore, cash and cash equivalents some 50, some 20 crore, to 20 20 10 50, total 200 crore balance sheet. Okay, liabilities, outside liabilities 100 crore, equity and reserves and surplus 100 crore, total 200 crore here and 200 crore here. Now in this stock, sir, first of all, did I verify fixed assets? Yes, I verified. Entire value is correct. Trade receivable, entire value is correct. Cash and cash equivalents, entire value is correct. Outstanding liabilities, entire value is correct. Reserves and surplus, stock related, one adjustment is there. Inside this stock is, by the way, how much? 20 crore. Inside that there is one small item of stock, okay, which is 20,000 rupees. Which is 20,000 rupees. Its actual NRV is 15,000 rupees only, but management valued at cost. So there is a misstatement in amount. How much mistake happened? 5,000 rupees overstatement. The inventory value has shown 5,000 rupees overstatement in my sample. Now tell me, 5,000 rupees in 20 crore asset, 5,000 rupees in 200 crore total balance sheet item. Is it significant? Is it material? If you take this mistake and go to the top management, sir, 5,000 rupees over, sir, it's 5,000, sir. Sir, our company size is 200 crores, sir. Imagine what is the amount of 5,000 in 200 crores. 200 crores, 9 zeros. 5,000 is 3 zeros. 0.00001%. How can you point out this, sir? Don't you have common sense? This is how the management reply. So 5,000 is immaterial. It's immaterial mistake. It's not a material mistake. Dear Mr. Auditor, management asked you, sir, have you found material mistake? Have you found material mistake? No, sir, sorry. Only small, negligible, 10 rupees, 20 rupees, 1,000 rupees, 5,000 rupees, that mistakes only. Sir, please ignore it. Okay, sir, I understood. I will give in this case unqualified opinion because there is no material misstatement involved. Mistakes are there. Collectively, undetected, uncollected, undetected, undetected, uncorrected. Altogether are immaterial. They're not material. Okay, whatever I found, whatever I detected is immaterial. Whatever I could not detect, okay, I estimate, I feel there is no that much of mistakes also. Altogether, I feel they're immaterial. So I will give unmodified opinion because financial statements are free from material misstatements. Second example. Okay, second example, same example you take, inventory. Okay, total balance sheet 200 crore, total balance sheet 200 crore, inventory 20 crore value is there. In this 20 crore inventory value, there is an inventory whose value is 50 lakhs. Whose value is 50 lakh, one item of inventory. Okay, that NRV is 10 lakhs only. Cost is 50 lakhs, but NRV is 10 lakh only. But management ignored NRV. They valued at cost only. They valued at cost only. They valued at cost. I have a proof. I brought expert valuation report that inventory value is 10 lakhs only. I have a proof. Management also agreed. Yes, sir. Yes, sir. It is really 10 lakhs only. Then why you did value at 50 lakhs? Modify. Modify. So inventory value is actually 19.6 lakh only. 19.6 crore only. But management valued at 20 crore. 40 lakhs overstatement. I requested top management, please modify financials. They said no. sorry sir, let us keep 20 crore, we will not modify. Okay, you don't want to modify, there is a mistake, I will modify my opinion. So fixed assets, no, they are correct, remaining current assets are correct, equity is correct, liabilities is correct, but inventory alone 40 lakhs mistake is there. Out of 200 crore, 40 lakhs, no doubt it's a material mistake. I want to give this opinion. Hey, dear shareholder, don't believe balance sheet. This company is a cheating company. Don't believe at all. Can I say this? If I give this kind of harsh opinion, what the director, sir? 40 lakhs only mistake in 200 crore. 199 crore, 60 lakhs is correct. You also agreed. 40 lakhs only mistake. Point out that 40 lakhs only. Why do you point out entire 200 crore? You found out only 40 lakhs mistake rate. Why do you point out entire 200 crore? Major thing, 99% it is right. No, that 1% only which is wrong. Just because of that 1%, why do you blame entire 100% wrong? Okay, fine, cool, management, don't worry. I have an option. I will give positive opinion only. I will give positive opinion. As you said, exception I will put. Exception I will put that to that positive opinion. I will give qualification. I will talk negatively only about 40 lakhs. This is called qualified opinion. This is called qualified opinion. Qualified means conditional positive, conditional opinion, qualified, subject to qualification, subject to remark, subject to reservation, subject to observation. Qualified opinion means conditional opinion. I'm giving positive. Okay, management. Entire financials, dear shareholders, the entire financial statements, in our opinion, to the best of our information and according to the explanation given to us, except for the effect of, okay, except for the effect of matter described in basis for qualified opinion section of our report, the aforesaid financials are true and fair. The financial statements are true and fair, except that. If I include an exception clause, exclusion clause, what is it called as? Qualified opinion. Don't worry. How qualified opinion wordings, how unqualified opinion audit report wordings, how disclaimer of opinion audit report wordings, how audit report will affect because of different opinions. All that I'm going to show you practical illustrations. Don't worry at all. Slowly, one by one, inject the concept one by one, step by step. So that's qualified opinion. Next, suppose fixed assets, okay, 100 crore, current assets 100 crore, outside liabilities 100 crore, equity 100 crore, total balance sheet is 200, total balance sheet is 200 crore. Okay, total balance sheet is 200 crore. In fixed asset, 10 crore material misstatement is an overstatement. In current assets, 7 crore material misstatement, not just 7 crore, 17 crore material misstatement is there. In outside liabilities, 25 crore, understatement is there, equity, so much amount is affected, so much of amount is affected. As a whole, you take the balance sheet, so many mistakes are there. Now here I want to say, sir, profit and loss account balance sheet was true and fair, sir. They're completely right. Except fixed asset 10 crore mistake, except cash and bank balances 5 crore mistake, except trade receivable 10 crore mistake, except inventory 10 crore mistake, except liability. Arey man, how many exceptions you use? How many exceptions you use? As a whole, is it right? No, it is not right as a whole. It's not one or two mistakes. It's significantly pervasive. It is affecting entire company position itself is misleading. Entire company balance sheet is misleading. It's not one assertion which is affected. Multiple assertions are affected. It's a pervasive level. When it is pervasive level, when mistakes are spread across, multiple assertions are affected materially, significantly. How can you say positive? How many exceptions you will add, man? That too, in each exception, you're not mentioning small amount, you're mentioning big amounts. In each exception, how can you give like that? So this is not reliable. Tell me one word, is this reliable or not? No, not reliable. It's not reliable. So say that, give an adverse opinion. Adverse means negative. Give a negative opinion. Say that financial statements are not true and fair. Financial statements are not true and fair. And this is when we give adverse opinion. When the mistakes are material and also pervasive. Sometimes no. I may not have mistakes everywhere. I may not have mistakes in every item. One item only I can have. Fixed asset 90 crore mistake. Out of 100 crore, 90 crore mistake is there. Only one mistake. But the amount you see, magnitude you see, it is changing the company entire overall financial position. It is completely misleading the financial position. Sometimes one only, but it is substantial. Multiple items affected. If they are not only material, overall misleading, Even that one item itself is affected, but it is also misleading as a whole. Only one item affected, but misleading as a whole. Now then also you will give adverse opinion. By the way, don't expect me to explain very detailed. This is a marathon session, not a regular session. Now, so that is adverse opinion. Then another balance sheet I will take. Another example I will take. Another example I will take. Fixed asset 100 crore, current asset 100 crore, liabilities 100 crore, equity 100 crore. In current assets, one inventory is there. Inventory total value is 20 crore. Out of this 20 crore inventory, 1 crore worth of inventory is with a third party. 1 crore worth of inventory is with the third party. Inventory held in the custody of third party. I want to apply SA 501 audit procedure. I want to apply SA 501 audit procedure. I want to talk to the third party. I want to physically inspect. I want to physically visit the third party premises. Physically want to check, is the inventory really there belonging to our company? But third party did not permit me. Our organization also did not permit me. Sorry sir, you can't go. Our business relationship will affect if you go and check. Sorry, we will trust him. He will trust us. You also trust us. That's it. 1 crore related worth of inventory that is lying with third party. Please don't verify. I am having a doubt, management. I am having a doubt. It's 1 crore. It's important material amount only. I know for 19 crores you gave evidence. For remaining current assets you gave evidence. For fixed assets you provided me evidence. It is true. Liabilities you provided me evidence. It is true. But this 1 crore I want to go and check really with the third party. Management denied. Ultimately, I did not get evidence which I want. I did not get evidence which I want with respect to 1 crore. Now, since I did not get evidence, can I say, sorry management, I'm unable to give any opinion. Sorry, I'll come out of the audit. I can't give opinion. Are Mr. Auditor, out of 200 crore, 1 crore only, no? Do one thing, give qualified opinion. Give qualified opinion. Only that one point you didn't get evidence. You got evidence for rest of the things, no? Yes, I got evidence. Then talk about them, no? 99% you know. Only 1% you don't know. Then what? Okay, what should I do now? You give a qualified opinion, man. Give a qualified opinion. Mention that financial statements as a whole are true and fair, except 1 crore worth of inventory which is lying with a third party where you did not get evidence. Mention that point. You did not get evidence, you mention. We will answer to shareholders. So here also we will give which opinion? Qualified opinion. When we did not get evidence, for material item. Remember here, can I say 1 crore is materially misstated? How can you say? See, suppose no, I gave qualified opinion. The financial statements are true and fair, except inventory worth of 1 crore is overstated. Management came and said, how it is overstated, sir? Do you know it is overstated? Show me proof. Sorry, I don't have proof. But you didn't give me any proof, right? You didn't give me any proof. Sir, I didn't give any proof. I didn't give any information. Does it mean you can say any comment you want? Can you say overstatement? Can you say understatement? When you can say overstatement, understatement, or when will you say that is a material misstatement? When do you say that? When you have a proof. You don't have proof, Mr. Auditor. You don't have a proof. Mention that you don't have a proof. That's it. It is material item. You did not get a proof. Mention that. How can you say it is materially misstated without having a proof? You only don't know is it right or wrong. How can you say it's a materially misstated? So, when we did not get evidence for a material item, we did not get evidence for a material item, but not pervasive. It's not pervasive. It's not changing the entire financial position. It's not affecting the entire balance sheet position and P&L performance. It's not affecting entirely. It's material, but not pervasive. You did not get evidence. Okay, give qualified opinion, which means, understand, until now we discussed 2 examples on qualified opinion. In one example, there is a material misstatement in inventory valuation. There is a material misstatement in inventory valuation. You have a proof. You have a proof that mistake is material, but not as a whole. Financials. Not as a whole balance sheet misleading. Only that inventory is misstated. Okay, it's material. So when you have a proof, and there is a material misstatement, you give qualified opinion. Another situation where you will give qualified opinion, you don't have a proof. You don't have a proof. And it is material item for which you did not get any proof. So you can't take risk. So you want to explain to the shareholders, for that material item, I did not get evidence. You want to explain that to the shareholder. So here also you give qualified opinion. So qualified opinion comes in 2 situations. And that's why you see qualified opinion definition. It will have 2 parts. Qualified opinion definition will have 2 parts. One, evidence is there, mistake is found. Another one, evidence is not there, We don't know whether it's a mistake or not, but it is important. It's big item. In those two situations, you give qualified opinion. Another example, another example, disclaimer of opinion. Many students, what I find them is they don't know where to give disclaimer opinion, where to give adverse opinion. Exactly, they don't know. When I out of 10, 8 students, when I ask this question, they say wrong answer. Disclaimer, sir. No, sir, all adverse. No, sir, sir, I don't know, sir. Have clarity, have clarity. Disclaimer of opinion, disclaimer of opinion. I am denying to give opinion. I am not giving opinion. No, not giving opinion, not expressing an opinion. No opinion. What is disclaimer of opinion? No opinion. SCA 705 recognizes, SCA 705 recognizes no opinion is also an opinion. Dear Mr. Auditor, you went to audit, right? Have you conducted audit? No, sir, I couldn't conduct the audit. Why, sir? Management did not talk to me at all. They're not even letting me to ask any question. They're dominating me too much. And I want to resign. Okay, do one thing. You can resign. No. But my law and regulation do not accept, sir. It expressly says I can't resign. It says I have to honor the contract. It says I have to perform the contract. I don't have a right to resign. Okay, do one thing. You want to do the audit, but you are unable to do the audit. Since when you are unable to do the audit, you have an option to resignation, option to resign. But the law is not permitting you to resign. At any cost, you have to give an opinion. There will be a situation where at any cost you have to give an opinion, where you don't have an opinion because you didn't do an audit, because you didn't get information, because you didn't get sufficient appropriate evidence, because you didn't get permission or cooperation from the management. There is a limitation on your scope. There is a limitation on your work. Ultimately, you are unable to conclude is it right or is it wrong. You can't do anything. You can't conclude anything. Do one thing. We have given another weapon to you. Express your opinion, express your feeling, express your conclusion that you don't have opinion, right? Express that by naming it as a disclaimer of opinion. Balance sheet, fixed asset, current asset, liability, equity, everything is there. Amounts are there, amounts are there. But problem is all these amounts you don't know are they right or are they wrong. Why you don't know? You want to check the background books of accounts. The books of accounts were seized, they were destroyed. Books of accounts are not there. I'm talking to the management. They were busy in their works. They are not at all responding me. They are not cooperating to me. I am talking to an accountant. I'm requesting accountant to give some data. He is not giving me at all. Ultimately, I waited for 15-20 days. Finally, one day suddenly they're coming and asking me audit report. Sir, where is audit report? Arey man, I didn't do audit at all. Sir, why you didn't do audit? The management blaming me in reverse. So now what should I do? I will give, okay sir, don't worry, I'll give audit report. You want audit report? I'll give audit report. In that audit report, I will mention that I don't have any opinion. And that is called disclaimer of opinion. Why? Here, sir, it's not 1 crore item which I didn't get evidence, sir. It's not just for 1 crore where I didn't get evidence. It's not significantly around 50 crore worth of asset I don't have evidence. 50 crore worth of liability I don't have evidence. I don't have evidence at all. But it's okay, no? Only 50-50 crore. No. Say it is true and fair. What's problem for you? What if it is not true and fair? What if it is not true and fair? Okay, I will take up the risk and I will say everything is true and fair. But what if it goes wrong? Who will guarantee me? Without evidence, how can I say they are correct? Okay, I will say they are correct. But what if they go wrong? What if the possibility of undetected misstatements could be material and pervasive? So I will not take risk. I will not give opinion. I will give disclaimer of opinion. So that is what disclaimer of opinion is about. That is what disclaimer of opinion is about. And now shall we see when we give an unqualified opinion how the wordings will come, when we give a qualified opinion how the wordings will come, when we give adverse opinion how the wordings will come, when we give disclaimer of opinion how the wordings will come. We'll see that. We'll see that. So in ICA material, SCA 700 gives you 5 illustrations. SCA 705 also gives you 5 illustrations. Pronouncement book. Okay, pronouncement book. You see how beautifully the wordings are crafted. Just a minute. Yeah, 700. In this illustration, sir, you will have an appendix here. So this is one illustration one. You see here, illustration one. Illustration one. Audit report. What is this illustration one talking about? It is talking about audit report on financial statements of listed entity prepared in accordance with fair presentation framework. Most of the listed companies, every company which is incorporated in Companies Act, they have to prepare financials as per 129, which talks about true and fair view. So obviously which framework it is? Fair presentation framework. So in a fair presentation, what is the auditor conclusion? The auditor concluded an unmodified opinion is appropriate based on the evidence he obtained. Whatever the evidence he got, no, based on that he decided to give unmodified opinion. But one more thing, before I proceed further, let me give you a diagrammatic representation, tabular representation of in which scenario which opinion we should give, in which scenario. So totally sufficient and appropriate audit evidence available. So you will either find two situations: evidence is there, you have a conclusion, or sufficient and appropriate audit evidence not available. Sufficient and appropriate audit evidence not available. First we will discuss about where evidence is available. First we will discuss about a situation where evidence is available. Evidence is available. Evidence is available. Now, since evidence is there, you can assess, you can quantify, you can evaluate. Is that balance sheet amount? Is that classification? Is that presentation? Is that disclosure? Is it right or wrong? Is it right or wrong? Is it properly stated or materially misstated? I mean, is it misstated? You can say it. So first I will ask you, is there a material misstatement? Is there a material misstatement? Situation one, you said no material mistake. I got evidence. NRV 10 crore. Cost is 10 crore. Whichever is higher. So everything is, so 10 crore only the value. Okay. So is it pervasive? Is it pervasive? Is it affecting the, is that mistake affecting the entire financials? First of all, I said there is no material mistake. No material mistake. So obviously the question of pervasive is not applicable. Okay. Now tell me which opinion you'll give in this combination. I will give unqualified opinion. A clean opinion I'll give. Second situation. Another. Dear Mr. Auditor, have you found a material mistake? We discuss some examples. Yes, management. Okay. Yes, Mr. Shareholder, I found 1 crore worth of material mistake. Okay. I found 40 lakhs worth of overstatement of inventory. Inventory is overstated. How much? 40 lakhs. Remaining items, everything correct? Yes. Is this 40 lakhs the only mistake? Yes. Is it material? Arey man, it's material mistake. It's a material mistake, 40 lakhs. Now tell me, but because of this entire financial position, is it misleading? Is it pervasive? No, it's not pervasive. It's material, but not pervasive. Do one thing, give qualified opinion. Okay, fine, very good. Third situation. Have you found a material mistakes? Yes, I found a material mistake. Inventory is overvalued by 10 crore. Debtors is overvalued by 5 crore. Assets are fixed assets are overvalued by 20 crore. Liabilities are overvalued by 50 or 60 crore. Now, is there material? Yes. Are they pervasive? Yes, they are pervasive. It's not just one or two items, multiple items, all are big items. They are completely misrepresenting the financial position of the company. They are misrepresenting. Balance sheet is highly misrepresentative. I cannot say it is right anywhere. Give adverse opinion. What is it? Give adverse opinion. Okay. So these are the broad three situations. Fine. Let me take another example. Okay. What if you did not get any evidence? What if sufficient appropriate audit evidence is not available? What if it is not available? Evidence is not available. Yes. Is it material evidence? Is it material? Is it so important evidence? Arey man, yes it is important man. If it is not important, why do I bother? I will directly go and give unqualified opinion. But it's a material item. 1 crore worth of inventory is in the third party go down. I want to go and physically check it out. Management is restricting me. Third party is restricting me. I am unable to know whether is that 1 crore really existing or not. First of all, tell me, is that 1 crore important for that company? Yes, it is material. Okay. Is it pervasive? No, it's not pervasive. It's not pervasive. Do one thing, give an opinion, qualified, say that entire financials are true and fair except 1 crore where you did not get evidence. Just mention that. 1 crore you are unable to comment. Remaining all true and fair. Just mention that. Okay. Second situation. Dear Mr. Auditor, have you got evidences? Fixed assets 10 crore, I don't know. Okay, current assets 10 crore, I don't know. Outside liability is 10 crore, I don't know. Equity reserves and surplus, I don't know. Why? Company accounting records were destroyed. Okay, ask accountant the data, he is unable to answer. Ask management, they are not cooperating. So entire organization is mess. So you are saying for material information you did not get evidence, you did not get data. No, I did not get. Is it material? Sufficient appropriate evidence not available? Yes. Is it material? Yes. Is it pervasive? Yes. It's not just one or two items. There are so many items which are affected. So you are saying evidence is not there. Entire balance sheet, you don't know what it is. Is it right or wrong? You don't know. It is pervasive. Pervasively, you don't know is it right or wrong. Can you give an opinion? I can't. Qualified opinion at least? No, no, no. Even to give qualified, I must say majority of it is true and fair, right? To say majority of it is true and fair, I don't have evidence. Okay, do one thing. Don't give an opinion. In order to say that, what should I give? Disclaimer of opinion. So broadly speaking, there are 5 situations. Broadly speaking, there are 5 situations. One unqualified opinion. One unqualified opinion. Okay, unqualified opinion. One situation. Qualified opinion in 2 situations you'll give. Adverse opinion, 1 situation. Disclaimer of opinion, 1 situation. There are definitions also. First, before I read opinion wordings, before I look into the illustrations, let me draft the definitions of what is unqualified, what is qualified, what is adverse, what is disclaimer. Let me draft the definitions and then we'll discuss the wordings. What is the definitions? Many students will try to mug up. No need to mug up. Right now you understood the concept. Now look at the definition, how I am framing. Okay, look at the definition. When will I give unqualified opinion? Sufficient appropriate evidence is available. No material misstatement. I will give unqualified opinion. Only one situation, one definition. So unqualified opinion, if the auditor concluded, how? Based on sufficient appropriate evidence. What you concluded? That financial statements are free from material. Is there material mistake? No. So free from material mistakes, and which means indirectly they are prepared as per applicable framework. We give unqualified opinion, and that's how unmodified opinion definition has come. Unmodified opinion, unqualified opinion, clean opinion, definition is same. So what does it indicate? It indicates you got sufficient appropriate evidence. It indicates financials are prepared as per applicable financial reporting framework. It indicates accounting policies are consistently applied. It indicates accounting estimates are reasonably applied. It indicates classification, presentation, amount, disclosure, everything is appropriate. Unmodified opinion indicates so many positive things. Okay, fine. Next, qualified opinion. You see, qualified opinion is there in 2 situations. A qualified opinion is there in 2 situations. One situation, evidence is there, material mistake you found, but not pervasive. Another situation, evidence is not there. That too, it's a material item, but not pervasive. Suppose if at all it went wrong, that material item, if suppose, okay, evidence is not there, let me say everything is true and fair. What if that material item which you did not get evidence, if it went wrong later on, everybody will blame you. Okay, don't take risk. So now you see the definition of qualified opinion, how it was drafted. Qualified opinion definition has 2 parts. First part, if auditor concluded, concluded, okay, based on sufficient and appropriate audit evidence. What he concluded? Based on sufficient appropriate audit evidence, that financial statements are containing misstatement. Financial statements are containing misstatement which are material but not pervasive. The auditor concluded, based on sufficient appropriate audit evidence, that financial statements are containing mistakes which are material but not pervasive. They are not pervasive. They are material but not pervasive. Okay, so this is one situation. Another situation, if auditor is unable to obtain evidence, you are unable to obtain sufficient and appropriate audit evidence, and concluded, okay, you did not get evidence, right? Now you conclude like this, and concluded that the possible effect of, look at the word, possible effect of undetected misstatement, if any, could be material and not pervasive, but not pervasive. What are they saying? If auditor is unable to obtain sufficient appropriate evidence and concluded like this, possible effect of undetected mistake. Dear Mr. Auditor, 1 crore inventory is the third party, right? Is there any material mistake? I don't know. I don't know. I don't know whether it's a mistake or not because I don't have evidence. I did not detect anything. So undetected. You are saying not detected any mistake. Does it mean is there a mistake? But possibility is there, no. Possible effect is there, no. Possibility of mistake is there, no. So auditor is unable to obtain sufficient appropriate evidence, but okay, he don't want to take risk. Okay, you did not get evidence, no. Give positive opinion. What problem for you? No. There is a possibility, no. It may go wrong, right? Possible effect of undetected mistake. There is a mistake, not detected. That possibility is there, right? Yes, that possibility is there. What is that possibility? Suppose if that 1 crore is wrong, what is that consequence? It's a material mistake. Of course, it's not pervasive. Okay, you did not get evidence. And the thing where you did not get evidence, the thing where you did not get proof, if at all, if it is turning into a mistake and you did not detect it, and that mistake is going to be material but not pervasive, in such a case, how can you give positive opinion? Absolutely no. So here also you give qualified opinion. Two situations. And you know how adverse opinion definition was drafted? Here, first part of the qualified opinion, as it is wordings, you observe the definition, you will be following some book, right? Qualified opinion definition is there, adverse opinion definition is there. Qualified opinion, first part of the definition, but not pervasive or and not pervasive, something will be there, right? You know, you eliminate the word not, you just substitute the word and. Material and pervasive, it will turn into adverse opinion. The definition will turn into adverse opinion. Now in a qualified opinion, second part is there, no. Second part, here you are saying material but not pervasive. You did not get evidence. The evidence where you did not get, possibility of mistake is there. That possibility is going to be material but not pervasive. Here also but not is there, right? Eliminate that but not word and put the word end. The possible effect of undetected mistake, could be material and pervasive. Are so many items of balance sheet, I did not have evidence. Okay, without evidence say true and fair. Okay, I will say true and fair. What if everything went wrong? Oh, pervasive level mistake. Okay, do one thing. Don't give opinion because it's a pervasive level mistake. If you risk and give opinion positively, it will take you a very bigger risk. So don't take risk, don't give opinion because you don't have proof. So here if I substitute the word but not with end, second part of the qualified opinion definition, just one word if I substitute but not, that I take off and substitute with the word end, it will become disclaimer of opinion definition. If you understand qualified opinion definition correctly, just by replacing one word, you can bring out adverse opinion definition, disclaimer of opinion definition, both. That's it. So that's about qualified opinion and adverse opinion and disclaimer of opinion definitions. Now we will see how in audit report wordings will change. In audit report, how the wordings will change, we will see. Just 1 minute. So just a minute. So right now, whatever definitions I told, this can be asked as an MCQ or true or false question, or they may ask you a straight question also. They may ask you true or false question or MCQ question to test your knowledge on the grip. Okay, to test your grip on the definition. So they may test you like this. So what is an unqualified opinion? If auditor concludes based on sufficient appropriate evidence that financial statements are free from material misstatements and are prepared in accordance with applicable financial reporting framework, then auditor will express unqualified opinion. Qualified opinion, two cases. One, if auditor concludes based on sufficient appropriate audit evidence that the financial statements are containing misstatements which are material but not pervasive. Second part of the qualified opinion, if auditor is unable to obtain sufficient appropriate evidence and concluded the possible effect of undetected misstatements, if any, individually or aggregate, could be material but not pervasive. Adverse opinion. If auditor conclude based on sufficient appropriate evidence that financial statements are containing mistakes individually or aggregate of could be, individual or aggregate, containing mistakes individual or aggregate or material and also pervasive. Disclaimer of opinion. If auditor is unable to obtain sufficient appropriate evidence and concluded that the possible effect of undetected misstatement, if any, on the financial statements could be material and also pervasive. These are the definitions. Modified opinion definition. If auditor concluded based on sufficient appropriate evidence that financials are not free from mistakes. If auditor is unable to obtain sufficient appropriate evidence to conclude financials are free from material mistakes. I don't have evidence to say they're right. I have evidence that they're not right completely. In these two cases, I'll give modified. And how this modified opinion can be divided into sub three types, that also we have covered. And now we'll look into the format of audit report. So first we are looking at unmodified opinion format. You see, this is the audit report format. You see the title, Independent Auditors Report. The title is very clear, independent. Addressing to the members of the company. And you see, this is an audit report on standalone financial statements. We all know, if a company is having subsidiary companies, the ultimate parent company, the parent company shall prepare consolidated financial statements also. So they have to prepare their own assets and liabilities, balance sheet, P&L, like standalone financials, group consolidating this company financial position with the subsidiary companies, joint venture, associates, combined consolidated financial statements they should prepare. So when a company is having subsidiary companies, this company shall prepare two sets of financial statements, one standalone financials and consolidated. Naturally, the auditor of this company has to give audit report on two sets of financial statements. One, audit report on standalone financials. Two, audit report on consolidated financial statements. Two audit reports he has to give. Now you see, this is an audit report on standalone. So that is not a big deal. That's just a information. Dear shareholder, this is an audit report on standalone financials. Information. First and foremost paragraph is what? Opinion. See, the standard is using side heading. The audit report format is containing side heading also. How beautiful it is. You know the specialty with side heading? When you give qualified opinion, we all know right now the opinions are unqualified, qualified, adverse, and disclaimer of opinion. When you give unqualified opinion, the side heading in audit report is simply opinion. But when you give qualified opinion, the side heading is qualified opinion. When you give adverse opinion, the side heading of the opinion paragraph is adverse opinion. When you give disclaimer of opinion, the side heading will be disclaimer of opinion. And you know what? Whenever you are giving qualified opinion, whenever you are giving adverse opinion, whenever you are giving disclaimer, why, Mr. Auditor, you gave adverse opinion? Why you gave qualified? What is the exact mistake? That mistakes you need to give clearly in basis for opinion para. Basis for opinion para. This is the second part, fourth section of the audit report. In basis for opinion, you have to clearly mention what mistake happened if there is a mistake. Sir, no mistake, sir. I am giving unqualified opinion. Then what should I do in the basis for opinion para? You just give a normal how you do audit. You just do audit as per standards. All that information you just can mention. Otherwise, you need to give very clearly what is the exact mistake you need to clearly mention. So, and accordingly, the side headings. So, what are the third section of the audit report? Opinion is third section. Basis for opinion is the fourth section of the audit report format as per the material. Now, when you give qualified opinion side heading, basis for qualified opinion side heading. Adverse opinion, basis for adverse opinion. Disclaimer of opinion, basis for disclaimer of opinion. This is how the side heading will vary. Whenever you are modifying your opinion, the side headings in the audit report also will change. I will show you right now. I will show you. Suppose you take Air India. You take. This is Air India's audit report. You see the side heading, qualified opinion. Since they gave qualified opinion, the side heading itself is reflecting qualified opinion. User, as a shareholder, by looking at the heading itself, I can understand, okay, auditor raised some objection. You see the second part, basis for qualified opinion. Now you see Reliance Industries Limited. So this is Reliance Industries Limited 1819 audit report. It's okay, anything is fine. So independent audit report 259 page. So here the audit report, you see independent audit report title. You see side heading is simply opinion. If the side heading is simply opinion, what opinion auditor gave? Unqualified opinion. You see the next one, basis for opinion, simple. You see the Air India, basis for qualified opinion, because they give a qualified opinion. That's how the opinion wordings, side headings will change. Not only side heading, inside content also will change. Inside content also will change. Let's look at the pronouncement. So when auditor is giving a unqualified opinion, what opinion paragraph will contain? Opinion paragraph will contain two parts. Opinion paragraph will contain two parts. This is one first part, this is second part. This is first part, this is second part. First part, you just have to give an introduction. We have audited, we have audited, we have audited standalone financials of ABC company comprising balance sheet, P&L, cash flow, statement of changes in equity, all that. In our opinion, this is the opinion, actual opinion. This is what most important paragraph in the entire audit report. You see here, in our opinion, to the best of our information, according to the explanation given to us, in our opinion, dear shareholders, in our opinion, it's not absolutely our opinion. It is based upon our information, according to the explanation given to us, based on the information I got, based on the explanation I got, I'm giving this opinion. Indirectly, I am emphasizing on the concept of reasonable assurance. Dear shareholder, you remember this opinion what I'm going to give here, it's based on information I got, based on explanation. Indirectly, if I got a different information, different explanation, I would have not given this opinion. I would have given some other opinion. Based on what information I got, I'm giving this opinion. The aforesaid means what? Here they mention no. The aforesaid financial statements give information required by the act in the manner so required. How the Companies Act is asking to give information in financial, in the same manner the financial statements are giving, and give true and fair view in conformity with accounting principles generally accepted in India. Dear shareholder, in our opinion, to the best of our information and according to the explanation given to us, the aforesaid financial statements are giving true and fair view. They are giving information as required by the law, as required by the act, in the manner so required. So they are giving true and fair view. See, here I didn't use any objection, exceptional wordings and all. I plain reading. They are true and fair. Now you see how qualified opinion wordings will change. How qualified opinion wordings will change. When auditor is giving qualified opinion, how it will change? You will find qualified opinion illustration in SA 705, or you can open study material audit report chapter. There also you can find. Listen these videos for multiple times. Okay, because it's a marathon, I need to cover so much. Auditing syllabus is so much. I don't know how many of you have went in this depth. People say auditing is a theory subject. I will prove by the end of this marathon, you will say auditing is the most practical subject. If you don't know how to learn the audit, you feel theory. You feel like mugging up. Now illustration 1. Audit report containing qualified opinion due to material mistake. So illustration 1, qualified opinion auditor is giving. You see the format, title same, independent, address it to the members. You see the side heading, they modified qualified opinion. In qualified, what are we saying? Financials are right only, except you see here, in our opinion, to the best of our information, according to the explanation given to us, same. You see here, the aforesaid financial statements give true and fair view. They are saying positive opinion only. You see here, in our opinion, to the best of our information, according to the explanation given to us, the aforesaid financial statements give true and fair view. So they are saying positive opinion. However, in between they added one word, except for the effect of matter described in basis for qualified opinion section of our report. In our report, there is another section. What section? Basis for qualified opinion section is there. Inside that, there is a matter. There is a matter described, except that effect of that matter described in this section, the aforesaid financials are true and fair. Except that matter, the above financials are true and fair. What is that matter? The company inventories are carried in balance sheet at so and so price, 10 crore. Management has not stated the inventory, at lower of cost or NRV, 40 lakhs misstatement is there, which is a departure from accounting standard. So they're explaining why they give qualified opinion. Why explanation is required, See, for you felt it is material. I said 40 lakhs worth of mistake is not tolerable. So I gave qualified opinion. I'm a normal shareholder. I'm an aggressive stock market investor. I saw your audit report. I saw the reason. 40 lakhs and all ignore. Hey, buy the shares. My risk appetite is different. So when auditor said that is wrong, as a shareholder, I will also not take it is wrong. I want reason why it is wrong. If you give me reason, I will also check that reason and I will decide accordingly. Maybe for you, Mr. Auditor, it's a very big reason, but for me, it's not a big reason. So that is the reason why auditor has to give reason in the basis for opinion para. And you see, when auditor is giving unmodified opinion, basis for opinion para do not contain anything about financials, mistake, all that. The basis for opinion para simply contains one standard paragraph. Basis for opinion section that contains one standard para. Simply that it talks about we conducted. You see the word we conducted our audit in accordance with standards on auditing. Our responsibilities under those standards no have so many responsibilities are further described in auditor's responsibilities for audit of financial statements section of our report. Below we have another report, another auditor responsibilities for audit of financial statements, another section in our report. Inside that, what are all our auditors responsibilities we have explained. What will be there in the auditor responsibilities section? In question bank, especially whoever is listening to my classes, regular classes, in question bank I already covered this. Auditor responsibilities in audit of financial statements, in question bank I covered what points will be covered in this section of the audit report. So in basis for opinion para, what are we saying? We do audit as per standards. We do audit as per standards. As per the standards, we have some responsibilities. And what are the responsibilities? Don't worry. It is not explained in basis for opinion section. It is explained. We have a separate dedicated section, auditor responsibilities related to audit of financial statement section. There we explained. Okay. And you see here, we are independent of the ICA, we are independent of the company in accordance with code of ethics as per disqualification qualifications of the company, and we believe that evidence we have obtained is sufficient, appropriate. This is a very big affirmation. We believe that the evidence we got is sufficient and appropriate to provide a basis for our opinion. Whenever you are giving unqualified opinion, qualified opinion, adverse opinion, you need to mention the highlighted sentence. You need to mention this highlighted sentence. We believe that evidence we got is sufficient, appropriate. You know, in opinion paragraph, first point, what you are saying, in our opinion, based on information explanation, we got it is true. Okay, you got some information explanation, based on that it is true and fair. Have you got enough information? Have you got sufficient information? Have you got appropriate information? Whatever you need. That's what we are confirming. Dear shareholders, don't worry. We got all the information, whatever we want. Only based on whatever we want, only then we are giving opinion. So don't think I am escaping saying whatever information they gave, I gave this opinion. No, I am not escaping. Whatever I want, I got, and then only I gave the opinion. You are affirmating here. You are confirming here. And you see, in qualified opinion also, first paragraph of the basis for qualified opinion, I will exactly point out mistake. Second paragraph of the basis for qualified opinion is a standard para. Whether you give unqualified, qualified, adverse, this paragraph is a standard. Sir, this paragraph will not come in disclaimer of opinion. In disclaimer of opinion, basis for opinion para will not contain this standard para. Only in unqualified opinion, qualified opinion, adverse opinion, this second part will be there. In unqualified, this itself is the part. But in qualified and adverse opinion, this is second part of the basis for opinion para. This paragraph, if you give disclaimer of opinion, will not come at all. Will not come at all. In basis for disclaimer of opinion para, we only talk about why we gave disclaimer of opinion. We will not talk about we have conducted the, array man, when you are giving disclaimer of opinion, where is the question of conducting the audit? How can you start the sentence with we conducted our audit? We conducted our audit means what? You did audit. You did audit means what? You got evidence. You got evidence means what? You have a conclusion. You have a conclusion means what? You give opinion. So that's basis for opinion paragraph. That's how it changed. Don't worry, I'll come to that. Next, I will show you adverse opinion. How adverse opinion will come. See, don't take it light. MCQs and all will come on this. Illustration 2 in SA 705. It is talking about adverse opinion. You see adverse opinion, side heading you see adverse opinion. Basis for adverse opinion. Basis for adverse opinion, you see it has two paragraphs. First paragraph and second standard para. Standard para is what? We conducted our audit as per standards on auditing. Okay, our responsibilities under those standards are described in so and so paragraph of our audit report. We believe that evidence obtained is of same para. Unqualified opinion, this para is there. Qualified opinion, this para is there. Adverse also it is there. In adverse, one more additional para is what? Why you gave adverse opinion. Specific reason you will mention. Now you see how the opinion wordings will change. In our opinion, to the best of our information and explanation given to us, same phrase, no, unqualified opinion, qualified opinion, same phrase, no, in our opinion, to the best of our information and according to the explanation given to us, the accompanying financials do not, you see the word, do not give true and fair view. That is what adverse, they do not give true and fair view. Why they're not giving? Why they're not giving? Because you see the word, because, not except. Except word is used in qualified opinion, because word is used in adverse opinion, because of significance of the matter. There is a matter discussed in basis for adverse opinion section. In the basis for adverse opinion section, there is a matter which I discussed. Because of its significance, I am saying they do not give true and fair. In our opinion, to the best of our information and according to the explanation given to us, the aforesaid financials are true and fair. Unqualified opinion. In our opinion, to the best of our information and according to the explanation given to us, except for the effect of the matter described in dash paragraph MCQ, option A, basis for opinion, basis for qualified opinion, basis for adverse opinion, basis for disclaimer. If you have never seen this observation, how can you answer this? You prepare auditing in a theoretical manner and expect a full marks in audit. Remember, auditing is also for 100 marks only, like FR, like SFM. You are spending 400, 500 hours on coaching plus preparation on FR, still you get 70, 75 maximum. In audit, you want coaching within 120 hours, you want to study 100 hours. Half the time you spend in FR, still you want 60 plus. How do you get? Auditing is a most practical subject. I will prove it in every marathon lecture which I am taking. I will prove it throughout the marathon. I will prove you that auditing is a most practical subject, provided you know how to learn the subject. Okay, MCQ can come like this. You check MTPs and all. This is how it is being asked. So depth, it's good. Only a qualitative student will come out as a chartered accountant. Now, still not over. Disclaimer of opinions. We need to see, right? Disclaimer of opinion. How disclaimer of opinion will come? See, this is a marathon class. Don't expect very detailed definitions. So, sir, go little slow. No, if you want, you slow down the video speed. Okay. So please don't compel me to take it little slow. Now, disclaimer of opinion due to auditor inability to obtain sufficient appropriate evidence. Disclaimer of opinion. You see side heading, disclaimer of opinion. You see basis for disclaimer. Here again one para only came. We conducted our audit as per. Where is that para? In disclaimer of opinion, basis for opinion paragraph shall not contain your responsibilities relating to standards on auditing. That you have obtained sufficient appropriate evidence. That and all you should not give. That and all you should not give. That and all you will give an auditor responsibility section. Even auditor responsibility section will drastically vary when you give disclaimer of opinion. When you give unqualified opinion, qualified opinion, adverse opinion, auditor responsibility section will have so much content. When you give disclaimer of opinion, auditor responsibility section will be hardly few lines, 4 or 5 lines. Basis for opinion para will not have the standard paragraph. Okay, now you see. We do not express. Can I say, in our opinion, to the best of our information, according to the explanation given to us, I am unable to give opinion. Can I, in our opinion, I am unable to give. Can you say like that? You say, we do not express opinion. And moreover, you see the starting line itself changed. Starting line itself changed. Unqualified opinion, I'll show you. Unqualified opinion, we have audited. Qualified opinion or qualified opinion, we have audited. Adverse opinion, we have audited. Everywhere we have audited. Disclaimer of opinion, disclaimer of opinion, we were engaged to audit. Why? In disclaimer, why am I giving disclaimer? Because I'm unable to do audit, I'm unable to get evidence. So I was just appointed but not conducted audit. So the wordings of the beginning paragraph, we were engaged to audit, that itself shows it's a disclaimer. By looking at the first line without even side heading, I can tell you which opinion it is. Okay, we do not express an opinion on the financials. Why? Because of significance of the matter described in basis for disclaimer opinion section. There is a basis for disclaimer opinion section. Inside that I gave a matter. Because of that significance, I cannot give an opinion. And this is how the wordings of disclaimer of opinion paragraph will change. And you know one more thing. basis for opinion paragraph, whenever you give a modified opinion, the wordings of basis for opinion paragraph should change. Whenever a material misstatement is there, basis for opinion paragraph should quantify the mistake. If you are unable to quantify, mention that you are unable to quantify. If the mistake is in the form of non-disclosure, narrative disclosure, you should give in basis for opinion paragraph. This all I explained in my question bank. How basis for opinion paragraph wordings will change when auditor is giving a modified opinion. Side heading will change, that we know. Inside that, wordings also will change. Disclaimer opinion, standard para, we conducted our audit as per standard, that at all, that itself will not come when you give disclaimer. And when you are giving qualified adverse and qualified and adverse opinion, there will be one additional para. You need to give clearly the reasons. You need to quantify. You need to mention more clear information. How to mention that? Everything is explained in the question bank. By the way, whoever is watching in YouTube, question bank is not available for public. It is only for those who joined my smart course or regular course. For all our students of smart course and regular course, question bank videos we did. That's it. This is little advanced concept. In examination, they may ask you 6 marks question. Write about basis for opinion para and how basis for opinion paragraph wordings will affect, how the basis for opinion paragraph will change in different circumstances of modified opinion. That's it. So with this, for the marathon purpose, I have covered, okay, what is an opinion, what are the different types of opinion, definitions of opinion, how audit report wordings will change in different circumstances, we have covered. And my dear students, whoever is listening to my regular class students, whoever is, okay, please, for you, question bank is already uploaded. Okay, already uploaded in the drive as well as in the application. Please watch in that question bank how basis for opinion paragraph wordings will affect. Okay, how it will affect, I gave it. Okay, for your information, I will even show you the question bank. I will show you the question bank. Okay, my dear students, this already explained in the question bank. SEA 705. You see, this is the auditor responsibility section. This is auditor responsibility section. What auditor responsibility section should contain? All this content. And where this responsibility description can give. How basis for opinion paragraph will come in case of modified opinion. 6 circumstances I gave. 6 circumstances I gave. How disclaimer of opinion paragraph, when the auditor gave disclaimer of opinion, audit responsibility section, in audit report, audit responsibility section will come, right? How that will affect, that also we explained. Now coming back to our main discussion. Now you see what we covered, we covered opinion now. And we covered even basis for opinion. We even covered basis for opinion. Just a minute. Yeah, now we covered a title, we covered addressee, we covered opinion para, we covered basis for opinion, we covered. Our next discussion is material uncertainty related to going concern. Okay, so we'll stop this part 2 video here, audit reporting. Still 2 to 3 parts of the video will come. So second part 3, we are talking about remaining standards. In part 3, we are talking about SA 570, key audit matter, emphasis of matter, other matter para, other information also. If possible, I will try my best to cover as much as possible in the part 3. This is part 2, and I hope you already watched part 1. Before watching part 1, don't come to this. If not yet watched, please go and watch part 1, fundamental terms to understand throughout the audit subject. That's it. So carry on. Have a nice time. Bye bye. And by the way, I'm sorry because I'm unable to give you so detailed explanation, because like this itself, if you see almost this is 1.5 hour session. Part 1 is 1 hour session. Almost 20 hours if I take, I can only spend hardly 50% of the syllabus. You see, 50 to 70% of the syllabus only I can cover within 20 hours of marathon. If I have to cover entire syllabus, 40 hours I need to take marathon, which I can't take. Obviously, I can't give completely on the YouTube, right? That's it. I hope you understand. Thank you. I hope you understood the level at which you need to prepare audit. Earlier, you have one level of understanding and now you are having another level of understanding. I hope you realize how to learn audit. It's not a theory subject, it's a practical subject, and I will prove it at every lecture in marathon. At every part of the marathon, you will understand it's the most practical subject. I'm telling you, you will connect to it mostly. Bye-bye. So this is part 3 of marathon, audit marathon for December 2021 exams for CA final, advanced auditing and professional ethics. Well, I hope you already have watched part 1 and part 2 videos. Only if you completed watching part 1 and part 2, please come to part 3. This is part 3 of the marathon session. Like many are asking me after I uploaded today like 2 parts, many are asking me regarding the soft copy material. Sorry to say that the soft copy material I'm not providing now. And the material, first of all, you feel it is very bulky because my main material is right now 660 pages, 120 pages approximately question bank, 100 pages. This is module 1, this is question bank, this is module 2. Altogether approximately 880 pages. And you know, this is excluding the chapter called audit under fiscal laws, direct tax and indirect tax. That will consist of approximately 200 pages material in the ICA material. So approximately around more than 1050 pages material. Sir, why the material is so bulky, 1050 pages in auditing? It's only because I am covering 100% syllabus. If at all I just want to skip 30-40% of the syllabus, I can even congest the material to 600 pages. So any of the students, whoever want to get my material, okay, like considering the presentation is very good, all that, no, only those who are attending my classes, for them only I advise it strictly. Others, you may feel it is bulky, but actually the material quality wise, definitely it is top notch material. You don't find that kind of qualitative material anywhere else for sure. But I don't recommend for those students who are not attending my regular class, because you will feel it bulky. You will feel it very bulky. So I'm not selling it on commercial basis also. Kindly cooperate with this regard. Now, this is part 3 audit marathon. In the previous part 1, I just spoke about fundamental terms. We discussed about certain fundamental terms. We discussed about some fundamental terms. Then we started audit reporting, where we have already completed 2 standards, 700 and 705. So 2 standards we have completed. Just 1 minute online. Yes. Fundamental terms we discussed about. Yes. Sorry. Just I'm checking is the stream going well or not. Yeah. So part 3. So like if you just once recollect the contents of the audit report. So we are learning how to prepare audit report. What is the process of preparing audit report? So contents of audit report, 4 segments we have completed. I told you audit report have totally 16 segments, 16 components, 16 sections, 16 parts, out of which only 4 parts we have completed. Title we understood, how to put a title to the audit report we understood, how to put an addressee we understood, what is the opinion, different types of opinion, what is basis for opinion in different scenarios, how basis for opinion paragraph will affect also we understood. And now the next one is material uncertainty related to going concern. Material uncertainty related to going concern, SA 570. And this is the standard where 90% of the student, I can confidently say, they feel they understood, but it is not. Now you see, now you check. So what is SA 570? SA 570, SA 570 simply uses the heading. What is the heading of the standard? Going concern. SA 570 is just going concern. So what is going concern? We all know, sir, from the foundation itself, from the CPT itself, we know what is going concern. It's a fundamental accounting assumption. That's where you are thinking. It is not just assumption. Going concern is about ability. Going concern is about ability. People think that going concern is only an assumption. As long as you think going concern is an assumption, you don't understand audit. You don't understand the SA 570. Going concern is an ability. See, my business is there. I am running my business. If I do not have proper cash flows, if my business is not running properly, if my customers are not being satisfied properly, if my customer demand is declining, my products are failing in the market failure, environmental failure, if all this is there, how can I continue my concern? What is meant by concern here? Enterprise, company, organization, institution, establishment. What is going concern? My enterprise will kept on going. It will not stop. It will not halt. So that is what going concern assumption is all about. Now, what auditor has to check? We all know. What is our objective? Our objective is to obtain reasonable assurance whether financial statements are free from material misstatements. Are they prepared in accordance with applicable financial reporting framework? That is what our objective, right? Yes. Now, management prepared financial statements using what assumption? Going concern assumption. So, management used going concern. As an auditor, what should I check? Whether management use of going concern assumption basis of accounting, is it appropriate? I need to check. As an auditor, what should I check? Management prepared financials using going concern basis, using accrual basis, using consistency principle. I need to check whether the usage of going concern assumption by management, is it okay? Is it acceptable? Is it appropriate? You need to check that. Why, sir? Because my business actually failed. I already defaulted. I am already insolvent. I am already insolvent. But okay, but my business has failed already. I become already insolvent. I become already insolvent. Now, but my management, like my company, those charged with governance, they prepared financial statements using going concern basis. They prepared using going concern basis, even though going concern assumption is not suitable. When I can run my business continuously, perpetually, or when I can run my business successfully, when I can continue really my business. Suppose I already defaulted. I'm not running business at all. But still I'm using going concern basis. And you know, you take balance sheet, fixed assets, 100 crore gross block value, depreciation 50 crore, the net WDV is approximately 50 crore. I hope you're all able to listen. Just let me once check. Can you all once confirm me in the YouTube chat or through any other medium, or you all fine? Is it okay? Yeah, it is a live right now. It is streaming live. Of course, recorded version copy is also been available later. So is it been okay? Yeah, fine. Fine, Chandrika. Thank you. So fixed assets, we are showing original cost 100 crore, accumulated depreciation 50 crore, and WDV is 50 crore. Fixed assets original cost 100, depreciation 50, net WDV 50 crore. Current assets, you take current assets. What is the valuation principle? What is the valuation principle? NRV or cost, whichever is lower. Why for current assets we follow costed NRV, whichever is lower? But why for fixed asset we follow historical cost concept? Because simple reason, fixed asset I don't want to sell. When I don't want to sell, why do I bother about net realizable value? You know, fixed asset is showing 50 crore. In reality, the market value is only 5 lakh, or the market value is only 10 lakh rupees. It's a customized plant and machinery. Today, Ford India, 1.5 months back, they announced, 1 month ago, Ford Motors India. Okay, they announced winding up. Winding up means they just announced that we are going to exit from India. We can't sustain in the India with respect to automobile market. And now there are two plants for Ford. One is in Chennai, another one is in Gujarat. The two manufacturing plants are there. Who will buy that manufacturing plant? Who will manufacture Ford cars? Only those they can buy. Or who can customize that factory according to the requirement of the existing automobile maker, then he can. Otherwise, how that plant and machinery will have value? He just have to sell it in a piecemeal method. He just have to dismantle it, sell it on kg basis, ton basis. But when he is purchasing the machine, he paid patents. He paid so much of intangible expenditure he must have incurred. Development cost he must have incurred. All that zero, if at all he want to sell the factory. So generally, you take fixed assets, you try to compute what is the net realizable value. It is 10 times lesser than what is shown in the books of accounts. Then why, sir, why our financial statements do not consider net realizable value? Because I don't have intention to sell. If I have intention to sell, I'm worried about net realizable value. Oh my God, my asset value came down. What should I do? I'm worried about that. If I don't have any intention to sell, why am I worried about it? Same way, whereas coming to inventory, why we are valuing inventory at cost and NRV, whichever is lower? Prudence concept. Recognize possible loss, don't recognize possible income. My cost is 10 crore, but net realizable value is 7 crore. There is an expected loss of 3 crore. So value right now, recognize right now. Because you are going to lose the money immediately. You know the loss. You want to sell it. As simple as such. This is the reason behind going concern usage. Because we are using going concern, fixed assets are valued at historical cost because we don't want to sell. Why will I sell? My business is flourishing. My business is running. Why will I sell? But what if you are in a position like Ford Motors, which is facing right now? You are in a position of Ford. Like Ford is unable to operate in India. So they are now looking for sellers for selling their factory. Tata Motors is participating in the bidding process. Some other motors is trying to participate in the bidding process to get that factory at the lowest possible price. Okay, now when you want to sell the company, what is the use of you, or how can you use historical cost concept? And when going concern assumption, when you want to sell the company, sell the company means because you are unable to run the company, you want to sell the company. Okay, if this is a situation, you have to prepare balance sheet P&L, not by using GAAP, not by using applicable framework. You have to reinstate every asset and liability. Every asset and every liability you have to reinstate at NRVs. And do you think balance sheet will tally that time? No. When going concern assumption is missing, when the company cannot use going concern assumption, obviously it cannot prepare financial statements. Even then, suppose if a particular company, though they can't continue business, they don't want to disclose it outside. Okay, they want to still maintain that company. They still want to maintain the company for some more years. Okay, there is some sort of malicious intention is there, some malified intention is there behind. So they don't want to disclose this severe position. Okay, severe crisis which the company is facing. Company literally is unable to run the business, but still they prepare financials using going concern basis. In that case, if you are the auditor, you need to check, is that usage correct? Is that usage appropriate? So you need to check in this kind of scenarios. That's why what the going concern standard says, going concern standard says, dear Mr. Auditor, okay, just 1 minute. So yeah, getting back, sorry. So going concern, like the auditor, what auditor has to check? First, auditor has to do a preliminary assessment. Whatever the company appointed us, first we need to do a preliminary assessment. What is preliminary assessment? Here we have to check whether management of the company has a formal going concern assessment or not. Whether management of the company, are they conducting formal going concern assessment or not, auditor has to check. A formal going concern assessment is being checked, conducted by the management or not, we have to check. So what do you check here? You will ask whether management has a policy, documented policy with respect to going concern. We will ask what is the nature and condition of the business. We will ask operational forecast of the business. We will ask, is there any transaction or event that significantly took place during the year that might affect going concern of the entity, that might affect entity continuity in the business. So we will ask whether management did a formal preliminary assessment, risk assessment. This can be asked as a straight question. Write about risk assessment related to going concern. Write about risk assessment related to use of going concern assumption by the management for preparation and presentation of financial statements. So you will get a question like this. That's preliminary assessment. Then what is the second part? After preliminary? So first I do this. So sometimes management may not have a formal framework. Management may not have a formal assessment, especially medium companies and small companies. They will not have a formal this thing. They will not have a risk management committee. You take very big company, listed company, LODR regulations, they need to form a risk management committee. As a risk management committee, what risk management committee do? They continuously identify various sort of risk, business risk, going concern risk, all that they will be formally having a program. But what about a company which is not listed? What about a company which is medium and small? They will not have a formal assessment program. In that case, what auditor has to consider in risk assessment related to going concern? Inquire why management do not have a formal program. Okay, you don't have formal program. On what basis you have used going concern assumption? Ask this question. Then ask the same questions. Nature and condition of business. What is the future operating forecast? Operating cash flow, and transactions and balances that are significantly happened during the year, occurred during the year, which might affect going concern. If management do a formal assessment, take their workings. If they don't do a formal assessment, ask them why they didn't do. On what basis then you have used going concern assumption? Remember, this is the area where 90% of the auditors are not checking. Most of the auditors are not checking. Of course, the reason why we don't check is because we don't have any checklist here. When we are doing audit, we don't have a checklist of going concern. Now, many audit firms have revised in the past 2 years. Many audit firms have revised their audit programs to include going concern concept. Going concern as part of audit checklist. So that is about preliminary assessment. By doing a preliminary risk assessment about going concern, you will understand, is there any condition, is there any circumstance, or is there any event that cast significant doubt on entity's ability to continue as a going concern. Let me open the material. Just a minute. So SAF 570 I'm opening. So this is SAF 570. Just 1 minute. Fine. So first, I will have to do preliminary assessment. In fact, it's called as preliminary risk assessment regarding use of going concern assumption by management. Management prepared financials using going concern. So you need to do a preliminary assessment. What? Here, the following factors auditor shall consider in preliminary assessment. First one, ask management. This actually I covered in my question bank. For all my regular course students, it is already covered as part of question bank. What is the risk assessment process related to use of going concern? I already covered. So you will ask management, especially listed companies, they will have a risk management committee. They follow LODR regulations. They have a formal enterprise risk management program. Okay, so you see, is there a formal procedure or not? Then check all these points. Suppose if there is no formal program, if there is no formal policy for the company management to check about going concern, ask why it is not there. Ask them why it is not there. And also ask what is the basis of use of going concern, and then check these points. Now after you check all these points in the preliminary risk assessment, suppose you come across some indicators, you come across some circumstances. What is that indicator is indicating? That indicator is indicating going concern might have affected. Going concern might have. Remember, an indicator doesn't mean there is absolutely going concern is wrong. No, it's just a symptom. It's just a symptom. By using that symptom, you have to conduct a further audit procedure. Based on that, you decide ultimately whether financial statements prepared using going concern assumption, is it okay? Evaluate based on the indicators and further audit procedure. First, auditor has to do preliminary assessment. Then auditor has to identify, is there any indicator? If there are no indicators, I did not find any indicators in preliminary assessment, close the standard, over. Suppose if you find any indicators, then investigate them and identify, conduct further audit procedure. What is further audit procedure? That is what this D point. This is an audit procedure. The following audit procedure should be performed if auditor identifies any circumstance. If auditor identifies any circumstance, any indicator that significantly doubt entities going concern, you have to carry out this audit procedure. By carrying out this audit procedure, you will get a concrete conclusion. Yes, going concern is missing. Company cannot use going concern. Or you may get a conclusion, going concern is very much appropriate, no problem at all. Any of this you will get a conclusion. Any of this conclusion you might get. Okay, so what are the indicators? First, let us look at the indicators and then go to the further audit procedure. Indicators, SAF 570 says, the standard says, indicators can be broadly classified into 3 categories: financial related indicators, operating indicators, and other indicators. What are financial indicators? Suppose company has a net liability position, net current liability position, working capital is negative. Air India's position is the same. Air India position is same. I will show you right now Air India audit report also. Don't worry. Fixed borrowings, fixed term borrowings approaching maturity without renewal or repayment. There are so many borrowings which I made. Now they are approaching maturity and I don't have any repayment option. I don't have cash in my hand and I don't even have plan for renewal. Okay, even if I ask the lender, sir, can you renew my application? No option. Withdrawal of financial support by creditor, negative operating cash flows, financial ratios are adverse, operating losses, discontinuance of dividend. Okay, creditors, we are unable to pay creditors on due date, inability to comply with loan agreements, defaults in repayment of loan, defaults in repayment of loan. You see, ILFS, Jet Airways, in 2019, it has started seeing its downfall. Only the moment they defaulted repayment of salaries. Kingfisher, they started defaulting in repayment of salaries to employee. From them only, from that particular moment only, it has started. And what happened later? Jet Airways, no more. Not even a single flight is being operated. Now, inability to obtain financing. Company want to launch a new product at least to revive the business. For that, company is unable to find an investor. These are all financial indicators. Operating management itself is intending to liquidate the operations of Ford India. Management itself wanted to see, as long as they managed. One day they reached to a conclusion, no, it is not viable for us to work in Indian automobile industry because we can't compete with the other innovators, other competitors. So what Ford declared? We are leaving. Management itself openly said we are leaving India. They have not defaulted. They paid everyone on time. No default. There is no financial indicator. Logically speaking, they paid everyone on time. Everything they honored. But with respect to intention, they strive. But of course, though they operated with negative cash flows. Negative cash flows always. Foreign holding company sent money to the Ford India, and that's how that company was survived. Next, loss of key management without replacement. Management person has lost. Loss of major market, key customer, franchise license. Ford Motors has lost major market the moment Kia was launched. Okay, the moment MG was launched. Until MG Hector was launched, like popular car in the market, Ford Endeavour is having decent sales. But once MG Hector was launched, many people have shifted, though it's a lower segment compared to Ford Endeavour car. So many people started buying. So loss of major market, labor difficulties. You see road transport corporations. AP Road Transport, Telangana Road Transport, Tamil Nadu Road Transport, KS Road Transport. So what happens if labor strikes? That RTC will struggle, financial crunch. Shortage of important supplies. Today, Apple iPhone 13, the production process was delayed. As per the recent report, Apple wanted to manufacture 90 million phones, but their production was declined by 10 million phones because of chip shortages. Semiconductor integrated chips shortages, important supplies, if it is not there, it will lead to my going concern. Of course, Apple did not face a going concern issue, but that is also, suppose that is the only product you are dealing with, and for that product, raw material scarcity is there. Now you see, from past 2 days, Prime Minister has conducted various meetings with all the electricity manufacturing companies, power manufacturing companies, because there is a shortage of power, especially in the northern part of the India, because of coal supply shortage. Because of the pending dues to the coal suppliers, they're not supplying the coal. And pending dues are there. Accumulated dues are there. And they don't have cash to pay. Emergence of highly successful competitor. The moment Jio enters into the market, BSNL lost. Idea Vodafone lost. And there are other indicators. Sometimes it may not be operating indicator that affected my going concern. It may not be financial indicator which affected my going concern. It's some other indicator. Which indicator? Non-compliance with capital and statutory. Suppose Yes Bank you take. They didn't comply with their RBI regulations, capital compliance norms, capital adequacy norms. So they didn't comply with that. So pending legal or regulatory proceedings against the entity, if successful, result in claims that entity unlikely to be able to satisfy. They can't satisfy. If at all that claim went successful, we can't pay. If at all telecom regulator is passed an order, yes, Vodafone Idea should pay immediately 58,000 crores worth of AGR dues. No installment, nothing. Already we waited for past 10 years. You have to pay immediately now. What Airtel CEO said, what Vodafone CEO said, we have only one option, wind up. Changes in law regulation, government policy, which is adversely affecting the entity. E-commerce policy 2020 affected so many ways how businesses will be doing. Flipkart, Amazon, they have opened so many companies. Okay, for the sake of complying with the new e-commerce policy. Uninsured, underinsured catastrophe, some catastrophe, natural calamity occurred, and I don't have proper insurance for my machines. And these are all various reasons why my going concern effect. So when you're doing preliminary risk assessment related to going concern, if you come across any of these symptoms, conduct further audit procedure. What is further audit procedure? What is further audit procedure? Why are we doing further audit procedure? Why are we doing preliminary assessment? Why are we finding indicators? In order to identify whether the organization prepared financials, right? They prepared using going concern assumption, right? Is it okay or not okay? For that reason, we are checking all this. So what auditor has to check with respect to the audit procedure? Whether there is a policy of assessment of risk related to going concern. Check once again formally. Evaluate management future plan of action dealing with going concern. Has entity prepared cash flow forecast? And any additional information you got to know. Get written representation regarding their plans for future feasibility, all that. Analyze cash flow profit. Analyze interim financials. Take legal opinions. Look at the minutes of the meetings. Look at any subsequent event happened. Look at borrowing facilities availability, all that. After checking all this, you will come into conclusion two types. You may come into conclusion straight away two types. Now you see, this is a very beautiful analysis. Okay. Now you may come into conclusion two types. Now here I will link SA 706 also. Okay. So conclusions reached. Conclusions by auditor relating to use of going concern assumptions. Related to use of going concern assumption 570. Conclusion. One conclusion. Yes, going concern is appropriate. Fine. Going concern is appropriate. Going concern is appropriate. Or another situation, going concern is inappropriate. No. Company cannot run the business. Already defaulted. Default have already started. Delay is already overdue. All the debts were outstanding, already overdue. It is not just outstanding, overdue. Inappropriate. Going concern inappropriate. I asked questions to the company. They were silent. I asked what is the future plan of action? How do you tackle this debt? No response. Management do not have any sound financial action plan to tackle the crisis they are facing. They don't have any sound financial action plan. Going concern is inappropriate, but still so clever these people. They used going concern assumption, make the balance sheet tallied, portraying to the public that we are fine. Auditor has to give an adverse opinion. And the reasons for why you gave adverse opinion, please indicate in the basis for adverse opinion section of your audit report. Sir, no sir. As you said, there is a very big material uncertainty, sir. There is a very big material uncertainty. There is a very big uncertainty. Yes, what you said is right. Company already defaulted. Company is unable to continue the business. There are all the indicators, all operating indicators, all finance, everything is there for our company. Every problem is there, but we have a sound action plan, sir. We have an action plan which we are going to implement in future, sir. Please wait. Don't say it is inappropriate. We have an action plan. We will implement it. We will revive our company. We will apply a turnaround strategy. Revive our company. Please wait, Mr. Auditor. They showed you with all the evidences and all how we are going to revive the company. Of course, till date revival plan not implemented, but a restructuring revival plan is shown to you. So management is fighting to run successfully the company once again. They want to put back the company onto the track. They are fighting severely. But see, revival plan have not yet started. Restructuring plan have not yet started. As on today, what it appears, going concern is not there. But still, management is saying, sir, we will revive. Please consider. Okay, fine, I will consider. So I will consider going concern is appropriate, but a material uncertainty exists. I will say going concern is appropriate. Okay, fine. Since you are having a revival plan, I will feel it's okay, appropriate, but there is a material uncertainty. I will consider your appeal. I will consider your request that you are having a sound action plan, all that. But do one favor. Please discuss all this thing in the financial statements, notes to accounts. You prepared notes to accounts using going concern basis without mentioning all this. You are telling me now when I ask this question, but you didn't tell to shareholders. You are cheating them. What if tomorrow your plan of action didn't work out? Your company have to liquidate then, right? So mention in the financial statements, disclose adequately in the financial statements about your material uncertainty situation, that you are having a plan of action. Somehow you want to do asset restructuring, a revival plan you want to implement, all that going concern is affected. That fact you mention in the financial statements. Company management, no, they did not agree. Sorry, sir, we don't want to show. Because you're an auditor, we are showing to you, but we don't want to show to the public. We don't want to damage our reputation. But then you are misleading the public. Your going concern already affected. Your plan, your future plan of action, we don't know. It depends upon market uncertainties, all that. How do I know whether your action plan works out or not? Okay, you are proving me, you are calling experts, you are calling market surveyors, and you are saying with them that this plan will work out. But at the end of the day, it is uncertain, right? And that uncertainty you are not disclosing in financials. So you are misleading the investors. You don't want to modify? Don't worry. I will give my modified opinion. I will give, depending upon the situation and severity, I will either give a qualified opinion or adverse opinion. Plus, whatever reasons I have, I will give it in the basis for qualified opinion, basis for adverse opinion. Why? Management did not disclosed material uncertainty related to going concern. They did not disclose material uncertainty related to going concern. So straight away, I will give adverse opinion. Sir, you said we are discussing this paragraph, no? You said material uncertainty related to going concern para we are discussing. Material uncertainty related to going concern para you said we are discussing. Okay, regarding that one I'm coming now. So company is facing a severe crisis. They're having a solid future plan of action, something like that. But as on today, going concern is inappropriate according to me. And I don't believe in their action plan. Management did not disclose. I will modify the opinion. Suppose, sir, what if company is very honest? What if company is very honest? Air India management. Take Air India management. They disclosed such material uncertainty in financial statements. They disclosed, sir, uncertainty related to financials. They disclosed. Along with that, they are also mentioning to each and every shareholder, we will revive the company, don't worry. They disclosed uncertainty, that going concern crisis, inappropriateness, everything they disclosed honestly. Now tell me, who are you and me to give a negative comment here when they disclosed everything true and fair? Financial statements, are they wrong? No, they are right. So you give which opinion in this context? With respect to this context, you give which opinion? Unqualified opinion. I don't have any right to modify my opinion. Why? They disclosed everything, man, honestly. Why will I give unmodified opinion? They disclosed everything honestly in the notes to accounts. That material uncertainty is there. And if I just give unqualified opinion, people may think company everything is fine. Auditor gave unqualified opinion, there is no problem for the company. But the thing is, I know in the financial statements, some note number 35, example, some note number 35, which is talking about material uncertainty related to going concern. The note number 35 is talking about material uncertainty related to going concern. Note number 35, it speaks about that going concern, such a very big issue. How do I know? Every shareholder read that. Company showed everything honestly, so I gave unqualified. I don't have any other option. I gave unqualified because they showed everything honestly. But how do I know? Every shareholder will look into that going concern point, such a severe issue, sensitive issue. So highlight it in audit report. What you do? Highlight it in audit report. Sir, how do we highlight, sir? Emphasis of matter paragraph. No, wrong. Not emphasis. For this purpose only, material uncertainty related to going concern paragraph is introduced in the audit report. Material uncertainty related to going concern paragraph is introduced in the audit report, and that particular material uncertainty related to going concern, that is what we are discussing. This is a highlighter para. This is not a qualification para, not a basis for qualification, not a objection para. This is just a highlighting para. We are just highlighting notes to accounts so and so point. Going concern material uncertainty, sir, please look into it. We are highlighting. Sir, we have emphasis of matter paragraph, no? We can highlight there, no? Array, it is not an ordinary para. It is not an ordinary something, ordinary important matter. It's not something just an ordinary important matter to highlight. It's a going concern issue. So I will highlight it specifically under material uncertainty. By the way, here one question can come in exam. Material uncertainty related to going concern para will arise in the audit report when the financial statements are not disclosing material uncertainty related to going concern. True or false? False. When financials are not disclosing, you will not highlight, you will give modified opinion, straight away qualified or adverse, and you will mention reasons in basis for qualified or basis for adverse. Sir, then when material uncertainty para will come into picture? When financial statements are honestly disclosing that situation. When financial statements are honestly disclosing that situation, and they are absolutely true and fairly reflecting company's severe position, they are reflecting true and fair view. You give unqualified opinion regarding that. And since financials are disclosing a very sensitive issue related to going concern material uncertainty, highlight it. Where do I highlight? In our emphasis of matter para, because it is a highlighter para? No, material uncertainty related to going concern. Look, material uncertainty related to going concern para will come in the audit report. Will come in the audit report only when auditor give unqualified opinion with respect to going concern. With respect to going concern, you don't have any objection. You are giving unqualified opinion. Only then this paragraph will come into picture. You are giving unqualified opinion with respect to going concern. Only then material uncertainty related to going concern will come. There is a material uncertainty. Financial statement discloses that uncertainty. You are giving unqualified opinion relating to that particular point. Then you can highlight it under material uncertainty related to going concern. Now I will show you Air India audit report. I will show you Air India audit report. Now you see, as soon as you open the Air India audit report, you will get little shock. This is Air India audit report for the financial year 1920. You see, material uncertainty related to going concern. They used the side heading, material uncertainty related to going concern. And you see, they gave qualified. Sir, how can they give qualified opinion and material uncertainty related to going concern? Just now you said, only when auditor issued unqualified opinion, we should use material uncertainty. What I said is absolutely right. Here, Air India auditors gave qualified opinion not relating to going concern matter. It is related to some asset valuation, some non-reconciliation, some asset related things, not related to going concern. Regarding going concern, they gave unqualified only. With respect to the qualification is given not with respect to going concern, but with respect to some other issues, some inventory valuation, some asset valuation issue, not with respect to going concern. Not with respect to going concern. So, with respect to going concern, what they gave, they didn't mention any qualification with respect to going concern. So, naturally, with respect to going concern, which opinion they gave? Unqualified only. So, and you see material uncertainty. The company has incurred a net loss of 77,000 millions. Okay, current liabilities exceeded current assets. Financial indicators, accumulated losses of 7,08,000 millions resulted in complete erosion of net worth. In spite of these events, which may cast significant doubt on ability of a going concern, management is of the opinion that going concern base is appropriate because of the continued support from Government of India. Having regard to other facts, please refer note number 53. In note number 53, they spoke about that. Our opinion is not modified. By the way, we are highlighting here, right? Are we modifying? Are we raising any objection here? No. We are not raising any objection. We are just highlighting the point which is there in the notes to accounts. Note number 53 of the Air India financial statements, which talks about material uncertainty. We are just highlighting here. We are not having any modified opinion. We are not objecting. We are not having any remark on this. That is what we are mentioning. Material uncertainty related to going concern, that paragraph presentation is exactly same as emphasis of matter paragraph presentation. That's it. Finally, another situation, what going concern, I may feel after evaluating further, first I do preliminary audit procedure, preliminary assessment, risk assessment, then I find indicators, then I will do further audit procedure, then I may conclude, yes, everything is fine. Reliance Industries, man, nothing going concern, they have surplus cash, everything. Going concern is appropriate. Management used going concern assumption. No material uncertainty, no inappropriateness, nothing, everything is excellent. I will also give unqualified opinion. When going concern assumption is appropriate, I give unqualified. When it is inappropriate, management prepared using going concern basis of accounting, I will give adverse opinion. Going concern is okay, actually affected, actually inappropriate, but they have future plan of action which is uncertain. So management chosen Air India, what they said, actually all these events have casted doubt on the going concern, but still Air India has prepared going concern basis as appropriate because of support from Government of India. So actually it is inappropriate. Material uncertainty is there. How long government support also, they don't know. Uncertainty is there already. But still they consider it as appropriate with material uncertainty which they disclosed. So since everything is disclosed honestly, auditor gave unqualified opinion regarding going concern. But then this is a sensitive issue, right? So auditor highlighted in the audit report material uncertainty related to going concern. After the premiere ends, rewatch it, this SA 570, especially the last 20 minutes of portion. I think so last 20 minutes of portion, you please watch it once again. That's it. So just 1 minute. Next, then SA 706. Another standard is SA 706. And now you know what? We have completed another paragraphs. We have completed another para. We have completed another para. Material uncertainty related to going concern paragraph is completed. So we know now when material uncertainty related to going concern paragraph can be used in audit report. We know now. Now let's discuss about emphasis of matter para. Let's discuss about emphasis of matter para, other matter para in the independent audit report. We are looking at contents of what? Independent audit report. Inside that, which paragraphs now we are going to read? Emphasis of matter paragraph, other matter paragraph we are going to read. We are going to study emphasis of matter para, other matter para. Now you see the standard heading. What is the standard heading? Emphasis of matter paragraph and other matter paragraph in the independent auditor's report. Emphasis of matter paragraph and other matter paragraph in the independent audit report. That is what standard heading. So SA 706 talks about two different sections of the audit report. One is emphasis of matter paragraph. Another section of the audit report is other matter paragraph. Another section of audit report is other matter paragraph. So what is emphasis of matter para? Emphasis of matter paragraph definition, if you see, no, it's a paragraph in the audit report. It's a section in the audit report or a para in the audit report that refers to an information appropriately, that refers to an information appropriately presented or disclosed in financial statements. That is presented or disclosed in financial statements, which in the professional judgment of the auditor of such significant to highlight it, to use it, to describe it here. In the professional judgment of the auditor, he feels this is very important information for the reader. So that particular thing is what highlighted in emphasis. What is emphasis dictionary meaning? Highlight. Emphasis of matter paragraph is a highlighter para. Emphasis of matter paragraph is a highlighter para. So what is, when emphasis of matter paragraph can be used? It is a para which is in the audit report which refers to some information. It is presented or disclosed in financials. How it is presented? Rightly presented, appropriately presented, not inadequately presented, not misstatemently presented. It is free from material. Appropriately means what? Free from material misstatement. Free from material misstatement means what? You have sufficient and appropriate audit evidence. That is the significance of the word appropriate. People mug up here. Emphasis can be used only when auditor when obtains sufficient appropriate evidence, only when there is no material misstatement, then only that matter can be highlighted under emphasis of matter paragraph. You are mugging up there. The word appropriately signifies that. Emphasis of matter paragraph is a paragraph used in the auditor's report which refers to an information presented or disclosed appropriately presented or disclosed in the financial statements. Appropriately means what? Free from material mistakes. Appropriately means what? You are having sufficient appropriate evidence that it is not having any material mistake. Only that matter you can refer in the audit report. You can highlight in the audit report. Sir, in notes to accounts, there is one disclosure, sir, related party disclosure. They gave wrong, sir. Can I highlight it under emphasis? Hey, when the related party disclosure is wrong, misstated, give qualified opinion, give adverse opinion. Why are you using emphasis of matter paragraph? Emphasis of matter paragraph is not a substitute for qualified modified opinion. Emphasis of matter paragraph is not a substitute for presentation or disclosure in financials. Whatever management has to disclose in financials, they have to disclose. There only, they can't use. Sir, dear Mr. Auditor, your emphasis of matter para, no, that para we will use, sir. Can we use? Can we give additional information there? No. Emphasis of matter paragraph is not a substitute for modified opinion, not a substitute for presentation or disclosure in financial statement. Sir, are we giving any separate opinion on this matter? No, we are not even giving any opinion. Then what is emphasis of matter, sir? It is simply highlighting some point, some information which is there in the balance sheet, P&L, cash flow note, SOC. SOC means statement of changes in equity. We are just highlighting that information. That is what emphasis. Sir, which information we can highlight? Any point we can highlight? No, check it. You can highlight any point provided it is appropriately presented. It is appropriately disclosed. It is appropriate. What do you mean by appropriate? Free from material misstatement. How do I know free from material misstatement? Get evidence. Get sufficient appropriate evidence. So So now we'll see. Just a minute. What I will do is in this part 3, I will only stick with emphasis of matter para. In part 4, I will cover other matter para SA 600 and 720. Three concepts I will cover in part 4 video. Now I will complete emphasis of matter. They may ask a straight question like this. What is the manner of presentation of emphasis of matter para? They may ask you a straight question. What is the manner of presentation of emphasis of matter para? You see the definition here. You see the definition here. What is an emphasis of matter para? Emphasis of matter paragraph is a paragraph included in auditor's report which refers to a matter appropriately, okay, presented or disclosed in the financials. Which one? That in auditor's judgment is of such important for which is fundamental for users understanding. Very important point, man. Everybody should read this. So that paragraph, is it related to going concern? Hey, if it is related to going concern, I have a dedicated para. Material uncertainty related to going concern, I have a dedicated para. There I will be using. Then which points I can highlight? Other than anything related to going concern. Other than anything that is related to going concern. Other than going concern, anything you can highlight related to notes. Provided it is true and fair, free for material misstatement, you have sufficient appropriate evidence. So what is the manner of presentation? What is the manner of presentation? I will show you ILFS audit report. By the way, Air India, did they use emphasis of matter? Let me check that. They used emphasis of matter. So why going to that extent? Emphasis of matter. What is the manner of presentation? See, emphasis of matter, they put in a separate section, separate side heading with a title clearly addressing that it is emphasis of matter. And draw attention to note number 29, note number 26, note number 49. See, so many points they have highlighted. And at the last, you see, this is a very important point. Our opinion is not modified in respect. Hey, shareholder, I'm just highlighting in notes, note number 26, note number 29, note number 42, note number 48. All these points you go and see. It is important. By the way, don't misunderstand. I'm only saying it is important. I am not having any objection on that point. I am not having any remark on that point. Our opinion is not modified in respect of the above matter. Dear Mr. Shareholder, don't misinterpret. That's why only I'm giving this. So emphasis of matter paragraph presentation manner is this. That is what given in the book also. So emphasis of matter paragraph. What is the manner of presentation? Include the paragraph in a separate section of audit report with a particular heading including emphasis of matter. Air India, how they presented emphasis of matter heading. Express the matter being emphasized, give reference to such matter in the financials, note number 29, note number 26, note number 49, giving reference, state that opinion is not modified. You see, our opinion is not modified. Auditors are saying very clearly, our opinion is not modified. And an emphasis of matter paragraph is not a substitute for modified opinion, not a substitute for financial statements, not a substitute for 570 material uncertainty, not a separate opinion also. We are not giving any opinion also. With this emphasis of matter paragraph is completed. With this emphasis of matter paragraph is completed. Okay, SA 570 we have done. SA 706 emphasis of matter paragraph is also completed. Actually, the image which I used, it says 706 and 600 also. But let me wind up the session because it's already 9:30 night. Okay, so we'll upload a recorded video or we'll take a live session depending upon my convenience. I need to check my timing also. So accordingly, I will take either a live YouTube session or I will just record the video and then upload the video. Until now, I hope you're convinced with respect to 570. I hope your logic, your doubt related to material uncertainty para, I think it is resolved. I hope you understood the difference between material uncertainty and emphasis of matter. Now, in our next part 4, I will talk about other matter paragraph. I will talk about other information paragraph 720. I will talk about SA 600. And then in part 5, probably part 5, I will talk about key audit matter. Then I will have a differentiation. Then we will discuss about differences between all this. Then by the way, what are the chapters I'm going to initially cover? Primarily in the marathon, primarily what I'm going to cover. This is very important thing. Primarily what I'm going to cover. I started with fundamental terms. Then audit reporting, approximately some 12 standards we are going to discuss. As I already told, audit reporting includes CARO, everything. Okay, then we are discussing about standards on auditing, where another some 13 to 14 standards I'm going to discuss, most important standards. Then mostly I will be discussing about either ethics I will start or corporate governance and audit committee I will start. Either of this I will start, but both I will cover in the marathon. Then I am going to cover peer review and quality review, peer review guidance, guidance on peer review 2020, latest amended one only we are going to discuss. Then we are going to discuss about PSU audit. Then we are going to discuss about bank audit. This is what primarily I want to cover, which will occupy minimum 60 marks weightage. Minimum, I'm telling you, it's only minimum 60, not even 60. These chapters will occupy 60 to 70 for sure. For sure. So this content which I wanted to cover in the initial tranche. Later, after we finish this content, depending upon the time availability, all that, I will cover the next part of the marathon. I hope you have got an overview on what we are going to cover in the marathon. That's it. I hope you're all satisfied now. You are getting clarity. Okay, part by part, your clarity on the subject will for sure increases. Okay, so carry on. So this is part 4 audit marathon session. Already 3 parts have already been completed. 3 parts were already uploaded. Again, I'm telling you, once we complete all the parts of the marathon, even I'm not sure exactly how many parts it will come, roughly some 17 or 18 parts will come approximately. Once all the 17-18 parts individually like this, once we completed, what we will be doing is, I will be doing a consolidation. I'll be doing consolidation of all the videos. I'll merge all the videos and put up one single file, so that whoever is watching later, for them it will be easy for having one video at one place. Now and also in that consolidated marathon, I will also keep timestamps also. For each and every topic, timestamps will be given, so you can easily click on the timestamp to revise the concerned topic. And now in the previous part 3 marathon, we have covered emphasis of matter paragraph. We understood what is emphasis of matter paragraph, and also we have completed 570 going concern at a glance. I mean, completely we have revised. And now there is still another paragraph which is pending, is other matter paragraph. In SA 706 we still have to discuss SA 706. So what is SA 706? SA 706 is talking about other matter paragraph. It is talking about other matter paragraph. Just 1 minute. See, there is a difference between other matter paragraph and other information paragraph. There are two different sections in the audit report. If you look at the contents of the audit report, we have two contents. One is other matter paragraph, another one is other information paragraph. Both are different. Other matter paragraph is dealt in the context of SA 706. Other information paragraph is dealt in the context of SA 720. So the both are completely different. And now, so SA 720 also we are going to discuss in the same section, in the same particular top part 4, because immediately as soon as we finish discussion of other matter para, if you understand other information, I think at the time of revision it will give you more clarity. Now, what is an other matter paragraph? If you look at the definition of other matter paragraph, now I'm not discussing other information. Once we complete other matter paragraph, then we'll be discussing other information. As per other matter paragraph, SCA 706, what is other matter paragraph definition? It is a paragraph in the audit report that refers to an information or disclosure, an information, or else simply that refers to an information other than, the word used is other than, that is presented or disclosed in financial statements. Other than that is presented or disclosed in financials. If you are referring to any other information, then we generally call it as other matter paragraph. If you look at the actual definition of other matter paragraph, it clearly says what is covered in other matter paragraph. You see, okay, what is covered in other matter paragraph? So what is it? Other matter paragraph is a paragraph that refers to a matter or information other than that is presented or disclosed in financials. In auditor's judgment, it is relevant for understanding of the auditor's responsibilities, or the auditor's report. If you want to make the user understand something additionally about the auditor's responsibility, audit report. More significantly, auditor's responsibility. Okay, if you want to clearly talk about auditor responsibility, something you want to talk about responsibility, then other matter paragraph is the only source. Sir, as you said in the previous sessions, we have a separate paragraph. No, this we already completed. Auditor responsibilities for audit of financial statements. We have a separate paragraph, right? Auditor responsibilities. Then why other matter paragraph once again talks about auditor responsibility? It is talking about other matter paragraph in audit report is talking about specific responsibilities of the auditor. It is talking about specific responsibilities of the auditor. Specific responsibilities. It is talking about specific responsibilities. What do you mean by specific responsibilities? Example, responsibility in case of joint audit, responsibility in case of branch or component audit. But joint audit related information, auditors are not giving in other matter paragraph. In the opinion paragraph itself, they are giving. State Bank of India, if you look at their opinion paragraph is having multiple parts. Generally, only two parts will have opinion paragraph. One is we have audited financials, that one. Second part is in our opinion, the actual opinion. But State Bank of India has given little more points where they are describing who are all the main auditors, who are all the component auditors, all the discussion they brought in the opinion paragraph itself. See, sir, can we do like that? Is there any prohibition? No, right? Since there is no prohibition, yes, you can do like that. But other matter paragraph is a paragraph where you can exclusively use it for discussion about how many branches were audited by branch auditors, how many branches were not at all audited, all that you can discuss in other matter paragraph. Now, since how to use other matter paragraph, since the discussion came about branch auditor, component auditor, let's now discuss SA 600. See, already in my channel, I have previously also uploaded some standard related videos, but which are of full length videos. But this is a revision. I only give it to you at a glance. I make you understand very broadly. Now you see there is a standard called SA 600. What is SA 600? Using the work of other auditor. Using the work of other auditor. Who is using the work of other work? Principal auditor is using the work of other auditor. Now you look at the SA 600. It has three definitions: principal auditor, other auditor, and it has a definition called component. It has a definition called component. 90% of the students don't understand these definitions. Without understanding these definitions, they think that SA 600 they understood, but which is absolutely wrong. Principal auditor means what? Other auditor means what? Component means what? What is a component? First of all, if you look at the component, it has 5 parts. Okay, branch, division, another one, continuation, what? Subsidiary, associate, joint venture. Subsidiary, associate, joint venture. So 5 parts are covered. If you look at the component definition, branch, division, subsidiary, joint venture, associate, whose financial information is included in the financial information audited by principal auditor. Who is other auditor? Other auditor is an auditor appointed for conducting audit of a component whose financial information is included in the financial information audited by principal auditor. Who is the principal auditor? Auditor appointed for conducting audit of financial statements of the entity which includes financial information being audited by other auditor. This much interconnected definition. 90% don't understand what is this. Don't worry, I'll make you understand. Branch and division, they are the definition of components. Branch and division are examples of component with respect to standalone financials. Subsidiary, associate, joint venture, they are also component, but not with respect to standalone financials. They are component with respect to consolidated financial statements. They are component with respect to consolidated financials. Now let's take one small example. Suppose you take State Bank of India. State Bank of India Limited, a classic example, best example to understand this concept. State Bank of India Limited is a listed company registered with the Banking Regulation Act, obtained banking license from Reserve Bank of India, operating across India, and even it is having approximately some 40 branches overseas. So what is the State Bank of India? State Bank of India itself is having some subsidiary companies, 30-40 subsidiary companies it has. In addition to that, State Bank of India Limited is having branches. State Bank of India Limited is also having branches. So what is the State Bank of India? State Bank of India is having subsidiary companies. By the way, State Bank of India is having subsidiary companies, right? Because they are having subsidiary companies, they have to prepare consolidated financials, and moreover, and on an annual basis, they have to prepare their own financial statements. That is called standalone financials. Now, State Bank of India is also having branches, approximately 23,000 branches they have. More than 23,000 branches, not ATM machines, branches. Okay, now out of these 23,000 branches, approximately 14,000 branches were not liable for audit. They were not audited. They were not audited because RBI has given certain guidelines for branches, which branches are liable for audit, which branches are not liable for audit. They have given certain guidelines. So 14,000 branches approximately were not liable for audit. Only 9,000 branches were liable for audit. 9,000 branches were liable for audit. And you know, these branch audits are, these 9,000 branches are audited by whom? Branch auditors. These 9,000 branches are being audited by branch auditors. Now, State Bank of India is also having, now you see, for these 9,000 branches, there are branch auditors who were recruited by the State Bank of India locally. Suppose if a branch is there in Hyderabad, so any practicing here who is there in Hyderabad is the stat auditor only. Branch auditor is also stat auditor only. Company overall auditor is also stat auditor only. And State Bank of India is also having a overall auditor, which we call it as principal auditor, whom we call them as principal auditor. And you know what? State Bank of India is having 14 principal auditors. 14 auditors they have, 14 different firms they have, and all of them are, we call, since more than 2 auditors were there, since 2 or more than 2 auditors were there, we naturally call it as joint auditors. Accordingly, SA 299 is also applicable. Accordingly, SA 299, suppose you take Punjab National Bank, they have 5 auditors. Suppose you take Reliance Industries, they have 2 auditors. Sir, is joint audit compulsory? For banks, RBI has given guidelines in 2021 April 27th, 2021, RBI has released some guidelines. Every bank which has more than 15,000 crores worth of operations, they must have a branch audit. Minimum 2 auditors, maximum 12. Earlier State Bank is having 14. Now upcoming year onwards only 12 auditors maximum. Only 12 joint auditors. And they have given eligibility criteria also for centrals. You know, actually for banks, principal auditor, we generally don't use principal auditor term in real life. We actually call them as statutory central auditor. We actually call them as statutory central auditor. In our upcoming marathon, not part 5, maybe later, bank audit discussion we will be going with. So at that time I will mention you what is statutory central auditor, all that more clearly. So State Bank of India has to prepare consolidated financials, standalone financials. Now you see the picture. Now you see. But State Bank of India is having 14 auditors, right? Let us assume in our example there is only one auditor. There is only one auditor. In real life 14 auditors. But let us assume only one auditor for the entire State Bank of India. What is this auditor has to do? He has to give an audit report on consolidated financials, and this fellow has to give audit report on standalone financials, both. He has to give audit report on consolidated as well as audit report on standalone. Now, what is standalone financials? Head office plus all branches, 23,000 branches, entire books of accounts, entire final accounts. If we merge, then we will get standalone financials. What is consolidated financials? You get standalone, right? Standalone financials of SBI Limited, that plus all standalone financials of all subsidiary companies, joint ventures plus associate companies. If we merge that, we will get consolidated financial statements. Now, who is principal auditor? Who is component auditor? From standalone financials point of view, let us assume State Bank of India is having Mr. A as a principal auditor. Mr. A is principal auditor from standalone financials point of view. All branch auditors are other auditors. Remember, all branch auditors are other auditors. We also call them as component. From standalone financials point of view, branches are components. From consolidated financial statements point of view, of course, the principal auditor is Mr. A only, because he is the one signing the audit report of consolidated financial statements. So Mr. A is only principal auditor. In addition to Mr. A, all subsidiary companies, joint ventures, associate companies, they will also have some auditors, right? All of them are actually called as other auditors. From consolidated financials point of view, subsidiary company auditor, associate company auditor, joint venture auditor, they are called as component auditors, and they are called as component. Okay, from standalone financials point of view, branch auditors are other auditors. Branches are components. Understand, that's how component definition has 5 parts. Now, what is a component? Component may be a branch, maybe a division, maybe a subsidiary, maybe an associate, maybe a joint venture whose financial information included in financial information audited by principal auditor. Now, who is other auditor? Other auditor is a person who has been appointed for conducting audit of financial information of a component which is included in financial information audited by principal auditor. Who is principal auditor? He is an auditor appointed for entity as a whole. Okay, which includes financial information of components audited by other auditor. That's it. These are the main definitions. Now, what SA 600 straight away starts with, Even though, see, branch audit reports and all we will not issue to public. Branch audit report is an internal document. We will not issue. It's a It's a 700 format report only. But it's also a statutory audit report only. But we will not be issuing to the public. Branch audit reports, what principal auditor has to do? Take the branch audit report, check the branch audit report, accordingly give his principal audit report. Accordingly give the principal auditor's report. Now you see, what is given by State Bank of India to public is only principal auditor's report, central statutory audit report, which is signed by 14 joint auditors. Only that report is being sent to public. Now 14 joint auditors are liable to give, nothing but principal auditors are liable to give opinion on entire financial statements. But did they audit entire financials on their own? No. 9,000 branches are audited by somebody. That audit report they received, based on the audit report they are giving opinion. Now if something goes wrong in the branch, who should be held responsible? Who bank should ask whom the questions? Not the principal auditor. With respect to branches which is audited by other auditor, branch auditor only answerable. Here there is a division of responsibility. Okay, accountability has been changed. Generally when we use work of internal auditor, when we use work of auditors expert, when we use work of management expert, when we use work of service auditor, SA 402, in all these cases I am only completely responsible. I am the auditor. I am 100% responsible. I can't even shift. But in case when I'm using branch audit report, when I'm using subsidiary company audit report, when I'm using associate company audit report, while preparing my audit report on standalone financials, while preparing my audit report on consolidated financials, I am not responsible if something is there wrongly in the component, because I have not audited the component. Then how did you give your opinion on the component also? Of course, you didn't give directly opinion, but you gave opinion on the entire company, which includes component also. How did you give? I gave opinion on the component only based upon their audit report, purely based upon their audit report, solely based upon their audit report. I am not accountable. I am not answerable. And that particular responsibility division you have to mention in other matter paragraph. That particular responsibility division you have to mention it in other matter paragraph. I hope now you understood what is other matter paragraph significance. Other matter paragraph, we mention some information, but that is not there in the financial statements. That is not given in the financial statements. That is not presented in the financials, disclosed in the financials. Suppose you want to give that information, you want to highlight something that is there in financial statements, or something presented or disclosed, emphasis of matter para. Something presented in financials related to material uncertainty related to going concern, para. Now I want to talk about something that is not there in the financials, where I can talk about other matter para. Specifically you can talk about auditor responsibility. What you are talking about? I am not responsible for the component. Yes, I only gave opinion on the overall company, but I am not responsible because component is audited by other auditor. He is also independent, he is also external, he is also statutory auditor. That's it. So this is where now you see the State Bank of India audit report. I will show you how other matter paragraph is being used. So this is the audit report of State Bank of India. You see here other matter paragraph. What are they saying? State Bank of India standalone financial statements. State Bank of India standalone financial statements or audit report. I'm showing you. We did not audit financial statements of 9,200 branches, okay, which are included in standalone financial statements, whose total assets reflect 30 lakh crore, liabilities revenue reflect 1,20,000 crore. The financial statements of these branches audited by branch auditors whose report have been given to us, and in our opinion, so far as it relates to amounts and disclosures in respect of branches, is purely our opinion is based on branch auditors. By the way, do I have any objection here? Our opinion is not modified. I'm just giving you information. This is how other matter paragraph. I will show you right now. State Bank of India consolidated financial statements. This one. Consolidated financial statements audit report on consolidated financial statements. So 244, you see this is consolidated financial statements audit report. This is audit report on consolidated financial statements audited by audited by State Bank of India, incorporated in these consolidation. We, along with 13, means total 14 joint auditors, did not audit financials of 9,000 branches. Branch related they have given already, which is already repeated. We did not audit financial statements of 27 subsidiaries, 8 joint ventures, whose total assets is 260 lakh crore, revenue is 69,000 crore. Okay, and these the opinion is purely based on the reports of other auditor. Who is other auditor here? Branch auditor? No. Subsidiary company auditor, associate company auditor, joint venture auditor. Whereas in standalone financials also we spoke about other auditor. Who is other auditor? There, branch auditor. Remember, company and branch both are one and same. But company and subsidiary company are not one and same. Separate legal entity. They both are two different companies. That's it. So that's about disclosure by auditors in other matter paragraph. Now when auditor is using which with this other matter paragraph discussion is over. SA 706 is over. Now there is a small requirement in SA 706. Okay, usage of emphasis of matter para, all that we discussed. Relationship between key audit matter, emphasis of matter, we will discuss once we finish key audit matter. When other matter paragraph in the audit report is used, if it is not prohibited by law and it is not a key audit matter, not prohibited by law, not a key audit matter, then you can give that information under other matter paragraph. Before you give emphasis of matter or other matter paragraph, what wordings you want to use in that para? Draft report, draft emphasis of matter, draft other matter para, show it to the top management. Get their consent. Is it okay? Then give it. That's it. So this is one precaution which standard is asking you to take. With this, SA 706 is completely done. Now next one is SA 600. Already 3 points have covered. Principal auditor means what? Other auditor means what? Component means what? Using the work of other auditor. Who is using the work of other auditor? Principal auditor is using the work of other auditor. Who is the principal auditor? Principal auditor is an auditor appointed for the entire company entity. Okay, other auditor is an auditor appointed either for the branch or division from standalone point of view, subsidiary, associate, joint venture from consolidated point of view. That's it. Now, what are the points as an auditor? Who has to, what points SA 600 says? What are the points that you need to check? So the standard straight away says the principal auditor would not be responsible in respect of work which is being allocated to other auditors, except if you have some suspicious, you got to know some suspicious information about reliability of work performed. Generally, we will not find this in our reality. When principal auditor has to base his opinion on the financial information of entity as a whole by relying upon statements and reports of other auditor, his report should clearly state division of responsibility where? Other matter paragraph. Yes or no? So definitions have given. Now, okay, acceptance as principal auditor. There are some points which you need to consider before you accept yourself as a principal auditor. See, this point is relevant once upon a time, not now. Now the appointment letter clearly tells you, are you a principal auditor or are you a component auditor? Earlier, sometimes no. Company, once upon a time, when everything is not that formalized, at that time, company will appoint 2 auditors for 2 branches, 2 auditors for another 2 branches. Let's assume company is having 4 branches, 1 auditor for 2 branches, another auditor for 2 branches. Now among these 2, who is principal auditor? So if you want to know you are a principal auditor or not, these are the points which you need to consider. Okay, but the situation generally do not come, and in the recent July 2021 exam, this question is asked for some 4 or 5 marks. In the recent July exam, 90% of the other books in the market do not have this point itself. I gave this material in May month itself. Okay, May 2021, and this point I included even in my regular class. I mentioned if the examiner want to ask you a strict question, a difficult question, he will test this, and that is what tested in July exam. Next. So, acceptance by principal auditor. The auditor should consider whether his own participation is sufficient so that he can become himself, he can call himself, he can act as a principal auditor for this purpose. Materiality of the portion of financials which you are doing audit, how much portion of financials is under your coverage, major portion is under your coverage, then you are principal auditor. Principal auditor, degree of knowledge regarding business, you are having most of the knowledge of the business, not other auditors. You are more knowledgeable about the company business, all that. You are the principal. These are all only criteria. So you can read this later. Now once you are a principal auditor, there are some procedures which you need to do. There are some things that you need to do. At a planning stage, you need to inform the other auditor, like how other auditor work is going to be used. Generally in real life, no, principal auditor will not have any discussion with the other auditor. by default, when other auditor and principal auditor is appointed, suppose you take State Bank of India, how it works, the State Bank of India central stat auditor, nothing but principal auditor, they will send a checklist, they will send a questionnaire to all the branch auditors by default. They have to fill it and then send it back. There is no express communication between them in real life. But what standard says, principal auditor may advise other auditors how his work is going to be used in the overall financial statements of the company. So at the planning stage itself, inform him in what direction he should work, all that. And you as a principal auditor, you know what are the peculiarities in the entire company. So inform the branch auditor, hey branch auditor, maybe this kind of risk might be there in the branch also. Please focus on that special considerations. Reporting. As a company auditor, I know what are the reporting applicable for this company. Suppose you take a small private company, a private company you take. I know whether CARO is applicable or not. Branch auditor may not know. He may not have the data. So I need to tell him what reporting requirements he has to comply. When he is giving audit report, what are the reporting requirements? IFC reporting is there. This one, CARO reporting is there. And principal auditor might discuss with other auditors a written summary. Okay, I may review a written summary of whatever, dear Mr. Branch Auditor, whatever work you did. Once send me a summary of it, a summary only. A written summary, you send me what you did, that's it. Or he may visit other auditor. I can go as a principal auditor. I have right to visit every branch of the company because I am the auditor who is giving opinion on the entire financials. Even though branch auditor is there, even though component auditor is there, nobody can deny me. I can visit there. Okay, that's it. And coordination, how there should be a coordination. If as a principal auditor, if I know some important point related to branch that affects the branch, I need to inform the branch auditor. Same way, I should tell the branch auditor, if you know something which is relevant at entity level, enterprise level, please let me know. We should properly coordinate with each other. I should tell my branch auditor, please complete audit early. Only if you give your audit report, I can give my audit report. I need to make him aware of how important branch audit, all that. So we should coordinate with each other carefully. Then suppose what if other auditor found some significant findings in the component, whatever he is doing audit, significant findings are there. Discuss with him what is that finding. Do a supplementary test if at all you are still doubtful. Okay, other auditor is saying this is very severe. Okay, you also got a doubt. You go and do a test once again. Document all that. What you need to document? Principal auditor, components which are audited by other auditor, significance of financial information, names of the other auditor, conclusions reached, components which are not material, which are not audited. Principal auditor should also document procedure performed and conclusions reached by him. That's it. And opinion. This is where many students again do get a confusion. SA 600 using the work of other auditor. Sir, how should we form opinion? How should we form opinion? Suppose case 1, sir, branch audit report, no, it contains adverse opinion, sir. Which means company auditor, main auditor also should give adverse opinion. False. See, at a branch auditor, he gave adverse opinion because whatever material mistakes he found at branch level, they are pervasive. At branch level, they are material. You know, the concept of materiality, the concept of pervasive. Okay, they both have to be applied based on your scope of audit. So materiality is decided based on your audit coverage. Branch you are doing audit, only at branch level you apply materiality. For a branch 1 lakh is material, but for company as a whole 1 lakh is immaterial. So branch auditor considers materiality pervasiveness at branch level and he gave adverse opinion. Now this report you got this report, branch audit report, sir. So that branch auditor gave adverse opinion. I will say the reason. 1 lakh amount only, immaterial, I will ignore. I will give unmodified opinion. So as a principle, see, 143 subsection 3 clause B. Clause C, 143 subsection 3 clause C. It's a checklist item. In that what clause C says, have you received audit reports of audit performed by other auditor? Okay, if so, have you considered it appropriately? They will ask you a question. 143, the reporting requirement. Sir, what is this? We'll discuss later. So you need to give an audit report this point. Have you considered branch audit report? Have you considered it? Yes, I considered it. He gave adverse opinion, but I felt it is immaterial as a company overall point of view, so I ignored. Okay, so just because branch auditor gave adverse opinion or qualified opinion, that doesn't mean you should also give modified opinion. They may ask you a true or false question, an MCQ. Branch auditor gave adverse opinion. Accordingly, principal auditor shall also give adverse opinion. But he gave an unqualified opinion. Accordingly, the company management said he is wrong. What is your answer? That is what you need to write here. Okay, if the other auditor issues, modified report, the principal auditor should consider whether the modification is significant in relation to entity. Yes or no? Is it requiring modification in the principal audit report? Consider that. where other audit report is other than unmodified, modified opinion. Principal auditor should document how he dealt with the qualifications and adverse remarks. If the other auditor work cannot be used, you express a qualified opinion. Arey man, this company is having other auditor and I don't have time to do audit of other audit of branches, but other auditor whatever work is there, company is not letting me to use, which is an exceptionally rare scenario. But if that is the case, give qualified or disclaimer of opinion. It may be either disclaimer or qualified because you are not getting evidence. No, that's it. So that's about SA 600. By the way, sir, can I refer in my audit report about other auditor? Yes, already I told you. Other matter paragraph we refer. So that's about other auditor. SA 600 is completed. Next. So that SA 600. Now simultaneously, let me take SA 299 also. SA 299 also I will take. Just 1 minute online. So what is SA 299? What is SA 299? Joint audit of financial statements. Joint audit of financial statements. What do you mean by joint audit of financial statements? Two or more than two auditors conducting audit of the entity. If the auditor, if company appointed, if an enterprise appointed two or more than two auditors, then it's a joint audit. So simple the definition. But look at the intention of the definition, concept of the definition. Joint audit means what? Two or more than two auditors appointed for the same entity, same scope, same financial year, under same statute. These are the four ingredients must present. Entity should be same, scope of work should be same, and it should be for the same period, and it should be under the same statute. What is your duty? What is my duty? What is your duty? Every one of us duty should be same, exactly ditto. Then only we will call it as joint auditor. What is the purpose of joint audit? Big companies, big enterprises, because the audit work will be so heavy, in order to have a sharing of work, in order to reduce burden on a particular auditor, they bring joint auditors. How joint auditors do the work? They divide the work and then execute. Joint auditors divide the work and then they do the work. Okay, how do they divide? They divide on a suitable basis, appropriate basis. They may divide based on time, they may divide based on items of financial statements, they may divide based on geographical structure. Okay, they may divide unit, they may divide work based on identified units. So what is time? Suppose two joint auditors are there. You do 6 months audit, I do 6 months audit. Items of financials, you do incomes and assets, I do expenditure and liability. Okay, based on geographical, you do north region, I do south region. Based on identified units, you do branch A, branch B, branch C, I will do branch D, branch E, branch F. So likewise on any basis they can divide. Okay, so branch auditors will divide the work and then do. But sometimes all works cannot be divided. Okay sir, fine, work can be divided on some basis. First of all, tell me about responsibility, sir. How joint auditors can share responsibility? As you said, they divide the work and then do it. Does it mean one joint auditor is not responsible for other joint auditors' work? Yes. The responsibility of joint auditors is joint and several. Separate responsibility is there, joint responsibility. Generally, several responsibility, separate responsibility. What is separate responsibility? In respect of work allocated to him. In respect of work allocated to him, or in respect of work allocated to other joint auditor. If the work is allocated to other joint auditor, then you are not responsible for his work. Sir, should I review his work? No need. He is also CA. He is also in practice like you only. So he is competent person. He will take care of himself, his work. You need not check it. He need not check your work, sir. What if you do wrong? You don't worry. You trust him. That's it. If something is wrong in his working, he is only answerable. So, in case of joint audit, when the work is divided and allocated among the joint auditor, each joint auditor is answerable, is accountable, is responsible only for whatever work allocated to him, not for the other works allocated to other auditors. No need to review also. But you said one more, sir, joint responsibility. Yes, there are some examples, there are some situations where combined responsibility is there, where decision on a particular point is taken by all of them, where work is not divided, all of them have executed. And with respect to presentation, disclosure of financial statements, always with respect to presentation and disclosure of financials, whether financials are complying with applicable financial reporting framework, whether financials are complying with accounting standards, framework related checking, all are responsible. Even though they divide the work, all are responsible. And with respect to audit report issued, so what is audit report issued? We issue each of one separate report. No. Joint auditors generally will come into a common conclusion and will give a common audit report. They will come to a common conclusion and give a common audit report. Sir, One of the joint auditor don't want to join, sir. Suppose State Bank of India, 14 auditors are there. One joint auditor, no, he felt completely negative about the company. He want to give adverse opinion. But we are 13, where we are saying unqualified opinion. Definitely that person should bound by us, right? No, a joint auditor is not bound by majority. A joint auditor do not bound by majority. Whoever disagree, he can give his audit report. In such a case, multiple audit reports will come, right? Multiple audit reports will come. If there is a disagreement between joint auditors, multiple audit report concept may come. Of course, till date it never repeated. Now you may get it out. Sir, what if two audit reports came? Public should believe which audit report? That's why basis for opinion paragraph is there. The person who gave adverse opinion or the person who gave a different audit report, he would have mentioned his reasons in basis for adverse opinion or basis for qualified opinion, right? He would have mentioned reasons, right? And those auditors who gave unqualified or qualified, whatever, they would have given their own reasons, right? Public will see both the reasons. They will take whatever the reason they want. That's it. You need not worry. But till date it never happened. Till date it never happened. Multiple audit reports on the same company by joint auditors never happen. Most of the times joint auditors will sit and resolve. Now there is another one. Now sir, okay sir, we understood very well. So now what are the special things which in respect of joint audit we should consider? You know, this is a very important thing. This is a very important thing. This reference is not required. That's a CA inter reference. The joint auditors, no, each audit firm partner will be there. Each audit firm team will be there. All of them shall be involved in planning. All the joint auditors shall establish overall audit strategy. All the joint auditors should develop a joint audit plan. While developing, identify division of areas and common areas. What are the common areas where all of us have to do, and what are the areas which each one of us separately have to do? Identify reporting objectives. Understand reporting requirement is different, reporting objective is different. Reporting objectives is mentioned in SA 300. Reporting requirements is mentioned in SA 700. Okay, in my regular class in audit strategy chapter for CA final, I would have covered what is the difference. Communicate significant factors with each joint auditor. Okay, so you should plan the audit in such a way, when I come to know some information about other auditors' work, I should communicate. He should also communicate. Coordination should be there. Consider results of preliminary engagement activity. What is preliminary engagement? SA 300 contains 4 points are there in preliminary engagement activity. SA 220 procedure, SA 210 procedure, relevant ethical requirement, communication with previous auditor. 4 points are covered as part of preliminary engagement activity. And not only that, each joint auditor shall do a risk assessment as specified in 315. Each joint auditor should discuss and document nature, timing, extent of common areas, specific areas. Every one of them. In fact, the common area, specific area, division of work allocation, all that. No, how many copies we will take printout? You know, n plus 1 copies. N number of joint auditors 14. 1 total 15 copies will take. Division of responsibility reports, we will take 15 reports. On all the 15 reports, all the 14 joint auditors will send. Why then 15, sir? Each one of us one report is for management. Tomorrow management has some query. Whom should they call and ask to clarify? So they look at the report. Okay, this area joint auditor B performed. I will call him and ask. For that reason, you have to give a management one report. That is what. And joint auditor shall obtain common engagement letter, shall give a common representation letter. All that. That's it. So that's about joint audit. So next, SA 720. SA 720. What is SA 720? Auditor responsibilities relating to other information. Auditor's responsibilities relating to other information. Recently, it is being tested frequently. Once in 2 attempts, a question is coming on this for 4 or 5 marks. So what is auditor responsibility related to other information? You see here, beautifully explained. What is other information? What is other information? First of all, right now I will show you State Bank of India audit report, annual report, 280 pages. 280 pages. 1 minute. Reliance Industries also I will show you. Reliance Industries 1819 annual report I will take. Reliance Industries 1819 annual report contains 460 pages. Do you think I am auditing all these 460 pages? No, I am only auditing financial statements and gave report only on the financials. Financial statements started on 268th page. 335 through 268th page and 433. Hardly 170 pages. Hardly 170 pages in the entire annual report is only belonging to financials. Only that I audited. And I gave audit report only of that. And company is sending to the public not just financials and audit report. Company is sending so much of other information. Some, you know, they are giving some key performance indicators, board of directors introduction, their business policies, their business segments related data. They are giving about company information. They are giving financial highlights. I have not audited this. I audited only financial statements. Financial highlights I didn't audit. So they're talking about so many other issues inside that company financial information also being mentioned. Now my problem, one document only, company sending 460 pages, one annual report they're sending. In second page, some revenue is there, 7 lakh crore. In my P&L revenue, 4 lakh crore. Are contradictory to each other. Shareholder will question, is auditor correct or management correct? Management says highlight is this one. Audited balance sheet, audited P&L says this is the amount. So which one is correct? Shareholders are having confusion. So the Institute of Chartered Accountants of India put a responsibility on you. What? Dear Mr. Auditor, I know you did audit well. I know you covered audit of financials, but you know one point, your financials alone are not being sent. Along with financials, some other information is also added. You please check how other information is correct or not. Is there any inconsistency? Is there any, look Mr. Auditor, along with the financial statements, a company is sharing other information in the annual report, just a minute. In the annual report contains financials as well as other information. Now, as an auditor, you need to check they are not inconsistent. They should be consistent. What is given in the other information, some financial facts and figures, what is there in the financial statements which is audited by you, certified by you, the facts and figures should be consistent, not inconsistent. If there is an inconsistency, please look into it and resolve it. Otherwise, public will panic. Otherwise, shareholders will panic. Internationally listed companies, these are so sensitive. So we cannot give a contradictory information. Your financial statements are 7 lakh crore turnover. Other information, key performance indicator, company showing 9 lakh crore. Shareholder immediately will get a question on this, which is correct. So please, you Mr. Auditor, first of all, tell me who is responsible for preparing other information? Management. Who is answerable if something is wrong in other information? Management only, not auditor. But the responsibility to ensure, the responsibility to verify whether other information is right or not is with the auditor. Okay, sir, what should I do? First, to do an audit procedure. For other information. What you do audit procedure? First, is there any material inconsistency between other information and financials? If there is a material inconsistency, consider whether there is a material inconsistency between other information and your knowledge. By reading annual report, you get to know so many things about the company. Already you know about the company. Is your knowledge is different from this knowledge? Remain alert. Okay, that other information not related to financial statements is materially misstated. If there is something wrong in other information, become alert. Okay. What and all auditor has to do? Just a minute. So what auditor has to do? Auditor has to read the financial statements, read the entire annual report, read the other information, and he will also read the financials which he has already audited. Check these two items. Now, auditor, if at all auditor identified inconsistency. Suppose if auditor identified inconsistency, sir, financial statements, other information contradicting to each other. At one particular amount, example, director's remuneration point is mentioned somewhere in the corporate governance report. Okay, that shows some amount, whereas in the profit and loss account, director remuneration point is some other amount, contradicting each other. If there is an inconsistency, what you need to do? First, investigate, discuss with the management about the inconsistency. Discuss with them. Try to identify which is correct, which is wrong. Is other information materially misstated, or is the financial statements materially misstated? Suppose other information only materially misstated. Ask management to rectify. Dear management, other information which you are giving, no, it is contradicting to financials. Financials are right. These are the proofs. Please change it. Management agreed. Changed it. Fine. Document it. Over. Suppose management is not ready to change it. Management did not change it. Sorry, sir. Other information, material misstatement is there. We don't change it. Let it be like that. I will give modified opinion. Absolutely wrong. Arre man, we give modified opinion when the financial statements are materially misstated. Is there a material misstatement in the financials? No. Material misstatement is there in the other information. Who am I to give, modified opinion here? Because modified opinion I can give when, look at the definition of modified opinion, SA 700. The auditor shall express modified opinion if, based on sufficient appropriate evidence, he concluded that financial statements contains mistakes which are material. Second, if auditor is unable to obtain sufficient appropriate evidence to conclude that the financials are free from material mistakes, only with respect to financials you can give modified opinion. Here, mistake is there in other information. So what auditor has to do? Management is not rectifying, no, nothing. In audit report, you have another para called other information para. In audit report, there is a paragraph called other information para. Look at the Reliance Industries audit report. I will show you how other information paragraph is there. 263 page. In Reliance Industries, they have given audit report. This is other information para. This is other information para. What do you mean by other information? There is a definition of other information. What is other information? Information other than financial statements and audit report. Other than financials, other than audit report, any point that is there in the annual report is other information. So in that para, auditor has to mention. What auditor has to mention? What auditor? The company board of directors is responsible for other information. Other information comprise of entire information given in annual report, but does not include financial statements and our audit report. Our opinion on the financials does not cover other information. Of course, we did not give opinion on other information. So we do not express any form of assurance on the other information in connection with our audit. Okay, why you are including this para, man? That's what. In connection with our audit, our responsibility is to read the other information, consider whether any information is materially inconsistent with the financials or our knowledge. If based on the work we performed, we conclude there is a material misstatement in other information, we are required to report the fact here. If there is a mistake, we are required to report. We have nothing to report in this regard. That's it. Reliance auditors found in other information there is nothing contradictory. If there is a contradictory, they need to report to you. But here nothing to report. That's what they said. So Reliance Industries Limited, the management maintained other information is correct, which is in line with the financial statements. That is what the auditors of Reliance Industries Limited mentioned. Now here one point is there. Sir, what if, sir, I prepared audit report, I gave financial statements, audit report, everything is over. Management not yet prepared other information. Moreover, company asked me, first you give audit report, sir, then we will give other information, everything. But as part of standard, as per SA 720, before I sign my audit report, in the audit report, other information paragraph, I need to give some information. Okay, before I sign that, I need to get what other information company is going to give. But company management said, sir, we have not yet prepared, sir. Okay, do one thing. Get written representation. Get a written representation that whatever other information they are going to give you, whatever other information that is going to given in the annual report, they make sure it is consistent. Get a declaration. Plus, ask management, dear management, once you prepare annual report, don't publish. First give me, I will have to see. Give a sign, give a declaration, give a promise that you will give me before you publishing. Get the declaration and give audit report to the company by mentioning that. Suppose after you give declaration, company gave you annual report, that annual report contains inconsistent information. And moreover, you know what the company did? They sent also. Now I know as an auditor, other information contains material misstatements, financials are correct, and company without my consent they sent it. Follow procedure given under SA 560. What is SA 560 procedure? I will tell you later. Next, one more thing. Sir, the mistake is not in other information. It is correct. Only after reading other information, I discovered a material misstatement in the financials, sir. If at all I didn't read that other information, I would have not detected. Only after reading that, I detected misstatement in the financial statements. Now what to do? Ask management to rectify financial statements. Give another audit report. A subsequent event procedure you will follow. Okay, but of course it is not a subsequent event. It's not related to absolutely subsequent event. Okay, so you just follow SA 560 similar procedure. Ask them to rectify. They rectified. Okay. If they did not rectify, give modified opinion. What? Give modified opinion. So that is what SA 720. If you understand the if you understand the content properly, the concept properly, when you read this, you will understand more beautifully. See, audit is not a mugging up subject. I'm telling you repeatedly. Never try to mug up the subject. Try to understand. Hardly there are 3 to 4 chapters in the audit where you may have to use your mugging up skills. What are they? Which one? Forensic audit, fraud investigation, due diligence. Okay, only these 3 chapters. Probably risk assess. That's it. Only these 3 chapters. Probably 330. Response to assessed risk. So there also test of controls related discussion will come so much. Most of that is not related to financial audit but operational audit. Okay, there you may have to apply your mugging up skills. Only these 4 places or 5 places, hardly. Nowhere in the entire subject of audit you require to mug up. You can understand very easily. You can have practical cases for everything. That's it. I hope everyone understood until now. So that's about other information. That's about other information in the auditor's report. So that is SA 720. So now until now, what are all we have covered? Just let me show you once. Let me see. I mean, let's discuss what else, what are all we have completed. Now you see what paragraphs we have completed. Other matter paragraph done. Other information also completed. Auditor responsibilities for financials also completed. Now you see, until now, from part 2 onwards we started part 2, 3, 4 until now. Title we understood. How to make a title in the audit report we understood. We are learning actually how to draft audit report, nothing but in the process of learning drafting the audit report we are learning all the concepts. So title, how to make, addressee, opinion, basis for opinion, material uncertainty is over, emphasis of matter over, other matter paragraph is over, other information is also over. And now let us finish key audit matter also. Let us finish key audit matter. Actually, as part of part 4, I thought of not covering key audit matter, but then since it's only 50 minutes, let's cover key audit matter also. What is a key audit matter? SA 701. SA 701. What is SA 701? You know, the heading of the standard, SA 701. Communicating key audit matter in independent auditor's report. Communicating key audit matter in independent auditor's report. Sir, what is a key audit matter? The definition, if you see the key audit matter, no, key audit matters are those in the professional judgment of the auditor were of most significant while conducting audit of the current year, and while conducting audit of current year. And key audit matter is not a substitute for disclosure or presentation, something you will get. Okay, so let us first understand what is a key audit matter exactly. First, before going into key audit matter, let us discuss what is opinion. It's an opinion on the financials. How many types of opinions? Unqualified, qualified, adverse, disclaimer. When will you give qualified? If the financials as a whole are right, 1 or 2 items are materially misstated, qualified. 1 or 2 items you did not get evidence, majorly you got evidence, qualified. Adverse, majority of the financial statements are misrepresenting, adverse. Disclaimer, for major items of the financial statements you are unable to comment, disclaimer. Okay, now emphasis of matter para. Sir, in the financial statements some important point is there, sir, note number. That is very important. When I'm reading the balance sheet P&L notes, I understood it is very important. I want somehow every shareholder should read this because it is useful for them. Then emphasis of matter para. Other matter para. Sir, branch audits I have not conducted audit, sir. Joint audit I am, it is moreover joint audit, sir. I am not responsible fully, sir. Joint audit is also there. Branch audit is also there. Subsidiary company audit is also there. They are only responsible for their work. Other matter paragraph. Auditor responsibility discussion. Other information, sir, along with my financial statements where I gave audit report, no, sir, along with that some other information is being sent, sir, as part of annual report. Other information, I need to check whether everything is right or not. Is there any inconsistency or not? That is other information para. Now, what is key audit matter? What is key audit matter? Name itself says important audit related matter. Important audit matter. What is an important audit matter? It's an important audit matter. When I am doing audit, no, I did audit for some 70 days, man. I did audit, let us assume 10 days in each quarter. Each quarter I went to the company, 10 days I did audit. Okay, when I'm doing audit, I faced some significant areas. I faced some significant issues. I faced some sensitive issues regarding which I discussed with top management. Remember the issues, special considerations, special attention. There are so many areas where my special attention would have required. Purchases, company changed software, sir. Procurement software they changed. Sales, billing system has been changed, sir, during the year. Accounting, ERP has been implemented newly. Okay, Reliance Industries Limited, 18-19 financial year, for 3 lakh crore worth of plant and machinery, 2,90,000 crore worth of plant and machinery, Reliance Industries, 18-19 audit report you take, 18-19 audit report you take, Reliance Industries Limited. The company has changed 2,30,000 crore worth of plant and machinery useful life, residual value changed, depreciation affected. Okay, so that's a very important area, sir. It's very big amount is involved. Okay, so Reliance Industries have changed Reliance Industries have changed 2.3 lakh, sorry, not 3 lakh, 2.3 lakh crore worth of plant and machinery related useful life, 2.3 lakh crore worth of plant and machinery residual values have been changed, sir. That's a very important big amount, sir. So I gave more attention on that area when I'm doing audit. And how I did audit, and that is what I'm giving in key audit matter, sir. In key audit matter, I'm not giving any related to, I'm not highlighting anything related to the presentation disclosed in the notes to accounts. I'm not highlighting anything. In key audit matter, I'm not talking about going concern issues, sir. In key audit matter, I'm not talking about auditor responsibility related to branch audit and all. Then what you're talking in key audit matter? What is there in the key audit matter? That's what, sir, I'm doing audit now. When I'm doing audit, let us assume I did 100 points I covered, sir. In audit, 100 things I worked. 100 areas are there on which I applied audit processes. Out of 100 areas, 10 areas are there, sir, which took my lot of time, lot of energy, where I gave more attention. All these 10 matters, no, sir, I frequently communicated with the top management of the companies. That much big important matters. Okay, out of these 10, I just want to share with the shareholders 5 matters, sir. I just want to share with shareholders 5 matters, sir. What you want to share? I just want to tell them I have done so much of audit, out of which there are 5 matters which are key audit matter. And shareholder, how I did audit it, that also I want to tell the shareholders. I want to tell the shareholders what is the key audit matter, how we addressed in our audit. What is the key audit matter, how we addressed in our audit. Indirectly, dear Mr. Auditor, you want to say how you did audit process. That's what? Yes, exactly. Are you giving any opinion here? No, sir, I'm not giving any opinion. I'm not giving any opinion. Are you giving any additional presentation or disclosure in relation to finance? Sir, presentation disclosure is management duty. Key audit matter is not for that. Are you giving any objections here? No, sir. When I have to give objection, it is under modified opinion paragraph. Then what are you giving? What are you giving here? That's what I'm saying. I'm just talking about important issues I faced in audit. Important issues I faced in audit. How I verified them, how I conducted audit. So you want to demonstrate your audit knowledge? Exactly. Yes, exactly. I just want to demonstrate my audit skill. I just want to demonstrate how I do audit of various things. So wherever there is a significant transaction happened during the year, wherever an area where high risk is involved, or wherever significant judgments are involved relating to that areas, I am picking out, sir, and I'm just explaining here and how we audit. That also I'm explaining. Suppose you see, sir, Reliance Industries key audit matter. The company 2,30,000 crores worth of plant and machinery, useful life has been revised, residual value has been revised. Accordingly, it's a key audit matter. What we did in our audit processes include: we evaluated assumptions used by management for estimating useful life. We verified economic useful life. We even obtained a technical valuation expert report SA 620. We understood whether the impact of because of the change has been properly accounted. We also checked disclosures made by the company in this regard. That's what everybody checks. That's what I also checked, sir. I just want to tell this here. That's it. Now here, are you giving any opinion? No opinion. Are you raising any objection? No objection. Are you highlighting anything in the financials? No, nothing. Then what are you giving? What is key audit? What is important according to me? I spent 70 days or 50 days in the company when doing audit. There are some points which I felt important. What is that important point? How I worked on it. That's it. I am just sharing my work experience on a particular important aspect. That is what key audit matter. Sir, in key audit matter, auditor can only talk about matters that are related to financial statements. No, there is nothing such. There is nothing such. You can talk about anything in key audit matter, provided it is there as part of your audit. You spend suppose company implemented new software. Until earlier, they used to follow Tally, a normal small ERP package. Now company implemented a very big SAP platform. Okay, SAP platform they implemented completely. So as an auditor, I am also new to SAP. So I have to first spend some 1 week to 10 days on training for SAP. Company only gave me. We discussed so many issues with the top management directors, all that for learning SAP, adapting with SAP. That itself is a key audit matter. Yes, absolutely. Key audit matter not necessarily related to financials. It may be related to other than financials also. Key audit matter can be other than financial statements also. What is key audit matter? That matter which caught my attention, man. That's it. In my entire audit, whatever caught my attention, that's a key audit matter. That's it. No, nothing. No more further discussion. It caught my attention. Yes, that's a key audit matter. You know, in Europe, this company is there. In Europe, there is a company, TDC Group. This is a company incorporated in Denmark, which prepares financial statements as per Danish Financial Statements Law, Danish Financial Statements Act. Okay, parent company financial statements. Just a minute. Consolidated financial statements. Wait, what happened? So here, independent auditors report. So you see, this is an independent audit report. Independent audit report. Okay, given by auditors of TDC Group in respect of the company TDC. So independent audit report, same title. They are also using key audit matter. They spoke about revenue recognition. They spoke about revenue recognition. So billing environment, some billing environment has been changed. The billing environment has been changed. Billing process is changed. How does it affect financial statements? Billing process is different. No, of course it's a control. So key audit matter can be related to an item belonging to financial statements, affecting financial statements directly, or it may be something indirectly affecting the financial statements. Anything can be key audit matter. In United States, Alphabet, America. Okay, in United States, Alphabet, this is Alphabet audit report. This is Alphabet audit report. Alphabet is nothing but Google's holding company. You know, in America it is called as critical audit matter. In America it is called as critical audit matter. So what is the okay, financials and audit report? This is report of ENY, independent registered public accountants firm. So they use the word critical audit matter. Same like India, opinion, basis for opinion, critical audit matter. In India we call them as key audit matter, key audit matter. Okay, critical audit matter. What are the critical audit matter? What is the matter? How they addressed in the audit. Same way we are also mentioning. You take Reliance audit report. You take Reliance audit report. You see, key audit matter, key audit matter, key audit matter, how our audit addressed. Okay, you see Alphabet, what is description of the matter, key audit matter, how we address the matter. Okay, you take TDC Group, you take TDC Group also. So they also give the same way of presentation. Key audit matter presentation is universally same. You see here, key audit matter, how they addressed the key audit matter. Key audit matter means what? Now let's come back to the discussion actually. What is a key audit matter? Now let's focus on the discussion. What is a key audit matter? See, never try to mug up. Understand what is a key audit matter exactly. You need not even try to remember. If you understand well, you need not remember. What is a key audit matter? Key audit matters are those matters in auditor's professional judgment were of most significant in audit of financials of current period. You see Reliance Industries audit report, or you see Europe foreign company audit report itself. Foreign company, key audit matters are those matters in our professional judgment were of most significant for while conducting audit of the current period. You see, key audit matters are selected from matters communicated with those charged with the governance. And by the way, you see Reliance audit report also. How they gave key audit matter introduction. How they gave key audit matter introduction. Key audit matters are those in our professional judgment were of most significant in our audit. These matters were already addressed in the context of our audit and in forming opinion thereon. By the way, we do not provide a separate opinion on these matters. That is what given in our book also. Key audit matter is not a separate opinion. Key audit matter is not a separate opinion. Is not a substitute for disclosed in financials. Is not a substitute for modified opinion. Is not a substitute for going concern material uncertainty reporting. It's not a separate opinion. Sir, then what is key audit matter, sir? Simple. There I am just explaining how I do audit. How I do audit of some important areas. Instead of taking a silly area, how I resolved, take a complicated area and how you resolved in audit. Explain that. That's it. So that's about key audit matter. Key audit matter is not compulsory. Emphasis of matter is not compulsory. Other matter paragraph is not compulsory. But key audit matter, no, it is applicable for listed companies. For listed entities, as per the institute guidances, it is always advisable to include some key audit matters in listed entities, or where there are any circumstances auditor decided to communicate key audit matter, or if there is a requirement under law, communicate key audit matter. And you know what, second, what most important, when the auditor disclaims the opinion, when the auditor is giving disclaimer of opinion, SA 705 prohibit communicating key audit matter. When you are giving disclaimer of opinion, you are prohibited to give key audit matter. And one more point I would like to tell you, when auditor gave adverse opinion, when auditor is expressing adverse opinion, emphasis of matter paragraph is also prohibited indirectly. Emphasis of, what is emphasis of matter? Financial something is there. You are highlighting here. Below that you are mentioning, we don't have any objection on that. What is adverse? Financials are not true and fair. In emphasis, you are saying we don't have any objection on that, contradictory to each other. No. So what the institute research committee says, whenever auditor gave adverse opinion, it is advisable not to give emphasis of matter para. What SA 705, 701 together says, when auditor gave disclaimer, key audit matter do not come. Why, sir? What is disclaimer? Unable to give opinion. Why? No audit performed. Why? Evidence have not given. When there is no evidence, when there is no audit, when you are not giving opinion, when there is no audit itself, where is the question of important audit? I did not do audit at all properly. I did not cover entire audit. Because of that, I am not giving opinion. I am giving disclaimer. Where did I conduct audit? If I conducted audit, I can identify what is important in that. I did not do audit itself. So the question of key audit matter do not arise. Now, sir, how do we select key audit matter? Generally, it's a matter of professional judgment. You may select it from the area where risk is involved. Europe company, TDC, billing group, risk based. Significant judgment. Reliance auditors have selected key audit matter based on accounting estimate which involved significant judgment. Why significant judgment? Because the amount 3 lakh crore. Significant event or transaction. Reliance Industries invested in some company. That is also taken as key audit matter because it's a significant transaction. So any of this you can take. So examples of what are all examples that can come under key audit matter? You may talk about impairment, you may talk about provisions, you may talk about valuation, you may talk about revenue recognition, you may talk about taxation matters, you may talk about asset revaluations, whatever. And there are some points which you should not communicate. Not communicate as key. See, it's not a prohibition. Key audit matter concept itself should not come when you give disclaimer. Sir, I have not given disclaimer, sir. I gave some unqualified. I gave some qualified. I gave some adverse opinion. But there are some points, sir, which you should not give key audit matter. You should not give them as key audit matter. These are the precautions you have to take. Where law prohibits such a disclosure, that particular matter law is prohibiting. Company want to issue bonus shares in next year. Now you want to, show that through key audit matter. It's a prohibition. The auditor determines communicating will bring adverse consequences. If I communicate that matter unnecessarily, it will bring unnecessary questions. People don't understand. First of all, shareholders do not have that much maturity or knowledge to interpret the key audit matter properly. So they may not understand. If the auditor considers that the matter is highly confidential or sensitive at the interest of the company, it's a sensitive issue. It's a confidential issue. Let us not discuss about that matter in the, key audit matter section. These are the 3 precautions. Prohibition under law. It will bring adverse consequences, or that matter is confidential to the company. Let us not discuss. Of course, I spent on that significant time in audit. I gave so much of attention, but still I will not discuss. If that point which I want to communicate as a key audit matter falls into any of these 3 categories, with this key audit matter is also completed. I hope you thoroughly enjoyed what is key audit matter. I hope you enjoyed. Okay, so what are the points that we have completed? What are the paragraphs that we have completed? Still learning audit report is not yet over. Still audit report preparation we have not yet completed. We are only understanding one by one segment of audit report. I don't know, until earlier you would have understood as a standard. Now I hope you are understanding all these concepts as techniques for preparing audit report. So we understood how to draft a title in audit report. We understood whom to address the audit report. We understood how many different types of opinions are there, how wordings of opinions will come. We understood how basis for opinion paragraph shall be drafted in audit report. When this material uncertainty will come in audit report, we understood. Key audit matter we understood. Emphasis of matter we understood. Other matter para we understood. Other information we understood. Now you see Reliance audit report. Now you see Reliance Industries audit report. We know how opinion paragraph will come. We know how basis for opinion will come. When key audit matter will come, we know. Okay. We also know when this other information paragraph will come. We know what is responsibilities of management. We know what is responsibilities of auditor. How this, and we know how other matter paragraph can be used. See, that's what. And we also finished auditor responsibilities for audit of financials. Responsibilities of management. So what about this? Responsibilities of management point, I will discuss it SA 210 in our upcoming parts when I'm discussing standards marathon. So at that time I will discuss about responsibilities of management. Don't worry. Now the pending part in the audit report, pending major part is report on other legal and regulatory requirements. Report on other legal and regulatory requirements. Report on other legal and regulatory requirements. Example, CARO, all that. I ask this question, student, sir, I'm very good in audit. I'll ask him one question. You know CARO? Yes, sir, I know CARO, sir. Where it will come in the audit report? Silent. So students are only trying to understand sentences. They are not understanding concept. You know CARO, you know there are 16 clauses, you know 2016 is a 2020 is there, but you don't know where it is used. Pity. After you become a chartered accountant, if you don't know how to prepare an audit report, industry is laughing at you. You must be commendable at audit. Who said audit is a theory subject? If you don't know how to decode, can you classify it as a theory subject? Just because you don't know the subject, just because you didn't understand, or just because you are misguided by somebody? I always tell auditing is the most practical subject. I will stand on it always. So report on legal and other regulatory requirements. This paragraph will discuss in our upcoming part of the marathon. So continuation. Okay, it will be there in the next session. It will be there in the continuation session. That's it. So there I am going to talk about report on other legal regulatory. You know what? In this 143 subsection 3 is there. Recently 4 matters were added in this. Amendment is there. But amendments I'm not covering right now. Once we finish entire marathon, we will have a separate session on the amendments in audit. So for better discussion, first revise with your existing knowledge with this existing marathon, then amendments will be discussed in detail. That's it. Then signature of the auditor. Auditor shall sign. Place of the signature. The place of signature will be usually the place where auditor signs the report. The city where you are sitting and signing, that city name you can mention. Date of the audit report, you have to mention the date in the audit report. That date shall be on or after approval of the financial statements. Date of audit report must be on or after approval of financials. 134 section also says that auditor shall date the audit report after or on the date of approval. Only once the board of directors approved the financials, only after the date you should give audit report. Why? Only approved financials are being issued to the public. Only on those financials which are issued to the public you are giving audit report. Then UDIN number from 1st July 2019, we have to mention UDIN. UDIN is like a digital signature, equal to digital signature. Earlier, if you know my membership number, you take a new stamp, go to the stamp vendor, pay 30 rupees, you will get a stamp. Stamp it, my signature, forge it. People think that I only signed. But today it is not possible, because today my signature don't have validity. UDIN number has replaced my signature. Of course I sign it, but my signature has a validity only when there is a UDIN number, unique document identification number, 16 characters number. So institute has a separate website, UDIN ICI. So there is a website like this, UDIN. So we have to log in here. I have my user ID, password and login. Whenever tomorrow I am signing the one audit report of a company, one tax audit report, GST audit report I'm signing, what contents are there in that report? Okay, I will mention all that content, and then I will generate OTP. I will get a number. That number I will put on that. Only then the document is valid. Otherwise the document is invalid. Sir, what if company went and submitted to bank with your forgery signature? Bankers are already given instructions by institute. Please accept any report only if UDIN is there. If there is no UDIN, don't accept. When banker got one document with UDIN number, what banker will do, here verify UDIN. He will come here. Okay, he will enter his name, OTP, all that, enter UDIN number, all that, send OTP, proceed. So here our banker will get, okay, who signed? So and so person signed, this amount is there. On this document, how much amount is there? He will cross verify. That's how UDIN is protecting forgeries, all that. It's a prevention of forgery, administrative power. It's an administrative, control which has been brought by the institute. So very good concept, UDIN is. So you see, we now completed what is UDIN, date of audit report, place of signature, place of signature and signature of audit report. All the contents we covered except one content, report on other legal and regulatory requirement. Only this is pending, and this itself takes another 1.5 hours. CARO, all that we need to discuss. Okay, so what is report on other legal and regulatory requirement? We'll discuss in the upcoming marathon, upcoming part, continuation part. Okay, carry on. I hope you thoroughly enjoyed. So this is part 5 marathon session. Already 4 parts we have completed. In part 1, fundamental terms, in order to proceed with the audit subject we understood. And part 2, 3, 4, we discussed about 8 reporting standards. We discussed about SA 700, SA 705, 706, 720, 299, 600, 570. So these standards we have covered, approximately some 7 or 8 standards we would have covered. So you see, like we started part 2, part 3, part 4, we are about to finish how to prepare the audit report. In preparation of audit report, in learning about preparation of audit report, all the parts of audit report we have completed. As I mentioned earlier, in audit report we are having totally 16 parts, out of which all the parts completed except this part. Which one? Report on Now we are going to discuss about report on other legal and regulatory requirements. Report on other legal and regulatory requirements. So this section of audit report now we are going to discuss. Before that, by the way, what I have not covered in marathon, I just want to highlight you, few points. With respect to SEA 700, with respect to SEA 700, 705, we only discussed about the definitions of unmodified opinion, modified opinion, various like unqualified, qualified, adverse, disclaimer, when it will come, when it will not come, wordings of that opinion, all that we have covered. What we have not covered is in SEA 700, objective of SEA 700 we have not covered. Specific evaluations to be made by auditor with respect to financial statements before expression of opinion, that we have not covered. Qualitative aspects of entities accounting practices we have not covered. SEA 705, coming to SEA 705, what we have not covered in marathon, okay, is what is the definition of pervasive effect we have not covered. How basis for opinion paragraph in different situations of modified opinion will change, that we have not covered. Okay, but whatever conceptually for you to learn the subject, with conceptual clarity, whatever is necessary for you, that we have covered as part of the marathon. Now if you check whatever audit report contents, if you check, we understood almost each and every section of the audit report, and now what is pending is report on legal and regulatory requirements. Report on other legal and regulatory requirements. Report on other legal and regulatory requirements. So what is this report? Many students, what I observed, I already told this point, but once again I'm repeating, what I noticed in many students is they prepare entire auditing, but they don't know how to draft an audit report. Now I think by completing this particular section, now you will be understanding how to draft an audit report in different circumstances, depending upon the situation, depending upon the conclusions reached, how to draft the audit report. I think you will get that particular command on this. Okay, report on other legal and regulatory requirements. We don't have any regulatory requirement. Only for bank there is a regulatory requirement from RBI to report certain items. Okay, but what we have is we are having generally for a company there are legal requirements for the auditor to report on certain matters. What are they? There are three sections: 143 subsection 1, 143 subsection 3, 143 subsection 11. There are three sections in accordance with which auditor has to give certain report. You see today, audit report is not just about opinion. Audit report is not a boring document. Audit report contains opinion, why he gave that opinion, basis for opinion, material uncertainty related to going concern, important matters in financial statements, emphasis of matter para, important audit issues, how audit is resolved in the audit, key audit matter, responsibilities of branch auditor, other matter paragraph. How about other information in the annual report? That paragraph is there. See, audit report is so much informative. Now with this particular section in the audit report, it is becoming even more informative. 143 subsection 1, there are 6 inquiries on which auditor has to give his opinion. There are 143, there are 10 checklist items where auditor has to give his opinion. In this checklist item, there is a checklist item called J. Inside that, 3 new clauses were added, not 3, I think 4 new clauses were added. Okay, that's an amendment applicable for the first time for November 2021 exam, December 2021 exam. And 143 subsection 11, CARO 2016. We all know that for December exams of 2021, CARO 2016 is only applicable, not CARO 2020. So, like, I ask this question whenever some students ask me a doubt on CARO, or whenever he asks me, sir, how to study audit, being a theory subject, it's a boring subject. I ask him this question, where do you think CARO will come in audit report? He don't know the answer. Most of the students I ask this basic question, they don't know the answer. That's how they learn audit. That's how they're learning audit. They think audit learning means sentence learning. No, sentence learning is different. Conceptual learning is different. I think by this time you would have experienced in the past 4 parts, you would have learned how beautiful the subject of auditing, how interesting the subject of auditing. So CARO 2016 will be given as part of audit report. It's part of audit report, not extension to audit report. It's part of the audit report. In which section of the audit report it will come, sir? It will come in the 12th section of the audit report. Report on other legal and regulatory requirements. Inside this audit report, inside this section, CARO points we will mention. But what we do is, since CARO points are so many, we don't mention in the main audit report. We will put a annexure 1, refer annexure 1, refer annexure 2. Like that, we will give an annexure to the audit report. Annexure is not a separate report. It's a part of audit report. It is like your additional sheet in examination. So like that we are giving CARO. Now all that CARO 143.3, 143.1 checklist, all that we are going to discuss. And by the way, I told you there is an amendment on this, right? That amendment we are not going to discuss as part of revision classes. All amendments we are going to discuss after we complete the revision classes. Once revision classes uploading is done, I will make a separate video for 1.5 hours where we will discuss only about amendments. Yes, in entire auditing, except physical loss, amendments discussion will hardly take 1.5 hours. And what I noticed from some student is, sir, please do a marathon on physical loss. Sir, please do a marathon on NBFC insurance. No, it is not possible. Once again, I'm clarifying you here. What are the chapters I'm going to cover? Right now, I'm clarifying you what chapters I'm going to cover as part of marathon available for public in YouTube. For my students, I'm going to give 100% revision lectures for all the chapters. But for YouTube upload, what I'm going to do is, I'm going to do fundamental terms completed, audit reporting is over, standards we are going to discuss, ethics we are going to discuss, peer review, quality review we are going to discuss, bank audit, PSU audit. So these are the main things which I'm going to discuss, and of course audit committee and corporate governance. Only these roughly some 8 to 9 chapters on I'm discussing, which will occupy approximately 60 marks of the weightage. 60 marks of the weightage. And what I sincerely suggest every one of you, audit under physical loss, whether it may be direct taxes or indirect taxes, it is 200 pages. Audit under physical loss is 200 pages. And students spend so much on that particular physical loss learning, approximately 30-40 hours he will spend for 10 marks weightage. What I suggest for you, ignore physical loss. Focus on PSU audit, bank audit, consolidated financial statements audit, risk assessment, audit in automated environment. All of that together, the weightage is 25 to 30 marks. Okay, instead of spending the time on physical loss, spend it on these 5 chapters, you will get more marks. Be clear, be strategic, be clever. Okay, your smartness should not only be there in terms of understanding, your smartness should also be there in terms of planning. Both should, coincide in order to get success in an unimaginary way. That's it. So now let's discuss without wasting further time. So report on other legal and regulatory requirements. This is one section in the audit report which talks about 3 sections in the Companies Act, 143.1, 143.3, 143.11. We are now discussing 143.11, which talks about CARO 2016. Currently it is CARO 2020, but previously it is CARO 2016. I am not talking applicability of CARO because applicability of CARO is a silly topic. Every one of you can understand. CARO is applicable to all companies, including foreign companies, except banking company, insurance company, section 8 company, dormant company, small company, private limited company, subject to 4 conditions. All 4 conditions should be satisfied. It should not be a holding or subsidiary of a public limited company. It should not have, the paid up capital and reserves and surplus together shall not exceed 1 crore on the balance sheet date. And third one, the aggregate of loans and borrowings from all banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. The turnover calculated as per Schedule 3, including revenue from discontinuing operations, shall not exceed 10 crore. Only a private company which satisfied all the 4 conditions, CARO is exempted. If any one condition failed for private company, CARO is applicable. So this is applicability part. On applicability, how to calculate reserves, how to calculate loans and advances, how to calculate loans and borrowings, how to calculate turnover, they have given some guidance on that also. So that is what applicability related to CARO. By default, CARO is applicable for all companies by default. If CARO is applicable for the company as a whole, even if there is a separate branch auditor, the branch auditor also shall prepare CARO report as part of his audit report. Further, sir, is CARO applicable on audit of consolidated financials? Sir, I'm an auditor of a company where this company prepares consolidated financials and standalone. So naturally, I have to give audit report on consolidated financials and standalone financials. Should I give audit report? Should I give CARO? Should I report CARO points also on consolidated financials as well as standalone? No, only on standalone CARO is applicable. With respect to audit report given on consolidated financials, inside that audit report on legal and other regulatory requirements, CARO will not come. That's it. Now, what are the clauses? I notice what many students is, they know all the 16 clauses. They have mnemonics, they have shortcut codes to remember all the 16 clauses. But what they don't remember is inside the content. And what is asked in the exam is inside content, not the 60. Tell me 16 clauses. Take 5 marks. No examiner will ask this question. They'll ask you, tell me reporting requirements for CARO with respect to fixed assets. Tell me reporting requirement in CARO with respect to fraud. There is a guidance note on fraud. Only if you read that guidance note on fraud, then only you can answer that particular question. Tell me reporting requirement for Nidhi company. Tell me reporting requirement for related party transaction. That's how in examination they'll ask. They will not ask you, tell me all the 16 clauses. I challenge, find any YouTube video that is available in the market. They only focus on how to remember 16 clauses. What is the shortcut code for 16 clauses? I am not blaming them. I am blaming the system. Because you are being attracted to diagrams, you are being attracted to colorful charts, you are being attracted to something. Shortcuts. And resultantly you're feeling the paper is tough. Never follow shortcut. Why? To that extent, I have smart notes. Actually, I have developed a thing called smart notes, a colorful notes. But my smart notes is not a short notes. It's a lengthy notes only. It's a lengthy notes only. I never use any diagram. You see, I am explaining from the bare text. Where did I use any diagram here? For hardly 1 or 2 cases. I explain entire content from the bare text because you have to ultimately write in the descriptive method, narrative method. Okay. Flowcharts also you can follow, provided flowcharts do not ignore descriptive, whatever the description, whatever is there for that particular paragraph, it will not ignore. That flowchart technique you can follow. Normal flowcharts, drone charts, there are so many that are being circulated, 100 pages audit book. If you take that, you will also get the similar marks only. You will not get full-fledged marks. Okay, always follow the right approach, always follow the right system. You will never fail in that. If you follow shortcut, success is doubtful. If you follow correct approach, see, I'm not asking you to do hard work. I'm asking you to do right work. Fine. So CARO 2016, there are totally 16 clauses. There are totally 16 clauses on which auditor has to report. There are totally 16 clauses on which auditor has to report. I am going to cover few clauses, at least some 10 or 11 important clauses I'm going to cover. So what are the 16 clauses? What are the 16 clauses in the CARO? Okay, 1 minute. Just a minute. I think I have covered CARO 2020 here in my booklet, but CARO 2016 also there. Just a minute, I will open CARO 2016 also. Be online. Yeah. So matters to be communicated as per CARO 2016. So what are the points? The first and foremost thing that auditor has to talk about in CARO report is fixed assets. What is it? Fixed assets. What auditor has to talk about fixed assets in CARO? What auditor has to talk about fixed assets in CARO? There are 3 issues which Companies Act is asking you. Dear Mr. Auditor, you are giving audit report, right? In the audit report, there is a requirement called CARO. Inside that CARO, there is a requirement for fixed asset. First clause, with respect to fixed assets, you have to give 3 comments. First one, whether company is maintaining fixed asset register. Actually, the clauses whether the company is maintaining proper records containing full description and situation of fixed assets. Okay. Second one, okay, whether the management is conducting physical verification of fixed asset at a reasonable interval. If any material differences are identified between physical account and records, how they dealt with the differences, auditor has to comment. Third one, whether immovable properties of the company that are situated in the property, plant and equipment in the balance sheet, whatever immovable properties, are they in the name of the company? It may be freehold property or leasehold property. Were they registered in the name of the company? If not, why they were not registered in the name of the company? In whose name it is registered? These are the 3 points auditor has to comment. First point, is the company maintaining records? I know, Mr. Auditor, whatever balance sheet P&L is there, it is true and fair. You only said it is correct. We don't know what is inside the company. So we are asking you some questions as a shareholder. Tell me, is the company maintaining records? Is the company physically verifying regularly? Are they taking care of the assets? Are they safeguarding the assets? And the third one, they're asking you in the third one, they're asking you whether immovable properties, whatever is there, are they in the name of the company? If not, why they were not in the name of the company? You take Reliance Industries audit report 1819. What Reliance Industries auditor report have commented on this particular fixed assets? No, on third point, they said during the year the company amalgamated, the company acquired another company where some 80 crore worth of buildings were kept for pending for registration. Okay, so they were awaiting for registration, except that remaining all other assets are in the name of the company, PPE, immovable property. So that's about fixed assets. Then CARO is asking you another question with respect to inventory. Second clause in CARO is inventory. Whether the company is whether the management is physically verifying, only one aspect is checked here, only one aspect. Fixed assets has three aspects, inventory has only one aspect. Whether inventory is being physically verified by the management at reasonable interval. If any differences were identified, how they were dealt in the books of accounts. They're asking you only about inventory physical verification, and the guidance note on CARO says inventory must be physically verified by the management at least once in a year, Whereas fixed assets, guidance note says the management should verify fixed assets at least once in 3 years. You know, the fixed assets physical verification, you take Infosys report, you take Reliance report, you take State Bank report, the management of the company will verify fixed assets once in 3 years. Considering the nature and size of the business, 3 years is reasonable. But inventory must be verified once in a year only. If the company did not verify inventory fully, they only verified 70% or 60% in a particular year, auditor must qualify here in the CARO, because it is not verified at reasonable interval, because the guidance note says clearly 100% verification must be done at least once in a year. Then the third clause. So second clause is completed. Then third clause, loans and advances to interested parties. The third clause is regarding loans and advances to interested parties. Okay, interested parties are nothing but companies, firms, proprietary concerns, or whatever, whose details are maintained under section 188 register of the Companies Act. 188, 185, 186, 187, all these provisions you would have learned already in the corporate law. So the significance of these provisions, you already aware of it, I hope so. Now, loans and advances to interested parties. Loans and advances to interested parties. So, what is this comment here? First question CARO is asking, dear Mr. Auditor, please tell me whether company has granted any loans and advances to those parties covered in the 188 register of the Companies Act. If so, verify how much is granted, to whom it is granted, verify that. See, loans and advances granted means obviously it is talking about loans and advances given, not loans and advances taken. Loans and advances given is a asset for the company, is an asset for the company where we are doing audit, where we are giving audit report. So if the company has given any loans and advances, verify how much amount given, to whom it is given. First point, verify the parties and amount. Second point, whether terms and conditions of such loans and agreements are reasonable. Whether the terms and conditions are reasonable. Sir, what do you mean by reasonable? Generally, every company, for everything, okay, they will have some rules and regulations to follow as per articles. So, in the company, as per articles, a company shall charge some rate of interest on every loan, on every advance. Okay, whether the same rate of interest is there in the loan agreement or not, check it out. Whatever the terms and conditions that were there in the bylaws of the company, same terms and conditions were there. Whatever terms and conditions that were given in the law, same terms and conditions were there. Is there any terms and conditions that were contradicting the company law, that were contradicting the bylaws of the company? They are unreasonable terms, prejudicial to the company. Auditor has to qualify. Third one, okay, company gave a loan to this person, they gave, and these are the terms. Okay, fine, reasonable. Now, is there a recovery? Is there a recovery of this loan given? Whether the repayment of principal, interest, or installment stipulated in the loan agreement, is repayment clause is there? Yes, it is there. Whether the repayment is regular. What is meant by regular? Every month is paying, sir. No, it's not regular. Regular means within due date. Regular means what is meant by regular? Within due date. Just a minute. So whether the repayment period is regular within due date. 1 minute, it is hanging. Just a minute. 1 minute. So the third point, whether the repayment of loans and advances is regular. Fourth point, suppose if there is a default, if the loan is overdue for more than 90 days, if a particular loan given to a related party is overdue for more than 90 days, check, Mr. Auditor, please check what steps the company has taken, check it out and comment it here. You see now, auditor is not just giving, hey, dear shareholder, bank balance sheet P&L true and fair, over. No, here auditor job did not end. Auditor has to check all this and also give a comment on this specifically. So shareholder is getting more insights about the company. So that's about loans and advances. And fifth clause in CARO. Fifth clause in CARO is regarding public deposits. Fifth point in CARO is deposits. Whether the company has accepted any deposits during the year. If so, whether the provisions of Companies Act 73 section 276, whether these provisions complied, RBI directives complied, NCLT directives complied, check it out. If there is a non-compliance, if Companies Act provisions are not complied, if directives issued by RBI not complied, if directives issued by NCLT not complied, if they were not complied, comment it here. What is the nature of non-compliance and what is the consequence of that non-compliance? What is the consequence? A penalty, prosecution, that also you comment here. So that is the reporting requirement with respect to public deposit. Then sixth point is regarding cost records. A very simple point. They are just asking you, dear Mr. Auditor, you are doing audit of a company, right? For that company, whether section 148 subsection 1 cost records maintenance concept applicable or not. If so, if applicable, whether the company you are doing audit, right? Did they maintain? Did they made the cost records? Are they maintaining the cost records? Just tell it. Just tell that. That's enough. You need not do a detailed examination. If cost audit is applicable, they will check it out. So whether cost records are maintained, why cost records are maintained by a company, why compulsory cost audit and all were there? To ensure performance. It is for conducting performance audit. It is for conducting efficiency audit, effectiveness audit, compliance audit, for all that purpose. Okay. Ultimately, even it's a listed company, private sector company, public money is involved, So for that reason, cost audit, everything is being conducted. It is something similar to propriety audit under PSU audit. Propriety audit for government companies, how it is significant? No, similarly, cost audit is significant for private sector entities. That's it. Next, seventh clause, statutory dues. What auditor has to comment with respect to statutory dues? First of all, CARO divides the statutory dues into two parts, undisputed due and disputed statutory due. What is a disputed statutory due? Where there is a notice from the department that I have to pay a tax and I denied. Okay, I filed a case against the dispute. Suppose I received a notice from income tax officer under 143 subsection 3 order, assessment order. I am denying him. I will not pay. Okay, I raised a dispute against him in the appeal. Okay, I filed an appeal with CAT appeals, let us assume. Okay, now whatever the amount, it is under dispute. So that due, whatever is due in the dispute, regarding that, auditor has to just give information. Whether is there any disputed dues that are there for the company but not yet deposited. Yes, there, sir. If so, if there are any disputed dues, dear Mr. Auditor, what is the nature of due? Income tax. What is the forum where the due is pending? What is the amount of, how much of due? Income tax, forum, ITAT, income tax appellate tribunal, amount is 10 crore. But what we mention in reality, we also mention which assessment year it belongs to. Okay, and act under which the due arisen, that also we will mention in real life. As per guidance note, these are the points you have to report. Here, CARO disputed you only have to give information, no opinion. Ask management, get information, copy paste here. That's it. First point, undisputed due. What is undisputed due? We all know that every month the company will deduct TDS. Every month company will deduct PF, ESI, collect PF, ESI. They have to pay their own contribution. Every month these amounts have to be paid. Now tell me, company will pay these amounts voluntarily or company will pay these amount on a compel order? Company will pay voluntarily. Without any dispute, company is paying voluntarily, and those dues are called as undisputed statutory dues. Now, what auditor has to comment with respect to undisputed statutory dues? Auditor has to comment to two issues. Okay, whether income tax, ESI, PF, GST, customs duty, advance tax, sales tax, VAT, CST, Whatever statutory due, something you are paying to a governmental authority by virtue of a levy. Because of a levy, electricity bill is not a statutory due. Electricity is a consumer product. You are buying the electricity and using it, consuming it. Electricity is a goods. It's a consumer product. It is not a statutory due. Just because we are paying to a power distribution company owned by state government, it doesn't mean it's a statutory due. There should be a levy. It should be a tax, or it should be a duty, or it should be a liability under a particular law. So that is called statutory due. Provident fund, ESI, profession tax, municipal tax, octroi, income tax, dues under income tax, dues under GST law, dues under customs law, dues under VAT, dues under central sales tax, all that comes under statutory dues. Now, is the company regular in depositing these undisputed statutory dues? Dear Mr. Auditor, just tell me, is the company regular? Okay, I know balance sheet P&L is true and fair. You give unmodified opinion. But balance sheet P&L true and fair means the amounts are correct. That is what your opinion means. There is nothing more. I want to know, is the company paying taxes on time? That is what CARO is answering. Yes, company is regular. If not, what is the amount of dues which are overdue for more than 6 months on balance sheet date? Dear Mr. Auditor, as on balance sheet date, some liability is there, right? TDS payable. Is it overdue for more than 6 months as on that date? No, it is not there. Just to comment that. So if there is any undisputed due but not paid by the company, which is outstanding for more than 6 months, by the time balance sheet date comes, it is already exceeded 6 months. Give list of that. You see Reliance audit report or any other company audit report, auditor gave positive comment. Yes, the company is regular in depositing undisputed statutory dues, all that. Second one, there is no undisputed statutory due which is outstanding for more than 6 months. Positive comment. Remember, what is the reporting requirement in CARO? Sir, every point, whatever clause and subclause, there are 16 clauses. In each clause, there are subclauses on which you have to give a comment. It may be positive comment or negative comment. Both you have to comment. If there is no, if that particular point is not applicable, say that it is not applicable. You take Infosys, CARO report given by auditor. Inventory point, they clearly say not applicable. Take Reliance Industries, deposits point, they clearly said no, deposits is not applicable. If a particular point is not applicable, say that it is not applicable. Over. Next, so that's with respect to statutory dues clause. Then clause number 8, default in repayment of loans. This is the clause which is talking about loans taken by the company, not given by the company. Loans taken by the company. Did the company has taken any loans from banks and financial institutions or debenture holders? Whether the company has raised any money, whether the company has borrowed, whether the company has loans and borrowings from banks, FIs and debenture holders. If so, whether the company is paying them regularly, the interest, principal or EMI, whatever, is the company paid regularly? If there is a default, lender wise, what is the amount of default? What is the period of default? Please tell me, the auditor. Please Mr. Auditor, inform a list of lender wise how much amount defaulted, 190 days period for which it is defaulted. Whether the company has borrowed any loans and borrowings from banks, FI, debenture holders. If so, okay, it may be term loan or non-term loan, whatever. Borrowings are there. If there is a default, comment it like this. Now, clause number 9. What is clause number 9? It is relating to application of funds. Sir, what is application of funds? Here they are asking you two questions straightly. First of all, tell me, Mr. Auditor, during the year, did the company raise any money? By way of, did the company raise any money by way of IPO or FPO or term loan? Okay, when they're raising this money, they would have mentioned some purpose, right? For this purpose, we are raising the money. Okay. Did the company utilize that money for the same purpose? Did the company utilize that money for the same purpose within the duration mentioned in the prospectus? In the prospectus, management would have mentioned within next 1 year we are going to use. So did the company utilize it within the duration mentioned in the prospectus? If there is a delay, or if there is a default, or if there is a default, or subsequent rectification, if any, shall be reported. There are three terms which are used in CARO. If there is a delay or default or subsequent rectification, if any, shall be reported. What is delay? The company raised money, but they have not yet spent. It is still in the bank account of the company. Default, company raised money for constructing a building, paid, used it for paying salaries. That's a default. And subsequent rectification, what is that? Paid for salary, but again they brought some other loan and then used it for the ultimate purpose. Subsequently they rectified. Any of these things happened, you have to report. This is a clause which indirectly prevents diversion of funds. Through this clause, shareholders will understand, is there any diversion of funds? It may be IPO, FPO, or term loan. You raise it for one purpose and using it for some other purpose. It's a diversion of funds. Yes Bank is facing that issue only, no? In 2018-19. Sorry, 2020. So that's about application of funds. Next, fraud. Next one is fraud. So clause number 10. I'll directly teach it here directly. So next one, clause number 10. What is clause number 10? Reporting of fraud. Whether any fraud by or on the company, by its officers, employees, has been noticed or reported. Only if that fraud on the company is by officers or employee, only that should be reported. Any fraud by the company on third parties, okay, that shall be reported. Fraud committed by the company means what? By the management on third parties. If there is any fraud by the company on third party, shall be reported. If there is any fraud on the company there is a fraud. By whom? Only officers or employees. That should be reported. You know what? In CARO 2020, this officers or employees word is deleted. Officers or employee word is deleted. The scope of reporting of fraud in CARO has been widened by deleting the word officers or employees. By the way, for December exam, this point is irrelevant. Just remember this. Is there any fraud committed by the company? Report it. Is there any fraud on the company committed by the staff, officers or employees? Report it. What is the nature of the fraud? Cash theft. Amount involved 10 lakhs. So that should be reported. And there is a guidance note on this fraud reporting, which I am not covering in the marathon. Okay, further 143 subsection 12. Okay, if the fraud, if any fraud identified by the auditor, here no, frauds committed by the company or on the company, these all frauds are already identified by internal control system of the company. Internal auditor, somebody would have identified, company would have identified that fraud. Suppose if there is a fraud that you identified when you are doing the audit, 143 subsection 12 is applicable. If it is less than 1 crore, board of directors report should report that point. If it is more than 1 crore, you have to report to the central government in ADT4 by within 60 days from the date of identifying the fraud. So that is 143.12. Sir, if auditor identified any fraud when he is conducting audit, he detected, should it be reported in CARO 2016? No need. But for a better sake, report it. As per the guidance note, no need to report. But what I advise for you is report it. You know what? CARO 2020 put a special point on that. Any fraud identified for more than 143, any fraud identified as per 143.12, that fraud shall be reported in CARO as per 2020 CARO, not in CARO 2016. Next, management remuneration. Okay, whether the company paid management remuneration, is it in accordance with 197 and Schedule 5? If any excess amount has been paid, which is violation, company has to recover for sure. Nidhi company. What is a Nidhi company? Nidhi company is also a financing company. Nidhi rules are applicable under company law. So, what is a Nidhi company? It's a company. This is also called as mutual benefit society. Nidhi company is also called as mutual benefit society. Chit fund is different. Nidhi is different. Okay. So, in Nidhi company, members, minimum 200 members shall be there. Nidhi company shall have minimum 200. I hope at CA final paper 3, paper 4, you already learned Nidhi rules and all. I hope so. Okay, if not, watch the rules and then watch it here. So what auditor has to report? If I am auditing a company which is a Nidhi company, then only this point is applicable. Suppose I am auditing a company which is not a Nidhi company, this clause itself do not apply. Suppose if I am auditing a company which is a Nidhi company, in that rule number 5 is there in Nidhi rules. So there are some conditions which Nidhi company has to comply with. Minimum 200 members should be there. Minimum owner's capital must be 10 lakhs something. Some kind of rules are there. And in that 2 conditions are there. Nidhi company shall comply with the net owned funds to deposit ratio in the ratio of 1:2. Net owned fund means owner's fund must be 1 rupee. For every 20 rupees deposit accepted from members, Nidhi company can accept only deposits from members because it is not a bank. Okay, further, the Nidhi company shall maintain 10% unencumbered term deposits. All my students, my regular course students also, please, I'm advising you to understand these 2 points. Okay, Nidhi company shall maintain 10% unencumbered deposit. First of all, what is a Nidhi business? Me, along with me, some 199 people are there. All 200 of us together formed a Nidhi company. For what purpose? One of us may need some finance need, and some of us are having some excess savings. So what we can do? Do one thing. All 200 members, whenever you are having money, deposit with the company. When any of you want loan from the company funds only, I will give it to you. Okay, like what is it? Suppose if I am a depositor, I am a member in Nidhi company, I will deposit with Nidhi company 100 rupees. Now I suddenly want a loan, I can take maximum loan of 90 rupees only. I cannot take 100 rupees. Nidhi company shall maintain 10% margin, and that is what this one. A Nidhi company, when they accept a deposit from a customer, from a member, okay, out of the deposit accepted, only maximum 90% can be given as a loan to the same member. That's it. So that is Nidhi company rules, all that. Okay, so I hope you have already covered it in the law, company law, already Nidhi rules. So auditor has to comment whether Nidhi company is maintaining 1:20 capital adequacy ratio norm. Indirectly it's a capital adequacy ratio. Whether Nidhi is maintaining 10% unencumbered deposits, this is a liquidity ratio. This is liquidity ratio. Is it maintained or not? Auditor has to check it. Then related parties, 2 sections you have to check. 177 audit committee approval obtained or not. 188 sections, conditions have been satisfied for executing transactions with related party. Further, whether accounting standards have been complied. What accounting standard says? All related party transactions must be shown at the one place in the notes to accounts. Is that complied? Auditor has to check that. Then preferential allotment, whether the company has made any preferential allotment or private placement of shares. Okay, if so, for, whether see whether section 42 private placement section has been satisfied, and what is the amount raised for, and for what purpose used for. Check it out. If there is a default, give the comment, give your details. And did the company has entered into any non-cash transaction with the directors of the company? If so, corresponding provisions of the Companies Act satisfied or not. 16th, whether you are doing audit of a company, right? Yes. As per section 45, RBI says there are some companies where they are liable for registering as an NBFC for sure. NBFC registration is mandatory for some companies. Why, sir? What is this provision? There are some companies which are doing actually finance business, NBFC business, but still they did not get NBFC registration. Why? If they get NBFC registration, continuously they need to file that form, this form with RBI, all that. That's why without getting registration, they are just continuing as a normal company. You are doing audit of a company, right? Tell me, is that company liable for NBFC registration as per 45 IA of the RBI Act? If so, comment here. Okay, for all the companies that you see in real life, this comment is a positive comment only. No, 45 IA is not, 45 IA is not applicable. So accordingly, this is not required to register as a NBFC. So these are the points that are there in the CARO. What is the audit reporting in CARO? We have to report mandatorily. It may be negative or positive, but if it is a negative, give reasons also. That's it. So that's about CARO. That's about CARO. Next. So reporting on legal and regulatory requirement. You see how in audit report it will look like. I will show you right now in audit report how CARO will come. Will take annual report. Reliance Industries Limited itself will take. SBI I am not taking because SBI is a bank. For bank, CARO is not applicable. So Reliance audit report I will take. So this is the audit report of the Reliance Industries on the standalone financials. I am not taking consolidated financials because in consolidated financials, CARO is not applicable. You see, in the CARO, in the Reliance audit report, there is a paragraph. What is that paragraph here? You see, report on legal and regulatory requirements. Report on legal and regulatory requirements. Inside that, first point is about CARO 143 subsection 1 companies auditor report order 2016. But they are not commenting here. They are giving annexure 1. You see annexure 1. This annexure 1 is completely CARO related paragraph. This is completely CARO related points. This is part of audit report. That is how CARO is being used. Now you see. Okay, 143 subsection 3. Now you check. I hope now you understood. Report on legal and regulatory requirements. Yes or no? Report on legal and regulatory requirement paragraph you understood. Now inside that 143 subsection 3, 143 subsection 1 is also there. What is 143 subsection 1? 143 subsection 1 duty to inquire. 6 inquiries were there, out of which 3 inquiries were asked in the past 2 attempts. For 4 marks they have asked in one of the attempt. In the past 2 attempts they have asked for 4 marks question. Okay, 3 inquiries. Okay, what are the 6 inquiries? First one, whether the company has granted loans and advances. Whether the company has granted. By the way, 143 6 inquiries are there, right? These 6 inquiries, auditor shall comment in the audit report only if there is a negative comment. Only if there is a negative comment. The research committee of ICI clarified 143 inquiries. Auditor just have to inquire. If everything is fine, no need to report. If there is a negative point, report it. You see any audit report of listed company, 143 subsection 1 6 inquiries related points, you will not identify at all. Why? Auditor would have got positive answer. Now 143 subsection 1. Okay, inside that first point, first inquiry. What is the first inquiry? Whether the company has gave any loans and advances on the basis of security. Did the company give loans and advances on the basis of security? This point is applicable for Nidhi companies and NBFC companies especially. Whether the company has gave any loans and advances on the basis of security? If so, first point, dear Mr. Auditor, check, are they properly secured? What do you mean by properly secured? Mortgage registration should be done. Hypothecation value should be assessed. Valuation report should be assessed. Credit worthiness should be assessed. The security value should be higher than the loan amount given. Adequate margin should be maintained. That is what properly secured means. Second one, okay, whether the terms and conditions are reasonable, are they prejudicial? So this is the point which auditor has to comment with respect to first inquiry. What is the second inquiry? Whether any transactions of the company, which are merely represented by book entries, are they prejudicial for the interest of the company? Check it out. Book adjustments, depreciation, provisions, these are all book entries only. There will not be any bill, there will not be any invoice, third party bill invoice will not be there. These transactions will have only book entry. The journal entry itself is a proof. There is no other proof. Are they reasonable? They are asking you. Third point, whether the company has sold any securities, shares and securities for a price less than purchase price. Understand, it is purchase price, not market price. Suppose I bought a share at 100 rupees. Today market value is 200 rupees, but I sold it for 150. This clause do not attract because I sold it for more than purchase price only, right? There is no loss here. If I sell it less than purchase price, if I sell a particular share for loss only, I need to comment. And you know, this third clause is not applicable for investment company and banking company. Sorry, of course, for banking company, investment company, this clause is not applicable. Remember one more point, 143 subsection 1, 143 subsection 3, 10 checklist items, 6 inquiries. All these points are applicable for banking company auditors also, insurance company auditors also. NBFCs, Nidhi companies, everyone have to comply with this. But CARO, banking company, insurance company, no need to comply. But NBFC, Muthoot Finance will give CARO report. Okay, Nidhi companies will also give CARO report, all that. Only bank CARO report is not applicable. Please make a note. 143 subsection 1, 143 subsection 3. CARO, I mean for banks, NBFC, Nidhi companies, for all types of finance companies it is applicable. But inside that third inquiry is there, no, whether the company has sold any shares and securities for less than purchase price. That point is not applicable for investment company, not applicable for banking company. Why, sir? Purchasing and selling shares and securities is a regular activity for investment company, regular activity for banking company. So they may either get profit or get a loss. That is part and parcel of their business. But for a normal company, it is not an operating activity. It is investing activity. What is an investing activity? When I have surplus money, I will invest in shares. If I get a loss inside that, my decision is wrong. Shareholder should know. Hey, dear shareholder, your company is a normal company. Still they bought some shares and sold for loss. Even if they keep it idle, you would have got so much of dividend. So for that reason, this third clause is. Then fourth one, they're asking whether company has granted any loans and advances. Have they been shown as deposit? You know, generally the word deposit sounds very secure. The word loan given sounds risky. Word deposit given is less risky. It appears like less risky. Deposit means somehow some contractual obligation would have been there. For that only they would have deposited. Nobody will look into it much. Okay, deposit whatever big amount, no problem. It's only deposit, secure deposit, something like that. But companies giving actually loans, they are classifying as deposit. Accordingly, they are escaping from so many provisions applicability. When the company is giving loans and advances, section 186 provisions are applicable. 187, 188, all these provisions are applicable. Suppose if the company classified it as a deposit, that is not applicable. So companies cleverly may do one thing, loans and advances they'll give, but classify it as a deposit. Okay, have you noticed any such kind of misclassification, wrong classification, intentional, malicious classification? Okay, if so, please report it. Fifth one, whether personal expenses were charged to revenue account, nothing but whether officers and employees, their personal expenses are charged to company revenue account. Check it out. You know which personal expenses charged to P&L, no need to report if the personal expenditure is out of contractual obligation for the company, or if it is a customary practice. If a company P&L is debited with some personal expenses, it is because of the contractual obligation for the company, or it is because of an accepted custom, then no problem. If it is otherwise, it must be reported. Sir, what is contractual obligation? Perquisite. As part of terms of employment, a director is given car for personal usage. It is there in the employment contract also. It's a contractual obligation. Though it is for personal purpose, though it is debited to company P&L, no need to report. Director purchased second car. Okay, director got second car facility from the company, which is not as per the terms of employment. This is personal expenditure. Unauthorized expenditure shall be reported. What is accepted custom? All the employees, we have given Diwali bonus, Diwali gift, sweets and all that. Okay, we have given amount, they purchase whatever they want. So that is a personal expenditure debited to the company account. It's an accepted custom in India. For Diwali, Dasara, for all types of festivals, it is customary in India to give this kind of gifts, personal expenses of employees, directors. It is customary to debit to our company accounts, company P&L. This need not be reported. What should be reported? Which is not an accepted custom, which is not out of contractual obligation. Anything over and above these two unauthorized expenses, which are incurred for personal purpose, but debited to company profit and loss account, nothing but that expenditure is out of company pocket. So that should be reported. And the sixth one, whether the company has raised any money, whether the company has issued any shares for cash. Cash means what? Monetary consideration. Whether the cash actually received, if cash is not received, there are any arrears. Whether the position stated in the balance sheet, is it correct, regular and not misleading? Check it out. That's it. These are the 143 subsection 1, 6 inquiries which auditor has to make. If on these inquiries, if you find any negative comment, auditor shall report. That's it, 143 subsection 1. Then 143 subsection 3, 143 subsection 3, checklist. I call it as checklist. You know, it is also called as affirmations. Affirmations to be given by auditor. Checklist items. What is this checklist items? 143 subsection 1. Okay, report on legal and regulatory requirement. One is 143 subsection 1 that we have completed. Another one 143 subsection 3. Now we are going to discuss. Another one is 143 subsection 11 CARO that we already completed. Now 143 subsection 3 checklist item. Checklist item, first of all, what is the reporting requirement? Whether positive or negative, both should be reported. If there is a negative, give reasons also. What are the checklist items that we have to report? What are the checklist items that we have to report? Okay, what are the checklist items we have to report? The auditor report shall state whether he has sought and obtained all information, explanation, which to the best of his knowledge and belief were necessary for the purpose of audit. They are asking you, dear Mr. Auditor, have you asked and obtained all the information, explanation necessary for your audit? Please give me one more time. Hey, shareholder, you see opinion para? In our opinion, to the best of our information, according to the explanation given to us, the efforts and financial statements are giving true and fair view. I gave already. Further, in basis for opinion para, last para you see, we believe that the evidence obtained by us is sufficient and appropriate to provide a basis for opinion. I already commented. It's okay, man. I want one more time the reformation under company law. That is as per standard on audit SA 700 ICA requirement you commented. Company law requirement. Company law is asking once again whether you have asked and obtained all the information, explanation, whatever you want for that is necessary for the purpose of audit. Tell me. You said yes, we have obtained. Later, if any fraud was detected, you cannot come out and say, I asked this information. Company did not give me earlier. You can't say that. So be careful. So this is like a checklist. Check it out at the end of the audit when you are preparing audit report. Have you seen this point? Immediately just look back. Is there any information which I asked to the company but company have not yet provided? Check it out and then comment on this here. So Reliance auditors, you see positive comment. Now second point, dear Mr. Auditor, whether in your opinion proper books of accounts as required by law have been kept by the company so far it appears from your examination of those books. This is one point. This is one point. Whether in your opinion proper books of accounts as required by law, as per company law section 128, you have to every company has to maintain some books of accounts and records, all that. As per your examination, did the company maintain all that books and records, registers, all that? Okay, so check it out. And have you received proper returns? Returns means summary. Okay, for the purpose of audit, have been received from branches. Not there are so many branches, and in each branch some transactions are recorded. Have you received branch summary for which you have not visited? If there is a branch auditor separately appointed, you need not comment on this point. Otherwise, comment. Now C point, whether report on accounts of any branch office of the company audited by a person other than company auditor, that is branch auditor, has been sent to him. Dear Mr. Auditor, whether there is a branch auditor, if so, is his report forwarded to you? And how you dealt with that report? How you dealt with this report? Have you dealt with this report? You see any listed company other than banking companies, this point will not be there in the audit report. Why? Which company is appointing branch auditor? Only when there is a compulsion for appointment of branch auditor separately, then you have to appoint branch auditor, because RBI says branch should have a separate auditor. That's why banks appointed branch auditor separately. Then fourth point, they're asking you one more confirmation. Fine, you said balance sheet P&L true and fair, agreed. I want one more clarification. Are they matching with books of accounts? So that is fourth clause. Fifth one, whether you said balance sheet P&L whatever they showed is true and fair, I want to know, are they complying with the accounting standards? Sixth one, have you identified, dear Mr. Auditor, do you have any observations or do you have any comments, okay, on financial transaction matters? There are so many transactions you would have come across, there are so many issues you have seen in the audit. Is there any of your observation or comments? Do you have any observations or comments on those transactions which have any adverse effect on the functioning of the company, which have adverse effect on the functioning of the company? It is nothing but a propriety principle being tested for you. Think like a owner. Think like a owner, Mr. Auditor. Until now, you're only doing compliance audit, regularity audit. You're only checking rule matching or not, rule matching or not. Now check. Think from a owner point of view. Is there any transaction which is having adverse impact on the company functioning? Check it out. Now, one more thing. Whether any of the director is disqualified from the board of directors. Reliance Industries is having 14 directors on the board. Is there any director who is disqualified? Check it out. Generally, checking disqualifications of director is a very difficult task. What auditors will do, they will get a written representation. You see Reliance audit report, State Bank of India audit report, any other audit report, what auditors will reply, on this point, based on the result, on the basis of written representation received from the directors, none of the director is disqualified. Auditor is not doing any audit here. He got written representation and gave the opinion because of the limitation. Auditor cannot check whether director is disqualified or not. Next, dear Mr. Auditor, tell me, do you have any qualification? Do you have any reservation? Do you have any adverse remark relating to maintenance of accounts and other matters connected therewith? Companies maintaining accounts, do you have any adverse remark? That is what which is being asked in B point already. What B point says, in your opinion, are books of accounts proper? What is this H point? What is this H point? Do you have any objections on books of accounts? Both are same. Now next, I point, whether the company has adequate IFC, internal financial controls over financial reporting, whether the company have adequate internal financial controls, IFCO, okay, with respect to financial statements and operating effectiveness. Okay, generally what auditors do, IFC, they will give it as an annexure 2. You see this, you see the audit report. I will show you audit report right now. So 143 subsection 3. Where it is coming from, report on other legal and regulatory requirement, 143 subsection 3, inside that I point actually, but they deleted, so numbering will change here. With respect to adequacy of IFC, refer annexure 2. So they are giving a separate report, annexure 2. What is annexure 2? It's a report on internal financial controls under clause I of 143 subsection 3. So you need to give an opinion whether they are operating effectively or not. You need to give an opinion like this for all listed companies as well as for all other companies except exception companies. What is exception companies? One person company, no need to report. Small company, IFC point not applicable. Private limited company whose turnover is not exceeding 50 crore and whose loans from banks and FI shall not exceed 25 crore, for them IFC reporting do not apply. IFC IFCO for reporting do not apply. What is IFCO for? Internal financial controls over financial reporting and such other matters as may be prescribed. Clause J. Inside this clause J, earlier we are having 3, now we are having 7 matters. Now we are having 7 matters. Binami transactions related 2 matters and one audit trial related matter which is applicable from 2020 to April 1st onwards, and another one is regarding dividend matter. There is an amendment which I will discuss in the amendments session. This entire G point I will be discussing in the amendments session. I hope everyone understood. So this is what report on legal and other regulatory requirement. If you see, we have even completed report on legal and other regulatory requirement paragraph in the audit report. Now we know how to prepare audit report. We know how to put a title, we know how to put a addressee, we know how to draft an opinion, we know when to use basis for opinion, how to use it, we know when to use material uncertainty, we know how to use key audit matter, we know how to use emphasis, other matter, other information, responsibilities of management, responsibilities of auditor, report on other legal and regulatory requirements where auditor has to comment on 32 matters. Okay, 143 subsection 1, 6 inquiries, 143 subsection 3, 10 checklist item, 143 subsection 11, CARO 16 items as per CARO 2016. Totally 32 matters auditor has to comment. 32 matters auditor has to comment. Total 32 matters. And we know what is the rules and regulations for signature, place of signature, date of audit report, and UDIN. This is what audit reporting segment. Part 2, part 3, part 4, part 5. These 4 parts videos together roughly approximately some 3.5 to 4 hours. Okay, we completely focused on audit report. The weightage is 15 marks. By the way, there are so many points which are there but which I have not covered. Open your ICS study material and check it out that. Okay, there are many other points out there which I have not covered, but main audit reporting standards we have covered. Now, what is my request for you? I already uploaded one 9 hours standard video from my regular course. Okay, inside that SA 620, SA 610, SA 710, SA 260, these 4 standards I am advising you to watch from that particular. They are regular videos, not revision videos. Okay, now totally what standards we have covered? 700 we have covered, 705 we have covered, 701 we have covered, 706, 720, 570. Okay, 570. Is there anything else we covered? 299. Okay, total 720. 4 plus 3, 7, 7 plus 4, total 11 standards we covered. Total 11 standards. These 4 standards, I have a 9 hours video. You can search in YouTube. See a Ram Harsha 9 hours video. I will do one thing. Wait. Okay, just you type so 9 hours video. You'll get this. You'll get this video 9 hours 11 minutes. Okay, inside that 710 you have to watch, 610 you have to watch, 620 you have to watch. 710, 610, 620. Maybe hardly it will take some 1.5 to 2 hours maximum. You watch that. So with this we have completed approximately 11 standards. Approximately we have completed 11 standards, and audit report, how to prepare audit report also we have completed. Taking this revision as a guidance, read once again from the study material. I'm telling you, you become a master. Now you have a guidance note on internal financial control. You have a topic of guidance to put on fraud reporting in the ICS study material. Please read that, don't ignore. I cannot make it available for marathon. Sorry for that. That's it. So with this, audit reporting is done. From the next part onwards, we are starting with standards on auditing, where I will be discussing a preliminary, a basic introduction to the standards, engagement and quality control standards, and we have totally 35 standards, out of which 11 standards already over, and some 7 or 8 standards I'm not discussing in the marathon. Remaining 10 to 12 standards I will be covering in the marathon. That's it. So after standards, we'll discuss ethics. Probably ethics. After ethics, corporate governance and audit committee. After that, peer review, quality review. After that, PSU audit and bank audit. That is my first tranche in the marathon. Once we finish that, depending upon my time availability, all that I need to check so many calculations. Okay, based on all that, then I will discuss about the other topics. I will think about the other topics. But those whoever is taking my regular course, for them all chapters I will give you 99%, 99%, 80% of the chapters I will cover in the marathon. For my students, whoever bought my regular course, okay, I will try to cover all the chapters. That's it. Carry on. Have a nice time. So continue with the next lecture, part 6. So this is part 6 audit marathon where we are discussing standards. In fact, if you look at your study material, this is the first chapter. Your ICS study material in Advanced Auditing Paper 3 CA Final, this is the first chapter, Standards and Guidance Note. So, well, there is a lot of introduction to the Standards and Guidance Note. But before that, so I just listed out what are the standards that are applicable for CA Final students. The standards applicable are totally 36 standards. One standard on quality control, 35 standards on audit only. We have totally 4 categories of standards. Like broadly the standards are divided into assurance standard, non-assurance standard. Okay, anyhow, I'll come to that preface part, little while later. First, let us have a look at what we are going to cover in the standards session. Already we have covered SA 299 as part of audit reporting chapter. It is already completed. Then we even have covered SA 570, going concern is over. SA 600 is covered, 610 is covered, 620 is covered. 700 is over, 701 over, 705 over, 706 is over, 710 is over, 720 is also completed. I hope you remember these standards we covered as part of audit reporting chapter. Okay, even I told you to watch SA 260 video also. In the reporting part itself, I mentioned clearly to watch these videos. Okay, already covered as part of the, until part 5. From part 2 to part 5, it is completely audit reporting sessions. As part of that, we covered all these standards. And now coming to the standards which I am not covering in marathon. The standards which I am not covering. I'm clearly saying I'm not covering it. 200 I'm not covering in marathon. Okay. 240 I will not cover. Even 230 I will not cover. 210, 220, yes, I will cover. 265 I am not covering. Why? Because 315, 265. These two belongs to risk assessment and internal control chapter, so which I am not covering. And even 300, it's a separate chapter itself in your study material, audit strategy, which I am not covering. 320 I am not covering. 330 also I am not covering. Though 330 is there, I'll give a glance. I'll give a brief idea about 330 if possible. If possible, I'll cover. Primarily what I decided is I will not cover them. 450 is not a big deal. It's a very simple standard. Okay, 402 I will cover because it's a critical standard which generally many students have doubt. Even 330 also many students will have doubt because 330 talks about further audit procedure. 315 talks about risk assessment procedure. 330 talks about further audit procedure. Okay, further audit procedure includes compliance procedure, substantive procedure. What is compliance procedure? Test of controls. So that entire discussion is very complicated discussion, which I don't want to publicly put it on the YouTube platform. So kindly excuse me for that. Okay, auditor has to first carry out risk assessment procedure, determine the materiality, then conduct further audit procedure. That's how the link is. Okay, fine. So this I'm not covering. 500 I'm not covering. 500 I'm not covering. Further, 530, 520 I'm not covering. For my regular course, I already gave various chapters for this. 520 analytical procedure, I gave a full-fledged chapter video, and 530 I gave a chapter video on sampling. So this I covered. Even for marathon, I'm not covering 540. 540 also I'm not covering. Then what standards I'm going to cover additionally as part of standards chapter? What I already covered is the one which I have highlighted with the green color. So 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10, 11, 12. 12 standards already covered, which now I'm going to cover 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. So total I am covering 22 standards on audit. Only with respect to audit, 22 standards I am covering in the marathon. Many standards which I am not covering, let us assume these standards which are highlighted in yellow color, 200, 230, 240, 500. Okay, and even I can say 330, 330, 520, 530. Whatever standards I've highlighted, 7 standards I've highlighted with yellow color. These are already covered at CA Inter, and that is the reason I'm not covering at CA Final Marathon specifically. So which means roughly speaking, even 300. Okay, that is also covered in CA Inter itself. But of course in CA Final also we have a separate chapter. 315, 330 I decided, 315, 320, 265 I decided not to cover because it has a separate chapter called risk assessment and audit in automated environment. As I already revealed what chapters I'm going to cover in the marathon, these chapters are not considered. So whatever standards I am not covering, no, they were already there as part of various chapters. So what are the standards that we need to exclusively discuss under standards topic? Or one is 210. It is also covered in CA Inter, but still once again I just want to cover it. 220, 250, 402, 501, 505, 510, 550, 560, 580. 1, 2, 3, 4, 5, 6, 7, 8, 9. So roughly there are 9 standards which I am going to cover exclusively in standards topic. Exclusively in the standards topic, I want to cover 9 standards roughly. Okay, already in audit reporting 12 standards we covered, some 11 or 12 standards covered. Now I'm going to cover another 9 standards approximately. Okay, so that's it. And not only that, by the way, SQC, standard on quality control, also I will cover in the marathon. Standard on quality control also I will cover in the marathon. So this is my basic first introduction related to what standards I'm going to cover. First of all, what standards we have in this curriculum, what standards we are covering as part of marathon and already covered as part of marathon, what I'm not covering, and I also gave you the reasons why we are not covering. Now, see, first of all, first let's have a small introduction to the standards. Small introductions to the standards. This is my smart notes. This is my smart notes. Presently, I have not made it commercially available because complete development of smart notes is not yet ready. Only for 7 or 8 main chapters the notes was ready. So complete commercial availability is not yet been launched. So okay, for a few chapters I already made standards. So I already made smart notes. So what is smart notes exactly speaking? Smart notes is, it's not a short notes, it's not a lengthy material also, it's a mediocre. It's a mediocre where you will not lose connection with the descriptive skills. At the same time you will get little interest to read because of the colors and the kind of presentation we made. Of course my handwriting is not so great, of course it's not even good. Okay, moderate, legible, everyone can understand probably, I hope so. Okay, now so let's look at the basic introduction here. Chapter 3, Standards on Audit, Statements and Guidance Note. This is the chapter name, which is as per your ICS study material also. Now, we have an authority called, okay, International Federation of Accountants. It constituted International Auditing and Assurance Standard Board. International Federation of Accountants have constituted, means have established a board called International Auditing and Assurance Standards Board. Nothing but this IFAC will have a council, right? They will have a managing committee, right? Out of that managing committee, some people, some members of the managing committee, they will form as a committee like this, subcommittee. This is actually called as a subcommittee, non-standing committee, IAISB. Example, a company will have board of directors. The same board of directors will formulate different committees like audit committee, remuneration and nomination committee, CSR committee, CG committee, corporate governance committee, so no, risk management committee. So the same directors will formulate different committees. Okay, so likewise, IFAC is one institution. It has formed one committee called International Auditing and Assurance Standard Board. It's a committee, first of all. Committee consisting of members who are actually the managing committee members of IFAC. Previously, formerly it is known as International Auditing Practices Committee. So this is international scenario. Now coming to the Indian scenario. We have Institute of Chartered Accountants of India, where Institute of Chartered Accountants of India has constituted Auditing and Assurance Standard Board. Actually, ICAI is having two types of committees, standing committee, non-standing committees. Approximately there are more than 40 non-standing committees are there. Inside that, peer review board is one committee. Okay, tax audit quality review board is one committee. Auditing and Assurance Standard Board is one committee. Who are the members of Auditing and Assurance Standard Board? They are members of nothing but the council. This ICAI is having 32 council members. Okay, from north, south, regional, central, eastern, western. So 32 council members are there. Okay, and in addition to that, central council members are there, which is headed by, where the central council members chooses the president and vice president on an annual basis. So this is the structure, basic structure of the Institute of Chartered Accountants of India. Now this institute, council members are there, no? They formulate Auditing and Assurance Standard Board, which is formerly known as Auditing Practices Committee. Now under the authority of the council, so the ICAI council is the one which is having the authority. Under their authority, Auditing and Assurance Standard Board, which is a subcommittee, okay, issues engagement and quality control standards, statements and guidance notes. Now what do you mean by engagement? Generally we think this chapter is standards on auditing, but actually it's actually engagement and quality control standards. Engagement and quality control standards. Engagement standards are different, quality control standards are different. Engagement standards are typically applicable whenever you are performing a specific engagement to a specific client. Quality control is applicable for a firm. We have only one quality control standard, SQC1. SQC1, quality control for firms that performs audit and review of historical financial statements, other assurance and review services. So SQC is applicable for every audit firm in India. What do you mean by audit firm in India? Firm means not partnership firm. Firm means an enterprise. Firm means an organization. Firm means an establishment. Firm means a concern. Firm dictionary meaning means an organization. Partnership firm means an organization formed with partnership. So firm means what? Sole proprietor, partnership firm, LLP, corporation or any other form. So all firms have to comply with SQC1, standard on quality control. What is standard on quality control? We'll discuss. Now, engagement standards. These engagement standards are broadly, okay, two types. Engagement standards are broadly divided into two types. When these standards are applicable? Whenever these audit firms which are registered with Institute of Chartered Accountants of India, whenever these audit firms accept a particular engagement. Sir, is it about audit engagement? Not necessarily audit. Any work that we accept, that work will come under one or the that work is an engagement. That's it. A client called me for conducting stock audit. It's an engagement. A client called me and asking me certificate. It's an engagement. So every work wherever I am entering into, it's an engagement. Just a minute. Yeah. So sorry. Where am engagement standard. So these engagement standards are broadly two types. What services that we provide are broadly categorized into two types: assurance based service, non-assurance based service. One service that we provide is assurance, where we give a sort of attestation, where we give a sort of assurance, where we give a sort of confidence to the user. Non-assurance, value added services. Where we don't provide any assurance. There. So what is an assurance? Assurance can be again two types. Assurance related to historical financial information. Assurance related to historical financial information. Assurance may be related to historical financial information, or assurance may be related to other than historical financial information. Historical financial information, assurance, two types: audit and review. Other than historical financial information, assurance services. Example: prospective financial statements. Assurance engagement on prospective financial statements. Non-assurance related services, compilation engagement, agreed upon procedures. Okay, now audit. What standards applicable? Standards on auditing. Review, standards on review. Engagement, SRE. Other than historical financial information assurance service, SAE. We actually call it as SAE, but of course some people are habituated to use the shortcut called SAE. The shortcut SAE is dedicated for audit. Okay, and SRS. So these are the like abbreviated forms for various services that we perform. And you know what is there in our syllabus? Only audit of historical financial statements is covered in our syllabus. Once upon a time, before 2018, not before 2019, all standards are covered for you. Total standards are 46. 10 standards are there, other standards other than auditing standards. So total 46 standards are applicable at CA final. But now Institute with generosity eliminated 10 standards. Now only you have 35 standards on auditing, 1 standard on quality control. This is the scope of syllabus, and out of which what we are covering in marathon, I already gave a list of it. I hope you understood, everyone. Then just a minute, let me check, is it recording? Yeah. Then so look at this. Now the ICI, the council, under the authority of council, auditing and assurance standards board will issue three types of statements. Okay, one is a statement, we call it as, another one is standard, another one is guidance note. Until standard comes into picture, there will be a statement. Currently there are no statements, only standards we have. Once a standard comes into picture, statement will be eliminated. Once upon a time we used to have a word called statement. Now statements are mandatory, standards are mandatory, guidance notes are recommendatory. However, there are two guidance notes which are mandatory. Guidance note on internal financial control is mandatory. Guidance note on tax audit is mandatory. These two guidance notes are compulsory. Okay, that's it. Now, like what is the compliance of the auditor with respect to standards on auditing? Auditor shall not deviate from standards on auditing. Even 143 subsection 9 of Companies Act, whenever you're doing audit of a company form of organization, you are doing statutory audit. As a statutory auditor, you have to comply with section 143, duties of the auditor. Inside that, subsection 9 talks about auditor shall comply with the standards on auditing issued by Institute of Chartered Accountants India, which are specified under 143 subsection 10. Nothing but whatever standards that we are going to discuss. So 143.9 we have to compulsorily comply, and even as per ICAI standards also, even as per ICAI guidance notes also, even as per ICAI preface also, it says for every audit engagement you must comply with standards on auditing. If you shall not deviate. Suppose if you deviate with respect to a particular requirement in a particular standard, if you deviate, you did not apply that process which the standard recommends. If you deviate, disclose that matter in the audit report. Without complying with the auditing standards, you cannot give an affirmation that you complied. You cannot use that we do audit as per standards on auditing in basis for opinion paragraph without actually doing audit as per standards on auditing. Only if you do audit as per standards on auditing issued by ICAI, then only use that statement in the basis for opinion paragraph of the audit report. And please note that just because you are disclosing that you are deviated from so and so standard, so and so standard you are not following, doesn't mean you are exempted. See, for the reader, he must understand so and so standard you did not follow. He must understand that. For that purpose, you are giving disclosure. Just because I disclosed that I have not followed a standard, just because you disclosed that you have not followed a particular standard, doesn't mean you are exempted. So disclosure doesn't relieve his responsibility to comply with requirements of the standard. So then what about accounting standard? First of all, accounting standards are applicable for companies. Management has to comply with accounting standards, not the auditor. Auditor has to check whether the company is preparing financial statements in compliance with applicable financial reporting framework. Applicable financial reporting framework includes accounting standards. As per the preface to the standards, accounting standards are applicable for all commercial, business, industrial enterprises. Even in your entire organization, even 1% commercial, business, industrial obligation is involved, activity is involved, accounting standards are applicable. So, applicable. If not followed, if accounting standards are applicable and organization did not follow, we have to express a qualified opinion or adverse. Suppose organization did not follow some accounting standard 28 impairment, or some India is 30, India is something related to impairment, they have not followed, and organization is so honest, they gave a disclosure in the financial statements also that they have not followed so and so standard, then auditor shall disclose without any modification. Disclose that point without any modification, because organization gave full-fledged disclosure, so you can't qualify. But disclose it in your audit report somewhere, preferably other matter paragraph, in other matter paragraph, that so and so organization has prepared financial statements, or else emphasis of matter paragraph, emphasis of matter paragraph, disclose it in emphasis of matter paragraphs to that note point which talks about non-compliance with accounting standard by the organization. Just highlight it in emphasis of matter paragraph. Emphasis of matter paragraph, what are we doing? Highlighting without modification. That's it. And sometimes some organizations are not liable for accounting standards where they are not applicable. In such a case, we have to give a disclosure in audit report without making a modification. That's it. With this, preface is over. But remember, the preface in ICAI book study material is not as simple as such. I will show you what is the preface. What is there in the preface, I will show you. Just a minute. Preface means this entire content. Approximately in my material it starts with 122 page. It starts with the 122 page. Approximately it will go for some 131. So 10 pages it is there. The preface itself. This is important. Preface means what? What are standards? What are guidance notes? What are statements? How to, what are the rules and regulations related to them? What are the auditor responsibilities? How opinion paragraph, all that will change because of non-compliance with them. All that explanations I have given. That recordings will be available only for regular course. Marathon, I'm not covering this. And this information, whatever I have given here, This data is already there with you in ICA study material, introduction. You have standards on auditing, statements, guidance note. This chapter is there, right? Inside that entire introduction is about this only. That's it. Now this is about the basic introduction to standards, all that. Now let's discuss into our actual standards. Now SA 210, agreeing on terms of engagement, agreeing on terms of audit engagement, agreeing on terms of audit engagement. What is this agreeing on terms of audit engagement? It is talking about letter of engagement. What is a letter of engagement? It is a document issued by auditor to the client, okay, specifying what are they: objective and scope of audit, responsibilities of auditor, responsibilities of management, a reference to applicable financial reporting framework, a reference to expected expected form and content of audit report, reference to expected form and content of opinion and audit report, and your signature of the auditor, signature for management, place for signature for management, date and place. This is an engagement letter. This engagement letter, the auditor must issue to the management at the beginning of the audit itself. Management should take this letter, acknowledge that letter, and then send it back to the auditor. Okay, so this is an express acknowledgement. See, in any business contract you take, seller, service provider are the one who decides the terms and conditions generally, not the buyer. When you're going for a movie theater, okay, with respect to watching a movie, that particular service, who will decide terms and conditions? A movie theater owner only. You're going to a saloon, you're going to buy a video game. What are the terms and conditions of that video game? The service provider only will decide, not the buyer. Seller is the one who will decide terms and conditions. Terms of audit engagement, terms of audit contract, who will decide? Auditor only, obviously. How auditor will decide? By taking into account the law and regulation under which he is doing audit. Can terms of engagement, can I have additional terms? Yes, you can have additional terms, but your additional terms of engagement cannot be contradictory to the law and regulation. The auditor and management can agree on additional terms, but it cannot be contradictory, it cannot be against the law, it cannot be against any standard. So in such a way, the terms of engagement can be. Now sir, we understood what is an engagement letter. Okay, the engagement letter format is there in your ICA book. Okay, in ICA material, engagement letter format is clearly given. What it starts with, you have requested us that we do audit of financial statements of so and so company, all that. We are pleased to accept the appointment. So nothing but it's indirectly an acceptance letter also. Now with respect to this audit, what is our understanding about audit are conveyed to you through this letter. So objective and scope, our audit will be conducted with an objective of expression of opinion. So we do audit as per standards on auditing. We have certain inherent limitations. We only provide reasonable assurance. All that points, whatever will come in audit report, responsibilities of auditor paragraph, all that points will come in engagement letter also. At the beginning itself, we are telling the management, look management, I am not going to identify all the deficiencies. I am not going to identify all the mistakes. I am not going to identify all the frauds. We have some limitations. Make a note of this. Sign it. Only if you agree each and every term in this. Only if you sign it and give it to us, one copy for you, one copy for me, only then I will start my audit. Until and then I will not start this audit. And issuing engagement letter is one of the preliminary engagement activity as per SA 300. As per SA 300, this is one of the preliminary engagement activity. That's it. Now, sir, should we issue engagement letter every year? Suppose I am a recurring auditor, sir. I'm a recurring auditor. I have been appointed as an auditor for this non-government company for a period of 5 years. Okay, for one AGM conclusion to 6th AGM conclusion. I am the auditor of Reliance company, sir, from 39th AGM conclusion to 44th AGM conclusion. Okay, so now should I send engagement letter every year? Not required. In case of recurring audit, issue of letter of engagement every year is not required. However, there are some circumstances where you must issue letter of engagement every year. Example, what are the issues where you have to issue letter of engagement? Okay, change of management have been changed, change of owners have been changed, misunderstanding of the original terms, law and regulations have changed, standard requires it compulsorily to issue letter of engagement. Examples. In these circumstances, you must issue letter of engagement once again, even though it is a recurring audit. Sir, I issued letter of engagement, sir. Logically speaking, management should read it and sign it and send it back. But management asked me to change some terms and conditions. I mentioned objective and scope, responsibilities of auditor, responsibilities of management, all that I mentioned, sir. But management is asking me to change some terms and conditions. What should I do, sir? If management is asking for changes in terms of audit engagement, if management is requesting or asking the auditor for changes in terms of audit engagement, look, are the changes acceptable? Are they acceptable? Are they reasonable? Are they justified? If so, accept it. Suppose if the changes made are not justified, not legal, not acceptable, reject. Don't accept the changes. Sir, I rejected changes, sir. Management is also reluctant. They don't want to cooperate with me for conducting audit. They are not letting me to do audit properly. Okay, in such a case, what can I do? Resign. You have a right to withdraw, right? Resign. And you know what? Resignation of auditor is dealt under Companies Act 140 subsection 2. 140 subsection 3 talks about penalty. There is an amendment inside that. We'll discuss in amendment session. Because the word resignation came, I'm just telling you once again that. This is what SCA 210 is all about. Simply SCA 210 is this. Okay, don't worry. I will show you the standard also. So this is 210. So what is the objective of auditor as per SCA 210? Okay, what are the limitation? Suppose what if there is a limitation in scope of audit prior to audit acceptance? Before you accept audit itself, management is putting so many restrictions. Don't do that, don't do this, all that. Don't accept that audit. Okay, the auditor shall not accept the audit if the auditor has determined financial reporting framework is unacceptable. Suppose if the company prepared financials using unacceptable framework, a framework which do not apply, auditor shall not accept. Or if management has not given their consent for engagement letter, terms of engagement, if agreement of the management means nothing but consent of the management, if it is not obtained, auditor shall not accept. This itself can be asked as a 3 marks question. What are the circumstances where auditor shall not accept the audit engagement as per SCA 210? Form and content of audit engagement. Form and content of audit engagement. Letter especially. See, letter of engagement is highly recommendatory. Okay, especially in case of non-stat audit is very important, because in stat audit, what is my duty, what is your duty, everything is given in the law. Even though we have a dispute, there is a lawmaker who can resolve us. What about non-stat audit? You approached me voluntarily, you appointed me voluntarily, the terms and conditions are completely internal to us. Here the chances of disputes are higher. If the dispute is high, who is correct? Are you correct? Am I correct? Who can decide? So a letter is required, a contract is required. So letter of engagement is highly recommendatory in case of non-statutory audit. But irrespective of that, the ICI suggests whether you're doing stat audit, non-stat audit, IT return you are filing for an individual, tax audit you are filing for an individual, for every type of work you are accepting, have a formal engagement letter. But in real life practice, only for company audits we are giving engagement letters. So you need to, tomorrow, you're opening a practice tomorrow, suppose, let us assume, you need to ensure that you comply with this. Contents of an engagement letter: title, addressee, objective and scope, responsibilities of auditor, responsibilities of management, reference to applicable financial reporting framework. Please add one more point. Reference to expected form and content of opinion. Expected form and content of the opinion of the auditor or audit report. Signature of the auditor, signature of the client confirming acceptance of terms. If the client did not sign and give acceptance, so don't accept the auditor, and date and place. So this format is already explained in my regular class by taking exclusive illustration which is there in the ICS study material. Now, issuance of engagement letter during recurring audit. In recurring audit, engagement letter generally it is not required. Whether in recurring audit, do we need to reissue the letter of engagement? It's absolutely professional judgment of the auditor. However, there are some circumstances where issue of letter of engagement is compulsory. These are the circumstances. Write any 4 in exam. Changes in terms. Why first of all client will ask you to change terms? Circumstances might change. Misunderstanding of the terms. He want to restrict the scope of the auditor. If the changes are reasonable justification, accept. Not reasonable, no reasonable justification, don't accept. If the client is not letting you to do the audit, withdraw from the audit. That is SCA 210. I hope everyone understood. Just a minute. Next. So that's about SCA 210. Then with respect to after SA 210, in the remaining standards, that what we need to discuss is 250. Auditors' responsibilities relating to laws and regulations in an audit of financial statements. From here, please look into carefully. SA 250, sorry. So, SA 250. Auditors' responsibilities relating to laws and regulations in an audit of financial statements. This standard is also having a different heading: consideration of laws and regulations in an audit of financial statements. Consideration of laws and regulations in an audit of financial statements. This is the actual heading of the standard, but in some books this heading is also being used. In some books this heading is also being used. Consideration of laws and regulations in an audit of financial statement. Consideration of by whom? Who will consider? Auditor. Sir, first of all, let us once understand what is our objective of audit. Our objective of audit is to express opinion on financial statements, whether they are free from material misstatements. So my objective is to give opinion on the financials. No, amounts are correct or not. What is the link between these amounts and laws and regulations? Suppose, income tax is a law. As per income tax law, we need to deduct TDS for various employees, or we need to collect GST for every sale we are making. We need to collect GST. We all know in GST, you would have learned in GST, whether you collect GST at the right rate or wrong rate doesn't matter. Whether you collect GST or not from the customer also doesn't matter. Whatever you are collecting, we assume it is inclusive of GST. We do a calculation by backward approach. You have collected 100 rupees. GST rate is applicable 18. So by 118, we will calculate how much GST that you have to pay. So this is what GST law says. Sir, I have not collected GST. Am I exempted? No, man. This is how we calculate and collect from you. Whether you collect it from customer or not doesn't matter. Suppose a manufacturer wrongly applied GST provision and consider his product as an exempted supply, and he did not collect any GST on that. Now tell me, just because he did not collect GST, does it mean his liability waived? No. But since he did not collect GST, he did not even recognize GST. He did not even recognize GST liability in the balance sheet. Now the balance sheet liability is understated because GST liability is not recognized. But tell me, tomorrow if the department detect it, what happens? They will collect retrospectively from the day one. Yes or no? So it's a liability not recognized in the balance sheet. Is it a material misstatement? Non-recognition of a liability? Yes, a material misstatement. Here, why material misstatement happened? Because of wrong interpretation of law. Is it a compliance of law or non-compliance of law? Non-compliance of law. Now you see how laws and regulations impact financial statements. And there are some other laws. They don't impact financials at all. See, laws and regulations is a very big term. See, you take a pharma company. You take a defense manufacturing company. The laws and regulations applicable to them are enormous. Not only finance related laws, not only revenue related laws. For them, various other administrative laws, privacy laws applicable. Okay, if they do not comply with those laws, they have to pay penalty also. It may, so like let's assume a company has violated pollution norm. Immediately when the pollution norm is violated, if the environmental authorities have detected it, they levy a penalty. But when they violated a pollution norm, does it affect financial statements directly because of emitting excess pollution, because of emitting higher pollution? Your balance sheet, asset overstatement, understatement, liability overstatement, understatement. Is there any such effect because of these types of laws, non-compliances? No. So what SCA 250 divides, dear Mr. Auditor, we are dividing laws into two types. One is type 1, another one is type 2 laws. Why, sir? Why you are dividing into two types of laws? I know I am familiar only with the type 1 laws. I am not familiar with the type 2 laws. I am not familiar with meteorological laws. I am not familiar with meteorological laws. I am not familiar with the pollution laws. I am not familiar with product safety laws. I am not familiar with consumer safety laws. I am not familiar with food safety laws, factory related laws and regulations. I am not at all having any idea. But the standard simply uses the word laws and regulations. So laws and regulations are two types. Those laws and regulations, as an auditor, I understand. Another laws and regulations which I don't understand, which do not even have impact on financial statements. So what is my responsibility under the standard relating to type 1 loss, relating to type 2 loss? Now type 1 loss are what? Type 1 laws are those laws and regulations which have direct effect. Those laws and regulations which have direct effect on determination of material amounts or disclosures, which have a direct effect on amounts and disclosures in financial statements. Example, all statutory due related laws in CARO, income tax, GST, sales tax, VAT, customs duty, provident fund, ESI, all these laws and regulations will have type 1. Type 2, these are other laws and regulations. These are other laws and regulations. Okay, other laws and regulations. If there is a non-compliance with them, it will not have any direct effect. It will not have any direct effect on the financial statements, amounts or disclosure. But if you fail to comply, if you do not comply, they may attract material penalties at a future date. So they indirectly affect financials, not current year, but at a future date. So these laws and regulations are called as other laws and regulations. Okay, what is auditor responsibility, sir? What is auditor responsibility? They may ask you a straight question, 4 marks question. Write about auditor responsibilities relating to laws and regulations as per SA 250. So type 1 loss you have to write, type 2 loss means what you have to write, and then you have to write responsibility. Type 1 loss, what auditor responsibility? Auditor has to obtain reasonable assurance, sufficient appropriate evidence whether all type 1 laws and regulations are complied. Auditor has to get sufficient appropriate evidence whether type 1 laws and regulations are complied or not. We take a list of all type 1 laws, we do compute, reconciliation, recomputation of all statutory dues, we check it with actual payments, challans, all that, and excess payment, short payment, delayed payment, all that we will identify, and we will identify non-compliances. So we do a complete exhaustive checking. Whereas type 2 loss, what is auditor responsibility? Auditor has to perform specified audit procedure or limited audit procedure, or also called as specified audit procedure, or also called as limited audit procedure. Standard uses the word SAP, specified audit procedure. The auditor has to perform specified audit procedure to identify circumstances of non-compliances, if any. You just have to try to identify flaws in that. Sir, every type 2 law complied or not? I can't check. But is there any non-compliance? You can easily point out. Whereas type 1 law, you are not only liable for detecting non-compliance, you have to check whether everything is complied, every condition is complied, every rule is complied. This is an exhaustive checking. There it is limited checking. You just perform limited audit procedure, specified audit procedure. You just try to identify, is there any instances, is there any incidents, is there any circumstances of non-compliance? Only that you will perform with respect to type 2 law. Next. Okay, so what do you mean by limited audit procedure, sir? What is limited audit procedure? Limited audit procedure for type 2 law, you just inquire management, top management, those charged with governance, is there any non-compliance with laws and regulations which are of type 2? Inquire and inspect correspondence with relevant licensing authority, just to check the communication happened between licensing authorities, type 2 licensing authorities. Inquire lawyers and all to know whether is there any non-compliance or pending cases related to type 2 laws and regulations. Basically, you don't have any skill, you don't have any ability, you don't have any technical competence to understand type 2 laws. So you just depend on the management, you depend on the lawyers, you depend on the regulatory authorities for identifying non-compliances. Whereas type 1 law, you have to do entire audit procedure. Okay, you have to do entire audit procedure. What is the audit procedure for type 1 loss? What is the audit procedure for type 1 loss? It is there in the main standard. So to that extent, it is not that required. That extent, it is not required. So what is the objective of auditor? Obtain sufficient appropriate evidence regarding compliance with type 1 loss. To perform limited audit procedure. In fact, the standard uses the word specified audit procedure to help identify incidents of non-compliance with type 2 and accordingly report identified non-compliance with laws and regulations. Whatever non-compliances you identified with respect to laws and regulations, report it appropriately. Sir, how to report? How to report? How to report? Suppose I identified a non-compliance. It may be type 1 or type 2. It's a non-compliance. It's a non-compliance. Every non-compliance with law and regulation shall be disclosed in the financial statements, because financial statements, notes to accounts will make an affirmation. Will make an affirmation by the management. Management will make a representation in that. What? We comply with all laws and regulations. But actually there is a non-compliance. Suppose if management agreed to disclose it adequately in the financial statements and board report, wherever they are required to, if they disclose it adequately, we give unmodified opinion. And whatever the disclosed in the financials, we will highlight it if possible under emphasis of matter para, you can highlight it. Suppose management not disclosed, or inadequately they disclosed, then we will give modified opinion, which may be qualified or adverse. Suppose management is not permitting me to do audit procedure with respect to identifying non-compliances. I want to identify non-compliances. Management is not letting me to do that. If there is a such kind of situation, you give qualified or disclaimer of opinion, because you are unable to get evidence, unable to obtain sufficient appropriate evidence. Sir, just a minute. Next. Sir, okay, non-compliance, all that. Will there be any indicators? Yes, there are indicators of non-compliance. There are some indicators of non-compliances. What are the indicators of non-compliance? First of all, what do you mean by a non-compliance? It's an act of omission with a rule, or an act of commission and a violation, okay, either intentional or unintentional, which are contrary against prevailing laws and regulations. Okay, so these acts, no, whether it is omission and commission, it may be in the name of the entity, on behalf of those charged, whoever they, anybody can do. Non-compliance does not include personal misconduct of the employee. An employee violated traffic rule while coming to the office. Do you think that's a non-compliance related to the enterprise and shall be disclosed in the financial statements? Not required. What are the indicators of non-compliance? Suppose some investigation is going on by regulatory authority. Some investigation is going on. It shows a symptom. Hey, why investigation is going on? What's wrong? Payment of fines. In the profit and loss account, fines and penalties, ledger account is there. For what purpose they paid fine or penalty? Fine or penalty is paid for non-compliances. For what non-compliance is there? Identify. Okay. Payment for unspecified services or loans. Payment for unspecified. In some organization, they may put other expenses, establishment expenses, miscellaneous expenditure. There will not be any bill for that. It shows some bribe. Bribe why they paid? To cover a non-compliance. So you can identify. Payments in cash. Okay, you are violating income tax law. Unusual payment towards legal and retainership fee. You see legal expense account, huge amount is there. Why are you paying so much of legal expenses account? Why are you paying so much of legal fee? What happened? Look into it. Transactions with companies registered in tax haven, related party transaction. Okay, tax related non-compliance could have been there. Unauthorized transactions, adverse media comment. These are all symptoms, indicators that there might be some non-compliances. These are all symptoms that there might be some non-compliances with laws and regulations. And what is the reporting? I already covered. The reporting of non-compliance I already covered. So that's about SA 250. Almost major standard have covered. First of all, by the way, tell me, whose responsibility primarily to comply with laws and regulations? Management responsibility. Management is the one primarily responsible for complying with all laws and regulations. Put internal controls, nothing but compliance controls. We call it as compliance control. From the point of view of COSO model, the control objectives are broadly three types: operating controls, financial controls, compliance controls. So organization has to set up and implement internal controls, namely compliance controls, to comply with the laws and regulations applicable to it from time to time. That's it. So that's about SA 250 and SA 210. We covered two standards and we also covered introduction. Then just 1 minute. So with that, SA 250, auditor responsibilities or consideration of laws and regulations consideration of laws and regulations in an audit of financial statements is completed. And now we are going to discuss SA 402, one of the lengthiest standard after SA 315, and one of the tricky standard which many students don't even understand at all. Yes, I'm very confident that 90% of the students don't understand at all what is this standard is for. So I will make it little more clear. I will not explain it faster, but I will make it little slow. Okay, but don't expect too much detail. Now, what is SA 402? Audit considerations. Audit considerations relating to an entity using service organization. Let's take this example. Let's take this example. Is it recording? Yeah. Auditor responsibilities or audit considerations relating to an entity using service organization. Now, there are some terms: user entity, user auditor, service organization, service auditor, subservice organization, service auditor of subservice organization, complementary user entity control, CUEC, complementary user entity controls, control systems, control descriptions. There are some more terms, not that required, okay, but these are the basic terms. Suppose I'm doing audit of an entity. I'm the auditor, there is a client. Let us assume I'm the auditor of Tata Consultancy Services, Mr. A. Now, TCS is user entity. Mr. A is the user auditor. Now, TCS is having approximately 5 lakh employees. 5 lakh employees. During COVID times, let us assume TCS is unable to process payroll on time properly because of the work from home, all that HR department, payroll department, some of them are affected with COVID, all that. So there is a big hectic process happened. I'm creating an example and giving you. Don't go and ask a TCS employee, is this happened? Okay, just an example I'm taking. So 5 lakh employees. What TCS did is entire payroll processing, entire TDS processing, okay, entire payroll as well as the TDS related to salaries. Okay, this entire processing has been outsourced to some payroll execution company, a company which is exclusively engaged in payroll processes for various companies. So TCS delegated that responsibility to payroll companies. Okay, so what this company has to do, payroll company? Now, one work of the organization. So we are doing audit of TCS, no? Payroll related entire computations, employee attendance, salary computations on a monthly basis, TDS deductibility, everything is calculated by this payroll company. Let us assume payroll private limited. Let us assume that's a payroll private limited. Okay, so this company is taking care of entire payroll operations of Tata Consultancy Services. Now, 143 subsection 3 clause I. As an auditor, we have to comment on operating effectiveness of internal financial controls over financial reporting. Yes or no? We have to comment on operating effectiveness of internal financial controls over financial reporting. Now, internal financial controls means what? Those controls which have a direct effect on financial statements. Those controls which influence, those controls if they fail, a control if fails, result in material misstatement in the financial statements, then that's a financial control. A particular control if failed, if there is a deficiency, if it did not work properly, it results into a material misstatement in the financial statement, and all that controls are financial controls. If payroll processing is not adequately done, if payroll processing is not properly done, it may either lead to payment of excess salary or payment of under salary error. It leads to a misstatement in the financial statements. Yes or no? It leads to a misstatement in the financial statements. If there is a deficiency in the payroll processing, the payroll company might do a fraud. So, okay, as an auditor, I need to understand all the financial controls of the Tata Consultancy Services, no doubt. But payroll related financial controls, they are not implementing. Payroll related controls are being implemented by payroll company, outsourced. Now, as an auditor, as part of my audit duty, I need to give my opinion on operating effectiveness of financial controls. But payroll related controls are not implemented by TCS. They are implemented by outsourced company. Now that company is called as service organization. Now there is a standard called SA 3402. There is a standard called SA 3402. Now payroll processing limited, it processes payrolls of various companies. Our company, it is only one customer for Payroll Private Limited. Payroll Private Limited has many other customers. Infosys is there, Wipro is there, Reliance is there, Indian Railways is there. There are so many customers it has. Now, as an auditor of TCS, I want to check whether payroll controls are effectively implemented, because I need to check and comment on IFC. So as an auditor, I want to check whether payroll controls are properly being implemented or not. So I called Payroll Private Limited. Dear Payroll Private Limited, I am coming for audit of payroll controls at you because I am the auditor of TCS. Their payroll processes you are doing. Payroll Processing Limited replied, sir, TCS alone is not one customer. Okay, we are having 150 clients. Do you think all 150 company auditors will come and do audit of our? When do we prepare our operations? When do we execute our operations? If every customer related auditor coming and doing audit, how can we do? Now, as an auditor of TCS, I raised my genuine concern. What I raised, so, okay, fine, okay, okay. So you're having a trouble. If I come, everybody else also will come. Okay, fine. But how do I know whether your controls are effective? That's why we have an assurance auditor report, sir. We have an assurance auditor. We have appointed an auditor under SA 3402 standard. In compliance with SA 3402 standard, we appointed one assurance auditor. He gave an assurance report. He gave an assurance report. Assurance reports are two types, type 1 report and type 2 report. As per SA 3402, an auditor who has been appointed for performing assurance on other than historical financial information. Here, I am not checking financial information of payroll private limited. The assurance auditor is checking controls aspects. So he is giving assurance report, type 1 report, or he may give assurance report, type 2 report. Whatever report, for whatever the purpose that payroll company appointed, no, that report he will give. Type 1 and type 2. So the payroll company replied me, I am the auditor of TCS. They replied me, sir, wait, I will send you type 1 report or type 2 report, both to you, or I will send you type 2 report. Take it. Okay, see, our assurance auditor said our controls are operating effectively. We have a description of systems, we have a description of controls, control objectives, and auditors have reviewed it, and auditors have checked. Our auditors also performed a test of controls, and they are effective operatingly. That report, assurance auditor's report, is given. Assurance auditor's report is given. Okay, so that report is being sent to the TCS auditor. Not only TCS auditor, for every customer there is an auditor, right? To all of them, this company forwarded type 1, type 2 reports. So now by using the type 1 report and type 2 report, how do you conclude? Controls at service organization are operating effectively. That is what the standard is dealing with. Until now, whatever I gave is only background. Until now, whatever I said is only background. Okay, so service organization is payroll. They have assurance auditor, right? We call him as service auditor. Now, in service organization, there are some services, database maintenance services, computer maintenance services, because it's a company which is processing payroll. Not only payroll of one company. This company processes payrolls of various 150, 200 big blue chip companies. So they have to use a robust software. And this software maintenance is delegated to some other service organization, cloud services. Okay, now sub-service organization is there. Okay, now as an auditor, I need to comment on financial controls of TCS, payroll financial controls. But these payroll financial controls are operated by Payroll Private Limited. So I requested type 1, type 2 report of Payroll Private Limited. Now this Payroll Private Limited outsourced technical services, some technical services to sub-service organization. But what I felt is that technical services is not related to financial statement, so it's okay. But suppose this Payroll Private Limited, this service organization, outsourced some services related to payment, payroll processing, financial aspect to another sub-service organization. It is a financial control affecting my control. It is a financial process. It's a financial process affecting my financial statements indirectly. In such a case, I will ask for sub-service organization type 1, type 2 report. Suppose the standard talks about two methods. It is very bit advanced. I hope 99% I'm very sure you would have not heard of this. Carve out approach, inclusive method. There are two methods. Carve out method, inclusive method. Even to my regular batch students, I didn't tell this. Okay, even if they are looking at this, they will also be shocked. What is this carve out method, inclusive method? See now, okay, let me actually discuss the content from the material. So along with that, I will discuss. So SA 402, audit considerations related to entity using service organization. What is service organization? It is a third party organization that provides services to our client user entity, Tata Consultancy Services, which are part of information systems relevant to financial reporting, payroll. Now, service organization systems. So as an auditor, first of all, TCS will give to payroll company based on their systems. These are policies and procedures designed, implemented, maintained by service organization to provide TCS user entity with the services covered by service auditor. Example, service auditor is covering assurance services. Who is user entity? An entity that uses service organization whose financials are being audited by service user auditor. Who is user auditor? Auditor of financial statements of user entity. Who is service auditor? Auditor of the service organization. Who is giving assurance report? Look at who is giving assurance report on controls of service organization at the request of service organization. What is sub-service organization? Sub-service organization is a service organization whose services are used by another service organization, whose services are used by user entity for whom we are the auditors. So that much connection is there. Now, report from service organization. We will get type 1 report, we will get type 2 report. What is type 1 report? It is just a report on description, design and controls. Description and design of controls at service organization. So type 1 report will consist of two components. Description by management of service organization about service organization systems, controls, objective related controls that has been designed and implemented at a particular specific date, 31st March, let us assume. And it also consists of another report by service auditor, assurance. He is providing reasonable assurance on description of systems, control objectives related, controls exist. Controls are formulated, policies are formulated, policies exist. That's it. He's only talking about existence of control. He is not talking about operating effectiveness. If at all service auditor assurance report, if the service auditor assurance report do not talk about operating effectiveness of controls at service organization, it's a type 1 report. If service auditor assurance report talks about operating effectiveness of controls at service organization, it's a type 2 report. It's a type 2 report. So in type 2 report, he will not only talk about, in type 2 report, these points will be there. Description by management regarding their systems, controls, all that. Service auditor report will be there regarding existence of system. Service auditor report will be there regarding operating effectiveness of controls. And service auditor will also give additional report. Service auditor will also mention description of what test of controls he performed, what is the result. So he will talk about operating effectiveness by testing controls. How do service auditor in the service organization understands whether controls are working effectively? By performing test of controls. After he performed test of controls, based on the results he got, he will talk about operating effectiveness. In order to talk about operating effectiveness, first of all, are there systems, controls that exist? So he will talk about existence. He will talk about existence. Who gave this information about existence of controls? Management gave information about existence of controls, all that. Now, as an auditor, which report we generally want? A type 2 report we want. We generally prefer, we generally ask for type 2. In international standards, it is called as SOC report 1, SOC report 2, SOC 1, SOC 2 report. Now, there is another term called complementary user entity controls. If you look at the definition of complementary user entity controls, these are the controls that service organization assumes. Okay, assumes. Okay, so at the request or which are implemented by user entity, but that one simply I made controls implemented by user entity in service organization to achieve control objectives. Now, in our example itself, TCS gave payroll operations to Payroll Private Limited. Okay. Now, in Payroll Private Limited, TCS put one additional control, specific control of TCS. This Payroll Processing Limited will generally do not follow that control. They don't have that control. But TCS put an additional control. Payroll processing have some policies, procedures, how to process payroll. They have some standard policies, standard procedures, standard operating practices, which they apply not only for TCS. They will apply to all the clients. On those controls, on those systems, type 1, type 2 report only will be there, type 2 report. Now, in the payroll processing, TCS being a very big client, they put an additional control. They put an additional control in the payroll processing, and that is called complementary user entity control. Complementary control belonging to user entity. Example, TCS, a simple example I'll take. Okay, simple example. TCS will send payroll data related to payroll, number of employees, attendance during the month, salary agreed with the employee as per the agreements. All that agreements also they will be forwarding. Now, let us assume out of 5 lakh employees, in the month of August 2020, let us assume 2021 financial year, August 2020, some approximately 20,000 employees were eligible for increments, promotions, increments, bonus. Okay. Now, generally, Payroll Processing Limited can directly process. Okay, they just have to tell the final figure to the TCS. That fellow will write a check. A concerned person will write a check and give it to the payroll processing company. They will talk with the bank and execute the payroll. And the employees will be credited with the salary by month end. But increments whenever there, payroll processing limited should get an express approval. Okay, generally this express approval is not as part of the payroll processing private limited controls. It is not there. Getting express approval from user entity with respect to increments, this control is not there. This is a control additionally put by TCS. So that control is called as complementary user entity control. Where complementary user entity control comes, I will show you. Don't worry. Now, services provided by service organizations. Sir, service organizations means there are so many, sir. There are data service organizations. There are backup service organizations. There are disaster recovery planning service organization services. There are payroll processing service organizations. So TCS have outsourced so many activities. Which services are relevant to me? This itself can be asked as a 3 marks question or 6 marks question. 4 marks question. This itself, services provided by service organization are relevant to audit. If they are relevant to financial reporting, if such service effect, okay, services provided by service organization are relevant for the auditor if they are relevant to financial reporting, and if such services affect a significant class of transactions, significant events and conditions, processing of transaction it is affecting, related accounting records it is affecting, financial reporting process including accounting estimates and disclosures it is affecting, then services provided by that service organization is relevant for the user auditor, user entity. Accordingly, we should get either type 1 report or type 2 report. Type 1, objective of SA 402. What actually SA 402 wants? First, obtain an understanding of nature and significance of services provided by service organization. What services service organization is providing? First, get an idea. What is their effect on user entity, internal control relevant to audit? Design and perform audit procedure responsive to those risks. Whatever the risk you found, based on that, perform audit. So, the user auditor shall obtain an understanding of services provided by service organization. Whatever service organization services they are providing, no, user auditor has to understand what services they are providing, where I want type 1 report, where I want type 2 report. Understand first what service they are providing. Accordingly, identify the risk. Accordingly, ask for the report. So, nature of services provided by service organization. In our example, payroll services and their significance to the user entity. Payroll occupies 30% of the total TCS expenditure. Nature and materiality of the transactions processed. Of course, it's very material. Degree of interaction happening between service organization and our client. How far our client and service organization interacting with each other. What is the nature of relationship? Are they related parties or unrelated parties? And what are the terms and conditions? So check it out. Suppose you are unable to obtain sufficient information from user entity. User entity, you are asking, dear user entity, you and service organization are coming together. What is your relationship? So you are trying to get all this data, but you are unable to get that data. In such a case, what auditor has to do? Perform alternative procedure. What? Obtain type 1 report, obtain type 2 report. Contact directly service organization through the user entity. This is called external confirmation. Visit the service organization for obtaining information about controls. Or use another auditor, send another auditor to service organization, get information, which is practically do not happen. Maybe external confirmation is possible, type 1, type 2 report. These are the ones which are practically happening. Now, when you're using a type 1 report or type 2 report, why are you using? It's a support for auditors understanding of service organization controls. What are the controls of service organization? What are the systems they follow? Because if the systems they follow, controls they follow, if they are effective, I assume in my entity financial controls are also effective. Accordingly, 143 subsection 3 clause I can comment operating effectively, positive comment. Before using type 1 type 2 report, the user auditor shall satisfy what service auditor's professional competence. So service organization has an auditor, right? He is only giving type 1 type 2 report, right? First of all, what is his competence? Is he competent? Is he having experience to give this kind of report? Check it out. Okay. Except in case member of ICA. Suppose if the service auditor is a member of ICA, no need to check his competence, all that, because he's trained like you. And what is the adequacy of standards under which T1 T2 report was issued? By following which standards he issued T1 T2? Further, no, this requirement do not apply if he is following, if he is a member of ICA. If he is a member of ICA, he follow obviously 3402, which is also issued by ICA. So in such a case, adequacy of standards, techniques, principles he follow to give type 1 type 2 report, you need not verify. Otherwise, if he is a non-member of ICA, he is not a member of ICA, you need to check his professional competence, what standards he is following, what benchmarks he is using, what frameworks he is following in order to issue type 1 or type 2 report. See, service organization assurance auditor, no, he need not be chartered accountant. He can be anybody. He can be certified internal auditor. He can be certified public accountant. He can be ACCA, whatever. Suppose, okay, I checked his competence. I decided, let me use type 1 or type 2 report. Let me use type 1 or type 2 report. Please evaluate whether the report type 1 or type 2, whether the date and period of the report, are they appropriate for audit purpose? You are doing audit of 2021. The audit report type 1, type 2 assurance report is belonging to 1920. What is the use? The sufficient and appropriate evidence provided by report for understanding user entities internal control relevant to audit. Now type 1, type 2 report, are they describing about systems controls sufficiently so that you understand what are all the internal control service organization is following? Check it out. Nothing but you are checking here completeness of type 1 and type 2 report. Determine whether user entity has designed and implemented complementary user entity. Is there any complementary user entity controls inside that service organization which are implemented by user entity? Complementary user entity controls, no. Complementary user entity controls, no. They were not audited by assurance auditor. Understand? Service organization has an assurance auditor, right? He will not do audit of complementary user entity controls. He cannot do that. Because complementary user entity controls are implemented by whom? Our company, TCS. That's it. Now sometimes a test of controls is required. Test of controls, why? If you want to get type 2 report, okay, I mean suppose you got a type 1 report, operating effectiveness related information you don't know, you got only type 1 report. How they are effectively operating you don't know. So in such a case, operating effectiveness also you have to test. If the user auditor is required to obtain assurance about operating effectiveness, suppose you want to know operating effectiveness of controls, do one thing, you perform test of controls at service organization. Or if service organization already has a type 2 report, type 2 report is what? They appointed assurance auditor, he verified the systems, he verified controls, he verified operating effectiveness, he himself performed test of controls. If available, get that. If that is not there, you perform test of controls or send another auditor to perform test of controls at service organization on behalf of user auditor. Generally, which is popular? A is popular. A is popular. Most of the audits in most of the service organizations, type 2 reports will be there. Type 1 report they will not encourage. Type 2 report only they will have. Type 1, type 2 options are given under SA 3402. SA 3402. Using the type 2 report as an evidence for operating effectiveness of controls at service organization. So can you use type 2 report as an evidence for operating effectiveness of? Yes, you can use. Before using, please evaluate whether the date and period covered by type 2 report, are they effective? Okay, check it out. Are they appropriate for audit purpose? Type 2 report belongs to 2021. My audit is also for 2021. Use it. Test operating effectiveness of complementary user entity controls, because type 2 report do not cover complementary user entity controls. So that's why you have to check how far complementary user entity controls are effective, because complementary user entity controls nobody can review. It is you, user entity, your client has implemented. So you need to check this. And adequacy of time period covered by test of controls. Adequacy of time period covered by test of controls. Whether test of controls in the type 2 report by service auditor, no, for what period he covered, is it adequate? Check it out. Evaluate service auditor's report on test of controls performed by him. Whatever test of controls he performed, check it out. Suppose if type 1, type 2 report excludes services of sub-service organization, this is called carve-out method. This is called carve-out method. Carve-out method. And those are relevant to audit of user entity. And those are relevant to audit of user entity. Some service organization, some processes, they outsource it to sub-service organization. And that controls are relevant for audit of user entity. It is directly related to financials. In such a case, whatever procedures we discussed now, type 1 report, type 2 report, all that, same procedure apply to sub-service organization also. Treat it as another service organization, apply entire standard once again. Finally, what is the reporting by user auditor after SA 402 audit procedures and all? Okay, suppose you are unable to obtain sufficient appropriate evidence. Then modify the opinion. Okay, modify the opinion. And sir, can I give a reference to service auditor report, assurance report, type 1, type 2 reports are there? Can I give reference to in auditor report, in my audit report? Can I refer about them? SA 610 logic you apply. SA 610 logic. When you are using work of auditor expert, Can you use about expert name in audit report? If you are giving unmodified opinion, you don't have any problem with expert report, leave it. Suppose because based on using expert report, it contains some qualifications and these are very material to the company. You felt it is very right. Financials are materially stated. In order to make the user, in order to make the shareholder understand why you are giving modified opinion, you may refer about auditor's expert. Same logic apply here also. Same logic apply here also. Oh my God. So that's about SA 402. What I'll suggest you is once again watch this video in a repeat mode. Once again repeat the video. 402 whatever I covered in the last, once again repeat the video. So all the sequence of events I covered here. See, covering CA final audit marathon. Okay, where we have to cover whatever the topic we discuss, we have to cover full discussion on that topic. Where I am hardly covering 50 to 60% of the syllabus, as I told. That itself takes 20 hours approximately. 20, which I'm putting in YouTube. And there are so many videos which are available where they say 100% syllabus covered in 10 hours. It is impossible. You can see the speed at which I am going. Okay, maybe some of you might feel I'm going too fast. Already this is 6th or 7th hour. Part 6, 6th hour probably, or 7th hour of marathon. Okay, still we are at the 3rd chapter only. We completed only audit reporting. Now we started standards. Standards also fully not completed. We discussed 210, 250, 402. Still we have 501, 505, 510, 550, 560, 580. Think how much time it will take. Okay, so once we complete that, we need to think, we need to read, we need to discuss corporate governance and audit committee, some important topics except LODR regulations. Then we need to discuss peer review and quality review. Then we need to discuss about PSU audit, then bank audit, then company audit, then ethics I will come. Okay, some students are asking instead of ethics, can you upload risk assessment automated environment chapter? I will think of it. So imagine how much time they will take. Still pending topics, almost 6 to 7 hours of marathon already completed, some 5 to 6 hours already completed. Still we hardly discussed that 10% to 20% of the syllabus only. So it is impossible for anybody to cover in a rapid revision marathon session within 10 hours entire audit. It's impossible. Don't even believe you. That's it. So with this, I'm winding up part 6 session. In the next part, I am going to discuss about 501, 505, 510, 550, 560, 580. All the standards I will cover in the next part itself. Okay, already I covered basic introduction. I told you need to read the study material, compulsorily the content. Those who are my students, you can directly read from the material which I provided. But others, if you think preface reading is not relevant, you are wrong. You have to do a preface reading. So standards, some 50-60 pages content is there in ICA material. First chapter, that compulsorily you have to read. That's it. Okay, carry on. Come to the next session. So now we are going to discuss part 7. Now it is part 7 of the marathon. In this part 7, what I am going to discuss is, first let me explain what I am going to cover in this part 7. 501 I am going to cover, 505 I am going to cover, 510 I am going to cover. 3 standards I am going to cover in part 7. After part 7, part 8 I will take. There I will be covering 550, 560, 580, standard on quality control, SA 220. These 5 standards together I will be covering as part of part 8. Right now we are discussing part 7 CA final marathon. In part 8 I will be covering this. Now before I start with part 7, in part 6 we discussed 402 standard, right? Relating to that, I just want to show one important item. Now I explained this SA 402 from the book which I used. I will do one thing. Only 402 standard smart notes I will make it available. I will make it available online. Okay, I will make it available online. Where you will get this material, SA 402. Please download our applications, RayStaff for CA and CMA. We have an application called RayStaff for CA and CMA. Please download that application. Inside that application, Log in first. There will be an option called main menu. Inside that main menu, study material. Inside that CA final, you will understand. SA 402 material I will keep. SA 402 material I will keep PDF copy. You can take download it from Android mobile also. You can download. Okay. If you are using an iOS mobile, Apple, from App Store, download an app called Class Plus app. Use our organization called JKSAA. For iPhone user, this approach. Okay, JKSAA. Then log in with your phone number, then download. But in iPhone, you can't download the file. So use Android phone only for downloading. Download and take a printout in black and white. That is also enough. Further, SA 402, the smart notes which I am giving you, this is only for guidance. But you should always use the actual content that is given in study material. The relevant points are paragraph 3, 7, 8, 9, 12, 13, 14, 16, 17, 18, 19, 20, 21, 22. These paragraphs are only what I covered in this smart notes. This is from direct study material pronouncement book 402. These paragraph you must read. After you read this, after you listen to that marathon part 6, whatever 402 content, some 25 minutes to 30 minutes I discussed, after listening to that, read this once again, then go to SA 402 main material pronouncement. Inside that, these point you have to read. Please take a screenshot of this and accordingly follow. SA 402 is also an important standard. Now coming to coming to our this one, part 7 marathon. Standards only, standards related discussion. SA 501, 505, 510. So what is SA 501? SA 501, it's an additional standard on audit evidence. It's an additional standard on audit evidence. So audit evidence, specific considerations for selected items. Now the standard selected three items. One is inventory. Another one is litigations and claims. The third one is inventory, litigations and claims, and the third one is segment information. Okay, these are the selected items. You need to do what? You need to specifically consider certain things. Audit, you need to specifically consider and get this audit evidence for these selected items. What specific considerations you need to get, what evidence you want to get with respect to inventory, you have to specifically consider this aspect, existence and condition. Auditor has to obtain sufficient appropriate evidence regarding existence and condition of inventory. Existence and condition is the specific consideration. Inventory is the selected item. Sir, litigations and claim. What is the specific consideration? The specific consideration is completeness of. Auditor has to get sufficient appropriate evidence regarding completeness of disclosure of litigations and claims. So then with respect to segment information, auditor has to get sufficient appropriate evidence regarding presentation and disclosure of segment information as per applicable financial reporting framework. These are the specific considerations for these three selected items. Now let's discuss what auditor has to do with respect to existence and condition of inventory. Remember, on this a true or false or MCQ question can come. The standard only deals with existence and condition. Valuation part, this standard is not dealing with. Auditor need not consider about valuation of inventory as per SA 501. We are not bothered about valuation as per SA 501. We anyhow check it as per accounting standard. Now what about existence and condition of inventory? That is what only we are concerned in SA 501. So what auditor has to check? What auditor has to check in SA 501? Specific considerations for selected items. Okay, existence. The auditor shall attend inventory counting. It may be 31st March counting or later. You may attend on year end or you may attend on some other date, but you must attend physical inventory counting. Auditor shall obtain sufficient appropriate evidence regarding existence and condition of inventory as at year end by attendance at physical counting and evaluate how management is counting, inspect the inventory, perform test count, reconcile physical inventory with inventory records. Suppose, sir, inventory counting is carried at other than balance sheet date. Auditor could not attend on year end. He is attending on some other date. Then whatever changes occurred between balance sheet date and count date, you shall review. Then physical inspection by auditor. Sometimes no, attending inventory counting physically is not possible for you. Okay, you are unable to attend physical inventory counting. Then okay, on some day where management is counting, on some day, you are unable to attend, then you take some particular date, go and observe physical counts, whatever the date you want to. Suppose, sir, physical inventory counting is impracticable, sir, because of the lockdown situation during COVID. What auditor has to do? Try to perform alternative audit procedure, get evidence regarding whether inventory exists or not. Sir, what is an example of alternative audit procedure? Suppose as on 31st March, company says in godown this much stock is there. 2nd April, 3rd April, 4th April, some deliveries happened. Delivery happened means outward, goods outward means goods are there inside the godown, right? Check outward entries, all that. Alternative procedure include subsequent sale of items of inventory, all that. If suppose alternative procedure also not possible, sir, ultimately existence and condition of inventory I am not aware of, sir. Okay, if the in such a case modify the opinion, give qualified opinion or disclaimer, because you are not getting evidence here. So qualified or disclaimer. Sir, what if the inventory is in the custody of third party? If the inventory is in the custody of the third party, you shall also obtain sufficient appropriate evidence there also. Request confirmation from third party. So any one or both of the following method you can follow. Okay, this is the first method. This is the first method. This is the first method. This is the second method. You can get sufficient appropriate evidence regarding existence and condition of inventory that is lying with third party in two methods. Get a confirmation, SA 505, or suppose if you are having doubt on confirmation, you attend directly, or send another auditor for physical count procedures of third party. Obtain another audit report on adequacy of third party count procedure. Inspect documentation regarding inventory held by third party. What is the proof that third party really having inventory? Get a proof. Request confirmation from other parties where inventory is pledged as a collateral. That's it. So that is regarding existence and condition of inventory. Specific consideration. These are the considerations which auditor has to take into account. Then litigations and claims. What auditor has to check? Auditor has to perform procedures, identify litigations and claims, okay, involving the entity. First of all, what is the objective? Auditor objective is obtain sufficient appropriate evidence regarding completeness of litigations and claims. How far litigations and claims where our organization, the client involved, how far the disclose, is it complete? That one. So for which what auditor has to do? He has to perform the following procedure: inquire management, top management, try to identify what are all the pending litigations, look at the minutes of the meetings, look at legal expenses account, look at fines and penalties paid. Okay, get a direct communication from external lawyers. Okay, and if management refuses to communicate with the third party lawyers, external lawyers, okay, then auditor has to discuss with the top management. If you are unable to obtain sufficient appropriate evidence, modify the opinion. Also, with respect to whatever pending litigations are there, get a management representation, declaration, written representation that none of the pending litigation is hidden from the auditor. Every pending litigation is disclosed in the financial statements. Get a declaration like that. That's what. Then coming to segment information, what auditor has to do? What is the objective? Auditor shall obtain sufficient appropriate evidence regarding presentation and disclosure of segment information as per applicable financial reporting framework. So first, obtain what methods management used. While considering the methods, there are so many things which management has to consider. Sales and purchases happened between segments, inter-segment transactions, all that. For our students, the question has been covered in question bank on SA 501 segment information. I covered in question bank. Please look into that. So check the methods used by management. Are they identifying all the reportable segments as per applicable framework? Check it out and apply analytical procedures also. So that is related to SA 501. So selected items are 3 items. What specific considerations? Audit procedure you need to. Specific consideration is nothing but audit procedure. So that's about SA 501. And there are some points. What are the matters which are relevant when you are attending a physical inventory counting? When you are attending physical inventory counting, what points you should keep in mind? Look at nature of inventory. If it is work in progress, what is the stage of completion? What are the controls related to inventory records and all? Whether instructions are given for counting, how to count, all that. Timing, at what time they are doing physical inventory counting? Is management maintaining perpetual inventory system? These are all questions you need to keep in mind when you are physically attending inventory counting. That's it. Then external confirmation. In external confirmation, this definition of exception is very important. Many students don't understand exception definition. Don't worry, I'll come to that. What is an external confirmation? External confirmation is also called as direct confirmation, also called as third party confirmation. External confirmation is also called as direct confirmation or also called as third party confirmation. So okay, we'll continue. So external confirmation is also called as a direct confirmation, is also called as a third party confirmation. Now, when do we call a confirmation as external confirmation? Only if the confirmation is directly obtained by auditor from third party. Only then we can use the word external confirmation. If audit evidence obtained as a direct written response to the auditor from third party, we also call him as also known as conforming party, then only we call it as external confirmation. Oral confirmation cannot be accepted. Paper or electronic form only we want. And what is an exception? What is an exception? First of all, before discussing about exception, let me discuss what is the procedure for external confirmation. Whoever is watching whoever regular students are there, what is the external confirmation procedure? In question bank, detailed answer is also given. Please check that. Please check that. In question bank videos, a detailed answer is given. Now, what is an external confirmation procedure? First, determine which information in respect of which you want confirmation. Trade receivables, trade payables, all that. Example. Select the conforming party, creditor A, creditor B, like that. Design the confirmation request, which may be positive confirmation request or negative confirmation request. What is a positive confirmation request? It is a request sent by auditor to third party to confirm the information given in the request, whether third party agree or disagree. Both he must reply. Negative confirmation, the third party has to reply only when he disagree. Otherwise, he can ignore. And even in our regular class, okay, we have clearly discussed in our regular class, we would have spent some 45 minutes to 50 minutes on only one standard. Okay, in our regular class, we discussed how positive confirmation request will be prepared, how negative confirmation request will be prepared. We discussed with the detailed examples. Okay, fine. So that's designing the request. Then send the request. We give a time limit. Within the time limit, you didn't get a reply. If it is a positive confirmation request, send a follow-up request also. That's it. Generally, external confirmation is obtained in following areas: bank, inventory held with third parties, trade payables, trade receivables, all that. But remember, external confirmations are not only for account balances. External confirmation can be used to confirm terms and conditions, contracts, transactions, side agreements, title deeds, amount due to lenders for whatever reason. There is no particular thing that you need to say. External confirmation we must obtain only in respect of outstanding balances as on balance sheet date. False. You can get confirmation for anything you want. So external confirmations are not only for account balances but also for above information. Now what is an exception? Exception means what? See, generally in my books of accounts, means my client books of accounts. In my client books of accounts, and based on the evidence which I got initially, the 10 lakhs is the outstanding balance to a creditor. Now I sent a confirmation request to the creditor asking what is the outstanding balance in his books of accounts. He replied saying 9 lakhs. Now, now the information contained in the client accounting records and the confirmation reply given by third party is not matching. That is called exception. That is called exception, not misstatement. Understand? You cannot say it's a misstatement. How can you call it as misstatement? Maybe third party records might be wrong. Okay, so whenever there is an exception, what auditor has to do? Investigate, conduct additional audit procedure. Okay, take client books of accounts, third party ledger. In third party books of accounts, our client ledger, do a reconciliation, unresolved items, inquire client, inquire third party. You will understand whose books are wrong. If the books of accounts of client is wrong, ask our client to rectify. If not, give modified opinion. So exception not necessarily means a misstatement. A true or false question can come or MCQ question can come from. Then now suppose, sir, what if management refusing? What if management refusing? By the way, my regular students, in question bank I covered one more question. Can I use external confirmation as a substantive audit procedure? What factors will influence me when I use external confirmation procedure as a substantive audit procedure? That's an additional question which I covered in question bank. Sorry, whoever is watching marathon in YouTube, it is not available for you. Question bank is not available for you. Fine. So what if management refuses the auditor to send a confirmation request? What if management refuses to send a confirmation request? Inquire why they're refusing. Okay, if there is a genuinity, try to get evidence from alternative procedure. If performing management refusal is unreasonable, you are unable to obtain evidence even from alternative procedure, communicate with top management, give modified opinion as per SA 705. Same way, if third party confirmation is not reliable, discuss with management, try to get evidence from alternate sources. Ultimately, evidence given by third party is not reliable, and you're also and you don't have any alternative ways. Evidence, ultimately you don't have any evidence, then also modified opinion. Then coming to negative request, sir, positive request or negative request, which is superior? Positive request is superior because there is a reply. Even in our foundation business communication subject, you would have learned a communication is effective only when there is a reply from the third party, other party. Positive request, whether he agree or disagree, he will reply. But in negative confirmation request, if at all he is agreeing, no need to reply. Suppose we sent a request, 3 days time limit we gave, he didn't reply. What we assume as an auditor? Okay, everything is matching, there is no exception, there is no misstatement. But actually third party doesn't know that we sent a mail. He didn't notice. Actually there is a mistake in that. That too mistake is in our books of accounts. So this cannot be detected. So sending negative confirmation request is a risky thing. Then why that concept has been put in the standard? Negative confirmation request can be used where risk is low, or you can use it for small homogeneous account balances and transactions, or very low exception rate is expected. Low exception rate means what? The possibility that your books of accounts amount, client third party books of accounts amount will always match. That the mismatch possibility is low, disagreement possibility is low, very low chance of non-response. Third party is such a kind, he will reply for everything. Now look at the definition of exception, you will understand more easily. What is an exception? It's a response given by third party which indicates a difference between what the information I requested to be confirmed, which is also contained in entity records, and information provided by confirming party. The whatever he provided, what is there in our books, which is what I requested to him. The difference is exception. That exception you need to investigate to resolve and identify a material misstatement. That's it. SA 505 is done. SA 505 is done. Then SA 510, initial audit engagement and opening balances. What is an initial audit engagement? First of all, initial audit engagement is an engagement where prior period financials were not audited. Nothing but for that particular enterprise, we were doing audit, right? That's the first time for that enterprise we are doing audit. Okay, for not only for us it is first time audit, but for the enterprise also first time we are doing audit. Last year nobody have done the audit. It's an initial audit engagement, and prior period financials were audited by somebody, predecessor auditor. Predecessor auditor is an auditor from another firm, okay, who has audited the financial statements, okay, whom I replaced now. Okay, so that's called initial audit engagement. What is opening balance? Look, definition of opening balance as per SAF 510 includes three things. Account balances, amount existing at the beginning of the period, accounting policies applied in the prior period, contingencies, commitments and disclosures that are made in the prior period. All these three will come under opening balance definition. Now, what is the audit procedure for opening balance? Nothing. So, whether prior period closing balances, were they correctly brought forward to current period? Check it out. Whether opening balances reflect application of accounting policies correctly or not? Check it out. Perform one or more of the following. Whether current period audit, do you get evidence for opening balance? Example, in current year, debtors, they paid at the beginning, April 1st week, the company received so many amounts. What amounts? These are belonging to 31st March outstanding. Amount received means 31st March outstanding is correct only, so that is that is nothing but an evidence for opening balance. Perform specific audit procedure, get last year financial statement, last year balance sheet, closing balance sheet, signed balance sheet, audited balance sheet. You can trust that by default unless you found some exceptions to it. by default, the current auditor can rely upon audited, certified financial statements of the last year. Trust them, they are correct. Okay, so last year closing balance, take current year opening trial balance, reconcile it. You will understand whether opening balances were correctly brought forward. Suppose if there are some adjustments, they should be prior period item. See whether prior period items are correctly disclosed or not as per corresponding accounting standard. Check it out. Same way, another aspect which auditor has to check in SF item. In SF item, broadly auditor checks 3 points: opening balances, accounting policies, modified opinion in predecessor auditor's report. 3 aspects which auditor will check. Consistency of accounting policy. What auditor has to check? The auditor shall obtain sufficient appropriate evidence about whether accounting policies are consistently applied. Whatever policies that were there in the prior period, the same were applied or not. If there is a change, see why there is a change in accounting policy, whether the changes were accounted and disclosed properly as per applicable framework or not. Check it out. If there is a wrong disclosure or inadequate disclosure, not properly accounted, give modified opinion. Okay, so what is the audit conclusion and reporting for opening balance? So check the opening balances whether correctly they were brought forwarded or not. Suppose if there are any adjustments and that adjustments are not reflected properly as a prior period item, opening balances are containing material misstatement, give qualified opinion or adverse opinion because it's a material misstatement. Suppose you are unable to obtain sufficient appropriate audit evidence regarding opening balances, qualified or disclaim. Audit conclusions and reporting. Remember, what is the audit procedure for opening balance? In question bank, we have covered 2 questions. What is the audit procedure when prior period financials were audited by predecessor auditor? What is the audit procedure when we are auditing the entity for the first time? Initial audit engagement 2 times. What audit procedure we have to follow? So that question is already covered in question bank already. That is not covered as part of this content. My dear regular students, please make a note. Now next, what is the audit conclusion and reporting related to accounting policies? With respect to accounting policies, if they are not consistently applied, give a modified opinion. Suppose if there are changes which are not properly accounted or disclosed, in such a case also qualified or adverse opinion. If you are not getting evidence about it, if it is pervasive, give adverse opinion. Disclaimer of opinion. Suppose predecessor audit report contains a modified opinion. Now that auditor I replaced. So in my current year other matter paragraph, in my current year audit report other matter paragraph, last year so and so person is the auditor. He gave so and so opinion. And whatever the opinion he gave, let us assume modified opinion. Whatever reasons were there, that reasons check in the current year also. Suppose previous year auditor has given a modified opinion that inventory has been valued at cost, not NRV. Check in the current year how the company valued. Did the company in the current year valued inventory at NRV and cost, whichever is lower? If not, you also give modified opinion if you think that is material. If predecessor auditor's report contains a modified opinion and the reason why he gave modified opinion is relevant in current year also, then current year auditor shall also give a modified opinion. That is what this point says. So SF item, initial audit engagement, opening balances. In this standard, you need to check 3 points: opening balances, accounting policies, predecessor audit report. Opening balances, apply audit procedure whatever we discussed. If you find material misstatement, give qualified or adverse opinion. If you are unable to check it, qualified or disclaimer. Accounting policies, check whether are they consistently applied. If there are changes, see whether they are properly disclosed. If not, qualified or adverse. Predecessor audit report, just now we have covered. So that's about SF item, opening balance, initial audit engagement, opening balances. I hope you understood. Okay, so this video is hardly a part 7 video, which is hardly a 25 minutes to 30 minutes video. In the next part 8 video, we will be spending a decent time: 550, 560, 580, SQC and 220. So 5 more standards we are going to discuss in our part 8 video. With the part 8 video, 99% I will close standards topic. Once standard topic is over, let us keep ethics pending. Let us keep ethics. Let's discuss ethics topic at last. We'll first focus on audit committee and corporate governance, then peer review and quality review, then PSU audit, then bank audit. Once we did all that, then we'll discuss about company audit and amendments. Then I will come back to ethics. So that is what our flow of the video, the flow of marathon. I hope until now every one of you are, every one of you understood all the standards whatever we discussed. I'll be happy if you share your feedback in the form of comments in YouTube, okay, so that others also will get to know how much of qualitative content you are getting, what kind of clarity you are getting in subject of audit. That's it. So come to the part 8. So this is part 8 audit marathon, where we are going to discuss now 5 standards: 550 related parties, 560 subsequent events, 580 written representation, SQC1 quality control standard, SA 220 quality control while conducting audit. SQC1, SQC220, there is a slight difference. People generally confuse between these 2 points, but don't worry, this particular part 8 marathon will help you to understand better about those 2 standards. And now, first one, SA 550, related parties. So the first one is SA 550, which talks about related parties. Wait a minute. Just a minute. We'll use which color? I will use something different color completely. Okay, orange will use something, because now already most of the words are in completely in this blue and black. So let us use a different color completely. Fine. So related parties. First of all, let's look at what is the objective of this standard. What is the objective of the standard? Why SA 550? What is the purpose of SA 550? Sir, we already have accounting standard, right, for related party disclosures. Now, what is this standard is dealing about? This standard is dealing about, first, recognize whether any fraud risk factors that may cause risk of MMS in related party relationships and transactions. See, accounting standard related party, if you take a standard, it only talks about disclosure of related party transactions by management. But as an auditor, we are not only liable to check disclosures. See, anyhow we have to check, we have to do audit, where we need to check whether accounting standard disclosure is complied or not. And we have seen disclosures are made, but disclosure made alone is not sufficient. Whether the disclosures are fully made, so we need to check, right? So whether the disclosure of related party relationships, related party transactions, are they fully made in the financial statements? How to identify? Okay, and moreover, understand the related party transactions is one source of committing tax frauds. We all know, you would have learned in direct taxes through Vodafone case or through many other cases that you would have discovered by using related parties, associated enterprise concept. They can do manipulation of accounts. They can escape from tax liabilities, all that. So the standard on auditing is here to make you discover new related party relationship, new related party transactions, discover frauds. So the objective of the primary objective of the auditor is, the primary objective of auditor, see, irrespective of applicable financial reporting framework, whether your accounting standard talks about this or not doesn't matter. The primary objective is recognize whether fraud risk factors that may cause risk of MMS in terms of related party relationships, related party transactions, and conclude whether financials are true and fair with respect to related party relationships disclosure, with respect to related party transactions disclosure. And the secondary objective, obtain sufficient appropriate evidence to ensure that financial statements are in compliance with the framework. So the secondary objective is regarding the framework, whether the applicable financial reporting framework complied by the management, whether with all the related parties are identified, all the accounted, all the disclosed, all the related party relationships, related party transactions identified and disclosure. The identification and disclosure of related party transactions and related party relationships is the main objective of the accounting standard. You have to check whether have they done properly. That is secondary objective. The primary objective of this standard is talking from fraud risk factor point of view. The primary objective is talking about fraud risk factor point of view. Just a minute. So the primary objective is talking about fraud risk point of view. And the second one, we have to comment on true and fairness of presentation and disclosure of related party transaction. True and fairness means whether are there any material misstatements in terms of disclosures of related parties, in terms of identification of related parties as well as transactions. So this is the objective. And sir, what do you mean by a related party? Generally, the definition of related party, you can take whatever is given under applicable financial reporting framework, namely Ind AS 24 or accounting standard 28. So whatever the definition of related party is given in the accounting standard, take that only. Suppose if applicable financial reporting framework contains no requirement or no minimal, it contains minimal guidelines only with respect to related party transactions and related party disclosures. Remember, in India, the second situation will not come into picture. Mostly we have accounting standard, we have Ind AS, which clearly defines who are related parties, who are not related parties more accurately. If at all, suppose, see, these standards, whatever we are reading or whatever we are discussing are taken from international standards. So in some particular jurisdictions, related party disclosure transaction or a standard might not be there. In such a case, the second part will apply. If the financial reporting framework do not contain related party requirements and transactions disclosure, or do contain only minimal requirements, in such a case the following persons are treated as related party. By default, many students have a misconception that related party definition is different in auditing, related party definition is different in accounting standard. That's wrong. If accounting standard clearly defines related party relationship and what is a related party, who is a related party, follow that. If accounting standard that you are following do not contain related party related standard, then follow this. Now, who is a related party? Any person or entity that has control or significant influence over reporting entity. We are the auditor of the reporting entity. So, whatever our client, its holding company or its associate company, we call it as related party. Any person in which reported entity has a control or significance, my subsidiary company or the company where I can influence. Entities that are under common control of reporting entities, which are also called as my all subsidiaries, which are under common control along with reporting, these are called sister companies. For me, same Tata Motors, Tata Steel, both are under common control of Tata Sons Private Limited, so they both are related parties. So Tata Motors will have approximately more than 30-40 related parties. Every company in Tata Group will have approximately 30-40 related parties. Then one more most important clarifications. Entities under common control, they said no. Third point is what? Entities under common control as related parties, no. Now, sir, like if you take Bharat Petroleum Corporation, Hindustan Petroleum Corporation, IOCL Corporation, BHEL, BPC, BEL, BDL, there are so many government companies, right? They all are under common control of central government, right? Now, are they related parties to each other? If the definition of related party applied to government sector, government owned by a state means not a state, okay, government, it may be central government or state government or union territory. Every government company will be a related party for another government company. That's completely wrong. So if the entities are under common control of a government, don't apply that third logic, unless they are engaged in significant transactions and significant resource sharing. Otherwise, they are not related parties. Common ownership point is applicable only for corporate sector companies, not for government owned enterprises. That's it. Then arm's length price definition is also given in SA 550. It is a price at which a transaction is conducted between a willful seller, willful buyer who are unrelated to each other, independent of each other. Both are aiming for interest of their own. Every buyer want to buy the product at lower price. Every seller want to sell the product at a higher price. Every seller want to gain maximum out of the transaction. Buyer also want to gain maximum out of the transaction. So that's called equivalent arm's length transaction. That's called arm's length transaction. So we have understood what is the objective of the related party, SA 550. We also understood what is meant by arm's length price and related party definition. Now, what is the primary objective of the auditor here? What is the primary objective? To identify fraud risk factor related to related party transactions or related party relationships and disclosure. Is there any fraud company have conducted? Try to identify. By the way, are we liable to detect each and every fraud that happened by related party? No. Related party transaction is a significant risk as per SA 315. SA 315 says related party transactions, a transaction with related parties is a significant risky area. Why? Because the possibility of frauds are very high. So what SA 550 also says, try to identify fraud risk factors with respect to related parties. First of all, if I have to identify any fraud risk factor in related party transaction, first I must understand who are all related parties for the company, what are all transaction happened with them. So related party relationships first I should understand, related party transaction today I should understand. In pronouncement, paragraph 13, you take pronouncement, paragraph 13 talks about identification of relations, or this one. The auditor shall inquire regarding identify entity related parties. What is the nature of relationship? Whether the entity has entered into transaction. Ask them. Ask nature of relationship. Ask whether they conducted any transaction. So that is what. Just a minute. So that is what auditor has to do. That's what we're given as a shortcut here. Inquire management regarding list of related parties, nature of relationship. Ask whether any transaction entered. If so, what is the type of transaction? What is the purpose? Alert. B. Maintain alertness. Paragraph 15 and 16 of the pronouncement says maintain alertness. I gave paragraph numbers here because you will refer to that standard actually in the pronouncement book later. Even all our regular students, if you remember, we have covered SA 550 from the pronouncement book mainly. Complete standard we covered. Okay. So what auditor has to? So auditor has to be alert. Auditor has to be skeptical. Inspect the following to identify previously not identified related parties by management. Management has already identified and gave. Does it mean based on management approach you will proceed? Don't you identify, is there any related party relationship? Is there any related party transaction that was not identified by the management? Yes or no? So we have to be alert continuously while reviewing documents, while reviewing records, while conducting substantive audit procedure. Auditor has to be alert. Remain alert. Be skeptical to identify previously unidentified relationships, unidentified transactions. Management by default will give you, sir, 25 parties are related parties, 45 transactions we entered with them. But this may not be exhaustive list. Management would have hidden something, or they failed to discover some relationships. So you have to be alert. Okay. And so like you have to look at bank documents, legal documents, third party confirmations, minutes you need to check, various other records necessary. Sir, how do auditor identify related party relationships? I covered in my question bank. For my regular course students, I covered the same thing in our question bank 18th question. In chapter 3 question bank, I separately gave question bank. In that I covered, look at entity income tax returns, information supplied, shareholder registered, investment registered, agreements, contracts. Okay, I look at the transactions that happen not in ordinary course of business. LIC policies, who is the nominee, who is the beneficiary, contracts renegotiated, internal audit report, entity filings with regulators, all that. Look at all that. You may identify. This is the audit procedure auditor has to do for identifying related party relationships, for identifying related party transactions. So you try to identify maximum possible extent who are all the related parties. 40. How many entities showed? 25. 15 were not showed by the entity. Suppose if auditor identified any, just a minute. Suppose if auditor identifies previously unidentified related party, management have not identified these relationships, not identified these transactions. It might be two cases. They identified, not disclosed it to you, or they have not identified. In such a case, communicate to top management as well as engagement team members. Request management once again to identify all the related party relationships. Why management failed? Management, why did you fail? I have found 35. You said only 25. Why you failed? If non-disclosure is intentional, evaluate the implications. If it is fraudulent, evaluate the implications. Perform substantive procedures for the newly identified related party relationships. Now, while doing audit, you may find some related party transactions outside normal course. What do you mean by outside normal course? Okay, the related one particular transaction was given huge discount. One particular related party, we have given a loan without any interest. These are outside normal course of business. Whether it's a related party or unrelated party, we have to transact at the same rate. You can't differentiate. But there is a possibility that related party transactions might be an area where a fraud can be committed. So auditor have to look at what is the business rationale. Why did you sell at low price? What intention? Why did you not put any interest on that related party? What are the terms? Check it out. Accounting and disclosure requirements, are they adequately made? Because it's not an ordinary course of transaction. And 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 suppose if auditor identifies any significant transactions outside normal course, identify nature of these transactions, check whether related parties involved. Suppose if you identify, I told you, if auditor identified any significant transactions, that is what one of the factor, okay. Identify any transactions that are not in entity's ordinary course. Generally, in addition to the normal terms, generally we have some terms with every customer. Suppose with one particular customer we have followed completely outrightly different terms and conditions, nature of transaction terms, that may be a factor where related parties can be identified. That's it. And finally, alertness. So maintain skepticism while reviewing bank accounts, while reviewing minutes, while reviewing various other records. And finally, obtain written representation. What written representation you have to get? Finally, para number 26 of the standard, if you take, auditor shall obtain written representation that they have disclosed, management disclosed to the auditor all the related parties and all the relationships and transactions, whatever they are aware. Further, management should disclose, the management should give representation that the not only auditor, not only giving you, whatever information we give you, we disclosed in financials. Dear Mr. Auditor, this is my written declaration. Okay, all the related party relationships are these people. These are the transactions. Take it. Further, I am giving one more declaration. Whatever relationships, transactions we disclosed, everything is in accordance with requirements of framework. They are appropriately accounted and disclosed. See, in this, this question might be very important. What audit procedure? This one, identification of previously unidentified related party transaction. This is one of the important question. That's it. With this, SA 550 standard is completed. SA 550, the objective I told you initially, why we have a standard like this? First of all, because accounting standard only talks about disclosure requirements, all that management will disclose everything, fine. Whether management disclosed fully, is there any fraud that was taken place through the route of related party? Okay, that is what auditing standard is putting. That's why I divided the responsibility into two types, primary responsibility and the secondary responsibility of the auditor. Definition and objective, you see here. So there is a primary objective. A point is about primary objective. I named it as primary objective. B point is about secondary objective. Though the standard did not say expressly, I named it as primary and secondary objective. Objective is what contained in 9th point. So I even gave a reference in the material. Please, all of you, SA 550, whoever my regular course student, especially, once again I'm reminding you, 9th point, 10th point, 13th point, 15th point, 16th point, 21, 22, 23, 26. These are the points from the pronouncement you must read for sure. In addition to definition of related party, in addition to objective of the related party. That's it. Okay, just a minute. Then coming to the next one. Then SA 560. Let's take SA 560. So SA 560 is about subsequent events. Same here also. Events occurring after the reporting period. So Ind AS 10. And even you have this one, accounting standard 4, events after the balance sheet date. So what is the standard purpose here? What is the purpose of the standard? First of all, what is the definition of subsequent event as per standard? What is the definition of subsequent event as per standards? 1 minute. See, in accounting standard, we have an accounting standard AS4 as well as Ind AS. What it says, every subsequent event which is an adjusting event shall be accounted and appropriately disclosed in the financial statements. As an auditor, before I sign the audit report, I would have already checked subsequent events whether identified and accounted properly as per accounting standard and disclosed. I will obviously check. Then why we again have SA 560 subsequent event standard? What if you signed the audit report, gave later, after giving the audit report, you identified a subsequent event, okay, which requires adjustment in the financial statements, which require adjustment in the financials, but you did not identify before signing the audit report. You identified only after signing the audit report. How to, whether, see how, I mean, you identified an adjusting event, let us assume, after signing the audit report. Okay, in such a case, what to do? That is why SAF 560 standard was brought. Here you see subsequent event definition as per SAF 560 is what, subsequent event means an event arising after the date of financial statements, but before the date of auditor's report, and fact coming to the knowledge of auditor after the date of report, and the fact coming to the knowledge of auditor after the date of auditor report. Whereas in financial accounting standard, what is the subsequent event? Events arising after balance sheet date, but on or before approval of financial statements date. That's it. Here what they extended, instead of using the word approval of financial statements date, what they put? Auditor's date, and the definition is extended, and fact came to the knowledge of auditor after the audit report date. You see, accounting standard 4 or Ind AS 10, as well as this one SA 560. What is that subsequent event? Let us assume 31st March 2021 is the year closure date. Approval date for financial statements is 30th June 2021. This is the approval date. And as per audit report date can be on or after approval date. By default, most of the auditors put the same approval date. Approval date only, audit report date. So how can be same? Morning they approved, evening I signed the audit report. So 30th June 2021, this is audit report date, this is approval of financial statements date, and date of in the standard on auditing, they don't use date of balance sheet, they use our date of financials. What are subsequent events? Events arising or events occurring after 31st March, after date of financials, but on or before audit report date. So within this period, same period, some events occurred. As per accounting standard, whether all these events are accounted and disclosed, auditor has to check. Auditor checked. After checking only on 30th August, auditor signed the audit report and gave the audit report. And now the problem is after 30th June auditor identified new subsequent event. By the way, when this event happened, this happened between the same period only, and moreover conditions present on 31st March. So this event is adjusting event. But what happened? Actually, during this period, auditor identified only 9 events and checked whether 9 events are adjusted. Everything is fine. So auditor said everything is true and fair. But you know how many events happened between this period? 10 events happened. But how many auditors identified? Only 9. One event is identified after 30th June. Now what audit procedure we have to follow? Sir, it's an event happened between the same period. Before approval only event happened. Condition also there. Adjustment should be done. I gave audit report already. Now I came to know one new adjusting event which should have been adjusted. Sir, if at all I know this event before, I would have not given this unqualified opinion. I would have amended the audit report. But problem is, I gave audit report and now I came to know about the new event. What procedure I should follow? Now check. The standard discusses the audit procedure into 2 parts. Have you identified this event before financial statements are issued to public? Before financial statements are issued to public? Sir, out of 10, 9 I already identified, adjusted. This one event I came to know after audit report date. But luckily, before financials are issued to the public. Very simple. What auditor has to do before financials are issued to the public? Okay, generally what auditor has to do? Discuss the matter with the management. Okay, whether financials require amendment. Yes, it's adjusting. Ask how management is going to amend. Suppose if management amends, carry out the new audit procedure, obtain sufficient appropriate evidence, all that. Okay, give a new audit report with a new date, same opinion, or you can just keep the opinion as it is. With unmodified date alone, you change it, that's enough. Suppose if management does not amend the audit report, financials are not amended, okay, the auditor shall modify the opinion, take back the audit report. Still financials audit report not issued to the shareholders, no, take back the audit report to give. Okay, suppose if the financials are nevertheless issued without modification, without your consent they issued, the auditor, do whatever you want, we are not going to change, we are issuing financials. Management sent a mail, financials, audit report, annual report, notice, everything they sent mail. What auditor has to do? Take appropriate action to prevent reliance on the audit report. What appropriate action? Give an advertisement, one in the national newspaper and the local newspaper. That's it. National means English paper, one in the regional medium. That's it. Suppose, sir, Sir, fact no. Already company I gave audit report, financials, audit report, notice of AGM, annual report, everything is sent to shareholders, sir. Now they are coming tomorrow, day after tomorrow, they are coming for AGM, attending AGM. Now tell me what auditor has to do. Same here also. Discuss the matter. Whether financials require amendment, first check it out and see how management is going to address. Once management ready to amend, they want to revise the financials again. Carry out procedures whether amendment took place properly. Review steps taken by management that anyone in receipt of previously issued financials were informed of the situation. Whoever we have sent mails, were there sent another mail mentioning this mistake is there, consider this new financials, consider this new annual report, were they informed? Consider. Provide a new audit report on the amended financial statements and include an emphasis of other matter paragraph to highlight that particular ACA 560 adjustment. Suppose if management does not take any step, take sufficient steps to prevent reliance. But tell me, do you think this much scene and all will happen, especially part 2? Once the financials are issued to the public, do you think this procedure and all auditor will follow all that? No. What management will reply in real life? Sir, we'll take care in the next year, sir. Don't worry. Let us write it. Let us consider this in the next year as a prior period item. What's wrong for you? What's wrong for you? So that's how management in real life generally replies, and of course auditors also will be quiet on this. Now, sir, what is the audit procedure for identifying subsequent events? We have so many. First, discuss with the management what procedures they are following. Look at whether any new commitments, borrowings are entered. Look at any sales and acquisitions happened after the financial statements date. Look at any assets have been acquired by the government, appropriated by the government. See whether any contingencies after 31st March were materialized. See any unusual accounting adjustments happened after on 31st March. Suddenly new sale entries came. In April second week many entries were reversed. See whether any events occurred that bring into question appropriateness of accounting policy. Is there any event which actually questioning accounting policies? And read minutes of the meeting, read entity latest financials. So by doing all this, you will get an idea whether any subsequent events happened or not. Through this, try to identify all the subsequent events and check whether all the subsequent events are rectified by the management and give audit report. Suppose after giving audit report you came to know about new subsequent event, then case 1, facts came to the auditor knowledge after audit report date, but before financials are issued to the public. Case 2, facts became to the auditor, known to the auditor after the financials were issued. That procedure is what just now we have completed. That's it. That's about SA 560. That's about SA 560. Then we are talking, then now we need to discuss about SA 580. So now in this particular part 8, we discussed SA 550, 560. Now we are discussing 580, written representation. 580, written representation. My regular course students, if you observe in question bank on written representation, we have covered some 2 additional questions which I'm not covering here. Please go through that question bank. So what is a written representation? Written representation is nothing but a written statement. It's just a written statement, maybe electronic or manual, provided by management to auditor. Why? To confirm certain matters or to support other audit evidence. Suppose just now in SA 560, I try to identify, suppose SA 550, I performed some processes. I verified IT returns, I verified investment register, I verified shareholders register. So much I did, and I discovered 28 related party relationships. I went and asked management, I found 28 relationships. Is it fine? Management gave a declaration. Dear auditor, it's not 28, 30. You did a very good job. You identified most of the related parties, but we have 30. Like that, they gave a written declaration to confirm whatever my audit procedure I did, to give me additional information. Look, in this example itself, you can understand. First, I need to do audit. Then take a written representation from management. Sir, management already gave written representation. Sir, 30 related parties. Then why should I do related party identification procedure? Why should I do? No. See, financials itself is prepared by management. They gave a written declaration by all the directors, CEO, CFO. Sir, our financials are true and fair. You took that. You also gave audit report straight away by mentioning by giving unmodified opinion. Then what is the purpose of you being appointed? You are there to do audit of your own. In addition, take written declaration. Written representation can never be a substitute. Written representation can never act as sufficient appropriate evidence. It is only corroborative in nature. It is only to confirm certain matters with you. It is only to support the evidence you got, audit evidence you got. So written representation do not include financials and assertions therein or supporting. Of course, by the way, the standard clearly says, dear auditor, though financial statements, books of accounts are also in written format, though they are prepared by management only, but SEA 580 point of view, books of accounts and financial statements do not constitute written representation. They do not constitute written representation. So then what is a written representation? Just now I said SEA 550. I identified 28 related parties. I went and asked management, is this okay? Is this correct? Management written reply they gave through mail or through WhatsApp message or through a written, declaration on the letterhead that yes sir, dear auditor, whatever you found are correct. Just two more related parties are there. Likewise they gave. So that's a written representation. Now, can I use written representation as an audit evidence? Of course, written representations are necessary information that you want. So, similar to an inquiry response, written representations are audit evidence. However, they do not provide sufficient appropriate evidence on their own. So, based on written representation, you cannot give an opinion. You have to carry out your work. You have to try to identify whatever things happened in that particular scenario. And what should be the date of written representation which auditor should take? For what period? Take written representation for the period for which you are giving audit report. You are giving audit report on 2021, take written representations related to 2021. Data. Written representation should be on or before audit report date. Written representation is also an evidence, right? What is the point of getting representation after audit report is issued? So it must be as near as practicable to auditor's report date, but not later than auditor's report date. And sir, management is giving written representation, sir, at some situations where I'm not getting some evidence. First check it out. Do you need evidence? For sure, which is not management representation? If so, if evidence is not obtained, give modified opinion. No, this is a kind of situation. Suppose it's about accounting policy. Management followed some particular accounting policy, particular valuation method for inventory. They have a justification why they followed that method. I also asked management, I spoke to expert, okay, I'm convinced. So I got management representation. But the problem is, after reading all that entire declaration or entire written statement given by them, I got a doubt. Is it fair? So when you have a doubt regarding reliability of representation, first look at the competence, integrity of the management. First of all, check, are they competent? Are they honest? First of all. Okay, and if written representations are inconsistent with you spoke to expert later and you understood management, whatever declaration they give is false, misleading, and if you concluded finally they are not reliable, whatever written representation on, they are giving you wrong information. Wrong information is equal to no information. No information means qualified opinion or disclaimer of opinion. If it is pervasive, disclaimer, otherwise qualified. Suppose you asked for representation, they did not provide. They said, sorry sir, we don't want to give. Same action, SA 705, express disclaimer if it is pervasive. If it is a basic normal material but not pervasive, qualified opinion. And remember, I even discussed in question bank for our regular course students this topic. What? There are some circumstances where auditor has to obtain expressly written representation regarding acknowledgement of responsibilities of management. What are the circumstances? In question bank it is covered. Please look into it. My regular course students, marathon students not required. You can just follow this guidance and follow whatever the material you are already following. So that's about SEA 580. And now let's look at SEA SQC and SEA 220, the standards which generally most of the students think they understand, but they are not. I'll prove right now. SEA 220, quality control for an audit. See, audit is a subject which requires high amount of visualization. I must have very good practical exposure, or you must have very good practical exposure. If both of us do not have a very good practical exposure, auditing appeals like it appears like it's a theory subject. If either I have or you have, you can visualize. If you don't have practical experience, and if I have practical experience, I can make you visualize. That's the difference. Now, SQC. SQC also starts with quality control. And just a minute. SQC also starts with the quality control word. Even SEA 220 also starts with the quality control. Now you see, the basic difference is SQC is applicable for firm as a whole, audit firm as a whole, okay, which performs audit, review, assurance, related service engagement. All the four terms, you remember at the time of introduction of standards I gave, we do provide as an auditors, as a chartered accountant, we provide four types of services: assurance, non-assurance, assurance based, audit, review with respect to historical financial information. Other than historical financial information, assurance engagement and related services, agreed upon procedures, compilation engagements, all that. So this SQC, What is this excuse? Simply speaking, suppose you qualified as a CA. Now you want to open up your practice. How should I open up the practice? What are all the policies I should design so that I have to run successfully my firm? Read the standard SQC. Not only the main content. The standard was given with explanatory material. Every standard in pronouncement you take, every standard will have explanatory material. Application and explanatory material with A1, A2, A3, that kind of approach. It's a detailed one. Those of you who want to set up a practice of must and should read the standard. This is not applicable only for audit. This is applicable for the firm. Sir, firm means partnership firm. No man, firm means entity, enterprise, corporation, establishment, concern, organization. Here may be sole proprietor firm, partnership firm, LLP, corporation. Okay, I mean a corporation means this one, a corporate form of practice. Okay, you set up a company providing consultancy services, management services. That's it. So what is SQC objective? SQC objective is talking about firm wise. The objective of the firm, as per SQC, the firm shall establish and maintain system of quality control so that the firm and its staff comply with all the standards. Whatever reports they are issuing, assurance report, audit report, review report, whatever reports, they are appropriate in the circumstance. Whereas SA 220, it is only talking about audit of financial statements. It is only talking about audit of financial statements, quality control for audit. What is the standard? This standard only talks about, suppose you are doing an audit of a company, a corporate audit, a stat audit. Now, with respect to that audit, you have to comply with the quality. You have to comply with your firm quality control policies. You have to comply with the standards on auditing. And whatever audit report you are issuing should be appropriate. Whereas in quality control standard, what is the objective? Reports should be appropriate. Whereas in SA 220, what is the objective? Audit report should be appropriate, because SA 220 is only applicable for audit engagement. SA 220 do not apply for review, do not apply for assurance, do not apply for related service, only applicable for audit. So the objective of the auditor, you see there it is the objective of firm they used. Here you see the objective used is of the auditor. Implement quality control procedures at engagement level, audit level, to provide auditor with reasonable assurance that audit complies with the standards, regulatory requirements. Report issued is appropriate audit report. Now, so that's a basic difference between SQC and SA 220. Now they have given some definitions. Within these definitions, there is a point called C, engagement quality control review. Important definition. What is this engagement quality review? Whenever you are doing audit of listed entities, SA 220 says, right now we are in SQC page. Whenever you are doing audit of listed entities, SQC says, before you give audit report, conduct an engagement quality control review. Engagement quality control review. Look, engagement quality control review, peer review, quality review, tax audit quality review, NFRA review. There are different types of reviews. Okay, peer review, quality review are completely different. This is EQC review. This must be done before audit report. Peer review, quality review, tax audit quality review, NFRA review, all these will be done after audit report date. But this review is alone has to be conducted before audit report. For listed companies, SA 220 says, dear auditor, you engage one partner and team, all of you went and did the audit. You decided and concluded something. You decided to give this opinion, but wait, before signing the report, call another CA who is experienced person within your firm or outside the firm, whoever might be, but he's experienced guy. He must be experienced guy. He must be in practice. He must understand what is the audit process, all that. Call him. Give your all workings. Let him evaluate objectively, independently, whether you did audit properly, whether your conclusions are right, because you may have a self-review threat. Not self-review threat as per IFAC, normal self-review. You gave work to the articles, you out of overlook, you may have taken wrong conclusion. So before you sign, better practice to go with that. For listed entities, SA 220 says it is compulsory. So what is engagement quality review? It's a process to provide an objective evaluation, unbiased evaluation before the report is issued. An important MCQ for true or false, or MCQ whatever, okay, of significant judgments the engagement team made and conclusions they reached in formulating the report. Engagement quality control is review in every audit of listed company as per SA 220. What is engagement quality control review is defined in SQC. Now, engagement quality control review will be performed by whom? A reviewer. We call him as EQC reviewer. Who is he? He may be my partner of the firm, or he may be other person, but should be a member of institute, must be a CA. in the firm, my employee or a suitably qualified external person, an outside CA or a team made up of such individuals with sufficient appropriate experience and authority to objectively evaluate before the report is issued. Okay, remember, when the review is done by team of individuals, it must be headed by member of institute, which means engagement quality control reviewer must be a member of the institute. He can be your partner, he can be your employee, but he must be a CA, or he can be an outsider, or he can be group of individuals can review under the guidance of a member of institute. Anybody can be a quality control reviewer. By the way, this SQC standard is applicable to the firm, right? What do you mean by firm? Sole practitioner, partnership, corporation, any entity which is formed by professional accountants. That's it. So that's about a firm, all that. And of course, engagement team, engagement partner, in your articles, you are very much familiar. Engagement partner, the one who is signing the audit report ultimately. Engagement team, senior article, junior article, all of us, the partner, managers, junior article, junior, all of us go and do audit, right? Our entire team is called as engagement team. Then what SQC says, SQC only talks about policies and procedures. What it says, firm shall establish policies and procedures for leadership responsibilities and quality. You see, establish policies and procedure. For ethical requirement, establish policies and procedure. For requirement, establish policies and procedure. Acceptance and continuation of client, establish policies and procedure. HR, establish policies and procedure. Establish policies and procedure. Monitoring, documentation also, establish policies and procedure. Because standard on quality control only talks about the auditor. Firm has to set up policies and procedures for leadership responsibility. They have to set up policies and procedures for compliance with ethical requirements whenever we are doing any work. Establish policies and procedures to ensure independence wherever work we accept, wherever independence is required. Establish policies while accepting the client, while continuing a client with respect to any work. And you know, acceptance and continuance of client relationship with respect to any work is SQC. Now what about audit work acceptance and continuation of client relationship? That is there in SA 220. SA 220 also contains the word acceptance and continuation of client relationship. That is for audit engagement. If the word used is specific engagement, then it is SQC. Why? Because specific, we don't know. Is it about audit? Is it about assurance? SQC talks from complete all points of view. So SQC talks about setting up policies and procedure. What SA 220 says, you know, it doesn't talk about policies and procedure. It talks about engagement partner is responsible. You see here. Here it talks about engagement partner shall take responsibility for leadership responsibility. Engagement partner shall remain alert for compliance with ethical requirements. Engagement partner shall comply with the independence. Engagement partner shall accept and continue the client relationship after considering the following points. Assignment of engagement partner shall, everywhere it starts with engagement partner. SA 220 because it talks only about audit. SQC, you see, it talks about firm shall establish. SQC is all about quality control practices to be followed by the firm. SA 220, SQC is about quality controls to be followed by the firm for all types of works. Whereas SA 220 is only about whenever you're doing audit, the engagement partner is responsible for leadership. He is responsible for ensuring ethical requirements. He is responsible for ensuring independence. He is responsible for acceptance of a client or rejection of a client, continuation of client. He is responsible for assignment of team. He is responsible for performance of the team, monitoring the team, direction, supervision and review, consultation, all that. And engagement partner only responsible to check whether engagement quality review shall be done or not. The audit of financial statements of listed entities and other audit engagements which firm determined as per policies and procedures. Their policies and procedures. For all listed entities, you compulsorily do quality control review. Then what about unlisted entities, other entities? If your firm says you have to do. An engagement quality review is required. Then engagement partner shall determine, recruit an engagement quality control reviewer, discuss significant matters, whatever you found that in audit, and don't date the audit report until completion of EQCR. And now what is EQCR? Engagement quality control reviewer shall perform. By the way, we are discussing about audit engagement. SA 220. With respect to audit, engagement quality control reviewer shall perform an objective evaluation, independent evaluation, unbiased evaluation of significant judgments, significant decisions by team. What conclusions they reached while formulating the opinion. This involves discussing significant matters with engagement partner, review the financial statements, review selected documentation, evaluate the conclusions reached in case of listed entity, whether the team is independent, whether engagement partner has appropriate consultation with the team, okay, and whether documentation reflect work performed in relation to significant judgments. Do you have proper documentation for significant judgment, significant conclusions, all that? What is a significant judgment? SA 500 talks about what is the significant judgments or conclusions. Suppose, sir, I'm an engagement partner, I decided unmodified opinion is fine. Now all engagement quality control reviewer, no, he is saying modified opinion. Now which of this applies? Because ultimately I am the one responsible, right? Now if there is a difference of opinion between the engagement partner and the quality control reviewer, whose will prevail? Firm quality control practice will prevail. You will have a policy and procedure for engagement quality control review, right? In that policies and procedure document, if there is a conflict between the engagement partner and quality control reviewer, whose decision will prevail? The firm quality control policy will put a solution how to resolve this difference. Follow that procedure. And SA 220 also says audit must be monitored. Audit must be monitored. This is about post audit. This is about post audit. What is post? Once what is this monitoring process? Monitoring involves, it's a process designed to provide the firm with reasonable assurance that its policies and procedures are relevant, adequate, operating effectively. This is once audit is completed. Post audit, logically speaking, this monitoring part is supposed to be SQC part, but in SA 220 itself they put, because they are specifically talking about audit, the engagement partner shall consider result of the monitoring process and latest information circulated as per, in the network. Before you finalize the report, you're a member of network firm. Example, in your network firm, some latest issues that were arisen in various audits, take those issues also, consider that before finalizing audit report. Suppose you already finalized, once check whether you complied with all that or not. Deficiencies noted may affect audit engagement, and the engagement partner shall document few things. Engagement quality control reviewer also shall document few important things, and we have given a practical question here. That's it. Remember, in case of listed entity, engagement quality control reviewer shall have a right to evaluate a team independence, whether the firm is independent or not with respect to audit. That also engagement quality control reviewer has to check. Independence part also he has to check. Generally, for other than listed entities, even though engagement quality control review is being carried out, he is not liable. SA 220 is talking about this. With this backdrop, now you read once again SA 220 SQC, later you will understand more better. So this is about SQC. SQC simply says set up policies and procedure for everything. Set up policies and procedures for everything. That's it. That's it. So that's about SQC 1 and SA 220. I hope every one of you have got some clarity on this. Okay. What I'm going to do right now is, instead of uploading part 8 videos straight away, I am going to merge part 1 to part 8, because part 1 to part 8 videos are completely like fundamental terms, audit reporting, where we discuss some 12 standards, and here we have discussed some 10 or 12, totally 25 standards we have covered as a whole. Okay, I think so all these parts I'm going to merge and then upload at a time. That's it. Carry on. And I'm going to mute the previous 7 parts. I'm going to mute them. I'm going to keep it in private. This I will be making it public. So next what I'm going to start is, I'm going to keep ethics pending, because ethics is some chapter where even if you read on your own, you can understand better. But revision is required for ethics also for sure. But ethics revision, I'll keep it at last. So next I'm going to do corporate governance and audit committee chapter. Inside that, except LODR regulations, all regulations, all other content I'm going to cover. And then we are going to talk about this one, peer review and quality review, then audit of banks, then audit of PSU. Then I will take risk assessment and internal control, and automated environment if possible. Okay, ethics I'm not giving for public. I'm not opening for public. Instead of ethics, what I have chosen is risk assessment and internal control, automated environment. These 2 chapters together, 10 marks weightage. This I'm going to put in marathon for YouTube purpose. That's it. Ethics I'm not going to do for public. I'm going to give it only for my students, ethics and other chapters. But believe me, I am covering approximately 50 to 60 marks content in the marathon, which I uploaded in YouTube. That's it.